1, 2, 3, 4, 5, 6, 7 to that. I don't think I need that one. I select, that's fine. 1, 2. Okay. 1, 2, 3, 4. Checking, testing. 1, 2. Are you getting enough signal there? Okay, because I'll just leave it where it's at then on that one. If you gentlemen are happy. Okay, 1, 2. Now we're gonna go try. That's that one. Then we try lectern. Try lectern. We're gonna try lectern.
We on? Yes. Welcome, ladies and gentlemen. Thank you. We're ready to go. And before we do start, I'm instructed to tell you about fire exits. There are two. One is directly outside of this door, opposite, as you leave. The other one is past the registration where you came in, and then down the corridor past the gents' toilets. We're not expecting a fire. We're also not expecting a fire alarm. So if we do have a fire alarm, it's a real one. Please do, I was going to say, normally you say switch your phones off, but don't today. Put them on silent, but do keep them on for the app, which I'll talk about in a moment. My name is Richard Thatcher. I'm a director of FinTech Global, and it's my pleasure to welcome you here today to the ESG FinTech Summit. I'm delighted to say we're sold out. We're going to have to use a bigger venue next time. We've got a capacity of 400 people coming in today, with over another 100, I think, that we've allowed to come through virtually, as they couldn't quite make it for a number of reasons. I'm delighted to say that over 50% of those attending throughout the day are actually ESG leaders at financial institutions. And the rest of you are innovators and expert service advisors. So it's a phenomenal group of people we're delighted to have got together. And that should be no surprise, because it was actually client demand that drove us to putting this together. We run events in all subsectors in FinTech, and we've worked with the financial services industry for many, many years. And this is an issue that's very much at the top of their agenda. So we're delighted to be kicking this off with a focus on what really is an important matter for every financial institution at the moment. And everyone you'll meet today is actually involved in driving the ESG transformation. So we could have had it 10 times bigger, but we really don't want the hangers on here. We really wanted to make sure that your experience is such that anyone that you engage with is very relevant to what's happening in the industry and potentially very relevant to what you're doing in your organization. Before we start, I'd really like to thank all of our sponsors and exhibitors who have helped us put this together. They are all industry-leading solution providers or industry-leading service providers. So please do take the opportunity during the plenty of the several networking breaks we have to go and visit their stands. You'll be amazed at what sort of technologies are being used to help drive ESG success. And if it's not something that you're using, it might be something that your competitors are using. So if you don't want to be left behind, you really do need to be talking to these industry leaders. You will be amazed at the innovations that they're working on. To get the most out of the day, please don't forget the event app. It's called Brella. If you download that from the App Store or Google Play and use the code VINPTM, sort of random code. It's a great app, but they couldn't work out how to come up with a code that was easy to remember. It will give you all the information you need, all the agenda, all the sessions, everything about the sponsors and exhibitors, all the bios of our speakers today, and if we have any interactive Q&A, surveys and polls, you'll be able to get involved in that. Most important of all, it'll allow you to connect with people so you can arrange meetings with them. There are already several hundred meetings backed up, so please do check your meeting requests. You'll be comforted to know that everyone you'll meet today is worth meeting because of the way we have actually been selective in how we organise the attendees. It's worked very successfully in our other events. Many of our other events are a lot larger than this, but the success has been driven very much by people being able to connect with the people they want to meet, and the app has enabled that and has resulted in a huge number of investments, partnerships, and deal proposals actually being initiated, and many of those going through. For those of you who don't know about FinTech Global, we provide market-leading FinTech intelligence to financial institutions. We're probably the biggest information service provider in the FinTech industry. We probably do more research and write more news across all FinTech sectors than anyone else, covering innovations, technology, trends, strategy, We also produce customized research and have advanced data analytics for anyone that wants to use that to look at the industry. And we create profiles on basically every fintech company by engaging with them directly. If you want more information, please go to our website, www.fintech.global. You can sign up there. You can sign up for our InsurTech newsletter or our RegTech newsletter or our RegTech analyst website or our InsurTech website, which is coming out soon. So no surprise then that given that we do so much in the industry, that we've actually developed what we think is the largest professional fintech network around the world. And that's comprises of over 300,000 finance and technology professionals who are actually heavily involved in the digital transformation of the financial services industry in one way or another. That also means that we've got a distribution channel to the decision makers and the influencers of those decisions in this industry. So if you are a innovative solution provider, there are a lot of financial institutions that are very hungry to know about what you can offer. So if you do want to be able to use the network to be able to present your solutions, please do talk to any member of the FinTech global team and talk to us about an impact marketing solution where we work with clients to actually get them the awareness they need amongst potential clients, and that has resulted in a huge number of successful deals. So today couldn't be more timely. We are at a turning point. The financial services industry has reached a turning point for ESG. That's evidenced by the headlines just in the last few weeks alone. We all know what's happening. It's all coming to a head. We've clearly reached peak greenwashing. The regulators now are applying a lot more scrutiny to what's happening, and they're acting. We've seen what's happened with Deutsche Bank, Goldman Sachs is under scrutiny, BNY Mellon have been fined, and these are by different regulators. So you can see this is happening worldwide, and people are beginning to challenge the hollow green rhetoric. And that's good. That's what we need. That's what the industry needs. So please do feel free to express your opinions today. There will be no circulation of your thoughts to the BBC. So don't worry about what happened with the HSBC guy. Nobody's going to throw you under a bus today. The videos will be available through our sites, but if there's anything that's too controversial, we will get your permission before. But if we don't have those sorts of conversations, the industry is not really going to move on, and now is a time that it desperately needs to move on. And we're also at a point, given what's happening with food security and Ukraine, where the very definition of ESG is being challenged by world events. So an important time to be here, an important time to engage with others in the industry to help drive it forward. And that means those of you that are ESG leaders face huge challenges. FinTech innovation is going to be essential for you to be able to meet those challenges. It's time for some people in the industry to stop polishing their halos and get on with it. That doesn't apply here. We excluded all the halo polishers, so don't worry about meeting any of those. There's a need to address all aspects of ESG. I know a lot of what I just put up is very much about the green area or the climate area, but ESG is so much more than that. We've got to talk about data, about governance, risk, and social impact. And so the agenda today will address all of those issues. We obviously need a more rigorous assessment of ESG objectives. When you have oil companies on an ESG list, but not Tesla, clearly things need to be thought through a little bit more carefully. There's a need for strategic leadership and viable action plans rather than just the hot air. And a lot of the transformation, the changes, the drive to net zero will be driven and supported by FinTech innovation. So that's what today's about. So don't underestimate how relevant that is to your ESG journey. Just to give you a bit of background on the level of innovation that's happening in this industry, I just thought I'd share some of the data that we have on ESG FinTech. In the last 3 years, it's grown 20-fold, from 57 million in 2019 to over 1.1 billion in 2021 last year. And that's just investment in third-party FinTech companies. So there's plenty more happening within larger institutions and broader technology organizations, but it indicates how big an area this is. And if you look at this year, over 600 million in the first quarter alone has been invested. So this year is very likely to be much bigger than last year as well, another record year. And the number of deals, as you see, over the last 3 years has increased 5.5 times from 14 to 78. Our research shows there's a lot more happening in the pipeline. If you want that data, if you want any other data on fintech, please do have a look at our websites or our newsletters. We actually provide a lot of it for free. So that's the background to what is a very important day for a very important topic. And therefore, I'm absolutely delighted to be able to introduce in a moment our first panel discussion of the day. We'll be talking about integrating ESG into business strategy. And to chair that keynote panel, I'm delighted to welcome Ben Kellard. Ben is Director of Business Strategy at the Cambridge Institute for Sustainability Leadership, an institute I know very well, as I actually studied there 10 years ago. Ben advises businesses on how to align their purpose and strategy with the transition to a sustainable economy. So, relevant and important to all of you, no doubt. And he leads several international initiatives on sustainability in business. He's got over 20 years' experience as an organisational consultant. It's my pleasure to hand over to Ben. Ben, if you'd like to introduce your panellists and your panel topics, welcome to the event.
Thank you very much indeed. Hopefully, you can all hear me okay. And a very warm welcome to you all. Great to be here with you this morning. As you mentioned, clearly things are really hotting up. ESG is very centre stage right now. I think we've seen that there's around 2.7 trillion across 500 funds, 3/4 of which is in Europe, and it's been up 12% in the last quarter. So we're seeing huge growth. And so really, kind of an exciting time to be in this whole space, and clearly fintech has got a really important role in that. But on the other hand, it's also a very ambiguous term. I think we use terms like ESG, purpose, sustainability almost interchangeably, but they mean actually very different things, but the risk is they mean all things to all people. There was some work done by Influence Map, who found that they did analysis of 593 ESG equity funds, and actually found that 421 weren't aligned with the Paris Agreement. So we're seeing quite a significant discrepancy on actually what we might, even just the Paris Agreement, let alone other dimensions of ESG. And you mentioned, that we're seeing the regulators at work, we're seeing dawn raids and so on. There's quite a big gap in that ambiguity, and I feel it's a bit like the Wild West. There's a lot of ambiguity, people piling into this space, and regulators starting to really creating some common goals and some common language for disclosure. Also, we saw a report just yesterday from Greenpeace and WWF looking at how the UK financial industry and financial services industry is actually responsible for double the UK emissions in terms of the actual investments that they're invested in. So again, we see this big discrepancy between where we need to get to create a sustainable low-carbon future and where we are today. So what I think that does is that creates a big opportunity. It's big for both individual businesses and financial institutions, as well as the funds that they manage, to align their purpose and strategy with a low-carbon sustainable future. So I'm really delighted to be able to be joined this morning with some great experts to explore what this sort of both challenge and opportunity means for both fintech, for financial services, organisations, and the funds that they manage. So as you can see here, we have Denise from Pollination, a very warm welcome. Also, we have Rishi from NatWest, a very warm welcome to you, and Adi from Lloyds Bank. So what we're going to be doing is looking at some questions, and I'm going to be drawing out a sort of conversation between us. But also what we'd really like to do is hear your questions as well. So please do sort of share the questions, and I've got my trusty iPad here. I'll be sort of moving to taking your questions as we move through the session. So that's where we're gonna flow. So the first question we're going to explore is, how can financial institutions develop clear objectives and create measurable KPIs to track progress? So, Adi, if I can maybe turn to you first and offer you maybe some insights.
I was almost going faster than you in there. Well, good morning. Brilliant to see this room full of people interested in the topic of ESG. I think in terms of setting KPIs and targets, what has already been mentioned is quite relevant. ESG is a broad landscape of things. It's not just climate, it's not just gender diversity, it's not just pay gap, modern slavery or human rights and so on and so forth. So I think when an organization, particularly an FI, a financial institution, is thinking about setting ESG targets, it's very important to be clear about the scope. What is it that you're going to set targets on? What are you trying to manage? You could try to manage your impact on an issue, such as climate change, which is more around decarbonization or portfolio alignment, more popularly known as net zero these days. And you could also set targets around the risks that you manage. So what are the financial risks that you face as a bank? What's the credit deterioration for your clients because of climate change and so on and so forth? They're different things. And it's quite important to have a credible set of targets and goals, to be extremely clear about what you're setting your targets on, how you're going to measure them. I mean, there's an old cliche, but cliches are cliches for a reason. So, I mean, they make sense in most cases. The cliche is if you cannot measure it, you cannot manage it. So if you do set a target, if you do set a vision, or a strategy at a high level, you need to have measurable targets. That comes down to appetite from the board and the senior management and all that. And then the third and the final thing I'd say is have a plan to achieve that strategy. It is not always straightforward. There are trade-offs to be considered. We can get into those examples. Hydropower is a brilliant example. So you might say, as an organization, if you want to set, let's say, renewable energy targets, in terms of how much you finance, hydropower is not a bad thing to do. From a biodiversity perspective, it is not a good thing to do in most cases. Now, you can manage those risks. So understanding that whole landscape, if an organization is clear that, look, our goal is renewable energy, we're not really prioritizing biodiversity at the moment, you're probably missing a trick, but at least you have a clear vision. And then investors know that, okay, if you're not interested in biodiversity, do I want to invest in your company or not? So being very clear about the scope and ruthlessly prioritizing, I'd say, because it is not possible for one organization to cover all elements standing today. There is a bit of a journey. But as long as we make progress and make clear progress, measurable progress, that's probably the best place to be.
Thank you very much. That's a great sort of initial perspective there. And so Denise, if I can turn to you, it'd be great to get some of your insights on the KPI question.
Sure. Good morning to everyone. First of all, a very quick introduction. I'm Deniz Harut. I work at the intersection of climate and capital today at a company called Pollination Group, which specializes in climate-related advisory and investments. Before Pollination, I spent more than 16 years in the banking industry, doing various different roles. I advised sovereigns, financial institutions, companies access the global capital markets, touching many themes like job creation, women's livelihood bonds, green bonds, etc., etc. My last role in banking was as head of sustainable finance for Standard Chartered Bank in Europe and Americas, where Adi actually was my climate risk guy before he joined Lloyd's. So I'll do the introduction on your behalf, Adi.
I just realized I forgot to do my introduction.
So on the KPI question, how do you set targets for a chunky, large, inefficient organization like financial institution? It's a very difficult task, but I agree completely with Adi that it starts with understanding your impact and the change that you would like to see, and define measurable, often in the case of climate change, science-based targets to transform your balance sheet. Before I share more views on this, I want to sort of offer a teeny bit of a reminder of the history. This relevance occurred to me very recently. When I moved to London back in 2008, I'm Turkish by background, it coincided with the week the Lehman Brothers collapsed. Some of you will remember the 2008 global financial crisis where, many people have lost their homes. The states had to bail out the largest financial institutions. Millions of people, lost their savings. The savings melted away. Many jobless on the street, etc. So it was the years where the social impact of banking, of financial services was felt most negatively. And as a result of that, the whole industry rewired itself. And today, when we look back at what happened, why did the crisis happen in the first place? The banks were packaging and marketing their products in an unethical way, and not disclosing the risks transparently to their customers and investors. Today, I would argue you could define this as ESG risk to some extent,
Absolutely,
right?
yeah.
Now, what happened since then? Of course, every crisis has some consequences, right? Positive consequences also. The regulations were rewritten, ESG policies came to play, risk frameworks changed completely. It opened the space for fintechs to disrupt, right? Because banks became very inefficient and heavily regulated. And a decade later, what I see today is not as sort of negative to that extent, but a rewiring of the financial services in a similar way, when we look at the climate risk and what that poses as a risk to the financial ecosystem. So thanks to 2008, we are in a much resilient, much healthier position today. You know, we weathered COVID for 2 years. Hopefully the inflation era, we're gonna get through one way or the other, but we need to make sure that we understand climate risk and how it sort of impacts the balance sheets of our institutions, but also the customers that we serve, so that we can be resilient in the face of that. Now, what does it mean for all of us? Like, what is the financial services industry doing today? What targets are being set up? And what do we now expect to see from all financial institutions as a general rule? First, I'd like to talk about TCFD. Like, let's mention some frameworks that are now becoming, you know, mainstream. TCFD started about 5 years ago as a voluntary task force led by the financial institutions. So this is financial institutions changing the industry, right? Where there is a common agreement and guidance printed around how you should disclose the impact of climate, the financial impact of climate on your balance sheet. Now, 5 years later, it was launched by Mark Carney. Today, more than 2,600 companies disclose voluntarily in accordance to TCFD guidelines. So we can argue that, you know, you are expected to do or follow the same suit. Otherwise, you risk being or having limited access to capital.
It's also becoming mandatory
exactly.
in the UK and various jurisdictions.
Exactly, and it's becoming very global also. Then we have United Nations Principles of Responsible Investing, UNPRI, which provides the data tools, also suggestions around data tools on how you should set your sustainability targets, mirroring to the Sustainable Development Goals. Again, another voluntary initiative, but thousands of asset managers and asset owners today participate in UNPRI. We cannot not mention European Commission's taxonomy and SFDR, the Sustainable Finance Disclosure Regulation. Today, most of Polynesian clients that are asset managers are in the middle of understanding what is Article 6, Article 8, Article 9, what does it mean in terms of the data that I need to collect from my portfolios, how am I going to report that, and also the mere fact of doing due diligence is changing in light of that. Like, what do I need to include in my due diligence process? Last but not least, Science-Based Targets Initiative, SBTI. We talked about Paris alignment, 1.5 degree alignment, 2 degrees. There's a debate around that. But SBTI is a very credible, powerful tool helping companies and financial institutions decarbonize, backed by science-based initiatives. And now when we look at companies, or when investors look at companies, they expect that the portfolios are also signing up to SBTI and getting on with it. So these four large frameworks that are out there that have been launched very recently in the past 5 years or so, I think have quickly become the general rule, and everybody should incorporate that in their strategy. Now, why are we here, like where we are today? I think the most pivotal moment was when companies started realizing the real value of ESG best practices. And some early adopters are already reporting on it, like the Unilevers, etc. of this world. What we are observing at Pollination and helping companies achieve is that climate action is becoming a core part of the company valuations, and it's being incorporated in financial models at the moment. So what the investors expect, what we expect is the next sort of decade's alpha, so return on investment, competitiveness, profitability, efficiencies, it's all gonna be directly related to climate strategies of the companies. So there is a numeric value now attached to climate action, hence, you know, the scrutiny coming to it from investors. And very rightly so, the regulators are also going to scrutinize very heavily what the investors call ESG and what they do. Sorry, it was a bit of a very long response.
That's great, and I think that's really helpfully set out the landscape, which is changing so fast, isn't it? Because we've also now got Task Force for Nature-related disclosures come out, hasn't it? It hasn't got the same momentum as TCFD, but that's growing rapidly, so you're right. That's really helpful. So, Rishi, as a head of climate and sustainability finance, it's really interesting also there in your title, it's reflecting that broader base. What's some of the insights from a NatWest perspective you can share?
Sure, happy to come in here. So just by way of very brief introduction, NatWest Group, 18 years now, 14 of those years have been focused primarily on climate and sustainability. So I've been here before it was cool, just to be clear. Outside the office, because I'm a bit of a geek like that, I chair Camden's local government pension scheme, which is a small £2 billion ESG award-winning pension scheme, but I'm also chair of all of London's pension schemes, which is £45 billion, and that's given me my first grey hairs, so I no longer feel young at all anymore. This has been a real mission for us. So about 8 years ago, I switched in my career within NatWest from financing renewables. So I previously financed about 500 megawatts, lending 500 million quid to finance wind farms, solar parks, and my favourite project, a whiskey waste product processing plant in Scotland, to try and think about how we bring climate into our strategy. I remember one of my mentors when I started in banking many years ago saying, "Oh, don't focus too much on climate; it might go away." And I won't name them, but it just always makes me laugh. We knew at NatWest we had a CEO change moment coming up, and it was a long mission. Knowing that we had and backing the two horses that were potentially our future CEO, and we realised that was the time to really embed. I mean, I think Denny's pointed out very well. Banks failed in 2008, and we all owe a debt to society to help repay some of that debt, both financially but also morally. Banks inherently can also be a force for good, whether it's half my balance sheet is mortgages, so it's helping people buy their homes. There are good things that banks do, and it's quite strange, you know, if I was saying this 14 years ago, I would not have been able to say it on a platform and say banks are good, because that was not the public feel. Now, the next stage for us in that evolution, and our CEO back in 2020, just shortly before the pandemic, set out our new purpose-led strategy. In this strategy, she put climate at the heart of our new strategy. For me, that was, incredible. I still sort of pinch myself sometimes when I think that my CEO at COP is there with Joe Biden, with world leaders, pushing the climate agenda, because actually banks can do more. And actually, why are you all here today? Because we can't do this alone. Climate change is not a problem that's going to be solved at Lloyd's, at Pollination, at NatWest. It has to be a collective endeavour. And that's why I think, for me, the last couple of years where we've put this into our strategy, started to set really challenging targets. When we set ambition to halve our financed emissions by 2030, we couldn't even measure our financed emissions at that stage, okay? We now have 52% tracked through our SBT and aligned with SBTI. The frameworks are key, and I like the intro speaker, because we have to really be honest with ourselves about this. I heard the term swashing yesterday, which is social washing, and I hadn't heard that one before, but greenwashing and swashing are the biggest enemies, because we lose all our credibility if we do that. On climate, I think it's sometimes a little bit easier, because actually we have carbon, and we can measure carbon, not 100% well, and I think some of you folks, I'm sure, will have ideas and solutions and tools to help us do that better. But I think the way we need to do this is embed it. So we started at the top of our house in our strategy. Climate's there. We have to reduce our harmful emissions. So, and we've got to reducing oil and gas exposure. We're lucky, for example, at NatWest, because we don't have much US exposure. So we start from an easier place than some of our peers. So it is a bit easier for us to be bolder on oil and gas. But hopefully we can then move the market on that. Then we need the key bet, and then getting our house in order, so reducing our emissions from our direct emissions, that's important too, because we have to walk the talk. But the real power is our balance sheets. It's the £200 billion, whether it's my 100 billion mortgages or the 100 billion I lent to corporate customers and help raise capital. And moving that and aligning that to climate measures is so key. So, financing green is good, and we talked a bit about the taxonomy and frameworks for that. We're still waiting on the UK taxonomy. It's been a long, long wait. I ended up writing my own and publishing it. It's available on that NatWest website because we couldn't wait. We needed to move things on. But the bit where I want to sort of put into the audience's mind is that we need to help our customers transition, because that's how the real economy transition. And again, it's not just me, it's not Addy. I need Addy to do it, I need Barclays to do it, I need HSBC to do it. And how do we help those solutions to help our customers do it in a genuine, authentic way? And I think we don't have all the answers on this. We're beginning to develop some of those, but I'll pause there because I know there's other questions.
That's great, thank you. And just to sort of contextualise that, I think a lot of this comes down to value. Though I don't know if anyone caught the Mark Carney and the Reith lectures, who's talking about linking how we understand value to crises, going back to the sort of 1930s, 2008, and then now, and tracing it back to how so far, of course, we've had these externalities, carbon, waste, biodiversity, which we just have been invisible to balance sheets and P&Ls up until now. So we're now bringing those in to how we understand value creation, which brings us back to kind of these terms, ESG, because I think we need to remember ESG was originally a sort of a filter for funds, wasn't it? That's what it was originally designed to do. And a bit like Milton Friedman said, in a crisis, people look for useful ideas lying around, and ESG was the idea lying around in the financial service industry, which has been co-opted. All well and good so far. But it's not been designed to help think, what does a business or organization look like that is sustainable and resilient into the disruptive future we're going into? It's not designed for that purpose. And I think it's radically trying to catch up with that, which is why it's interesting where we're coming from Cambridge is saying you need to bring in evidence-based goals. Because if you're not bringing evidence that reflects the latest science, you're essentially deluding yourself that you will be resilient into the future, because you're carrying externalities that are creating massive liabilities for the business, which are invisible to you and you're not managing. And so I think that's the other interesting piece, is how do we move from because the risk otherwise that we're into incrementalism. We're doing something on climate, great. Are we doing enough? That's the real question. So if we maybe move on to thinking, you've touched on it, Rishi, already, which is around how do we bring this into the businesses and funds that we're involved in. I mean, Addy, if I could maybe turn to you at Lloyds, you've been doing a lot like NatWest, aligning your goals with the Paris Agreement across your loan book. But I was just wondering, can you share some of the insights from your experience about actually really integrating sustainability and ESG into the business and the funds that you're managing?
Yeah, so clearly I've not had enough coffee. Rishi is one up on me. Just for a quick introduction, so my name is Adi Mukherjee. I joined Lloyds Banking Group about 6 months back as the head of ESG in the credit risk function. Prior to that, I was 10 years in Stanchart, most recently running the climate risk shop centrally. So I've always been a bit of a doom and gloom risk function, second line of defense guy. So everything I say depresses people, so prepare to be depressed. To your question, Ben, I guess, I think it was already touched on. So basically, when I got into the climate risk job, which was about sort of 4 years ago, I actually got into it since it became cool. I wasn't an old timer in this. I realized this is a very niche area, and everybody kind of, not to put blame on any single bank or institution, it's just everybody's talking about it as a niche thing. We're not talking about mainstreaming it. If you had a question on sustainability or climate at the time, you'd have 1 or 2 people in the bank, whom Denise would know very well, that you go to, and they are the experts. But nobody in the frontline teams, the relationship managers, those who are sourcing, originating transactions, nobody in the credit function or the second line of defense who are supposed to challenge it know about this stuff. They don't, because the reason is we hadn't mainstreamed it. So we are not speaking the language that these people speak. So if you're talking to a credit officer, you need to talk the potential impact to cash flows, the credit grade deterioration. That's a different language from, for example, talking to your operational risk colleagues and people who manage your data centers. They don't care about credit deterioration. They care about business continuity plans. So there's two different, completely different dimensions. So the need to talk the language that the mainstream people speak, and having that understanding, I think very similarly, I guess since you said this, Rishi, I'd be kind of, I'm happy to, not happy, but I admit the fact that Lloyd's Banking Group, for example, had set the same target, so we'll halve our financed emissions, or set that same ambition, halve our financed emissions by 2030. We were in a similar position, so when we said it, we didn't know how to measure it, but it was an ambition that was set by the leadership at the time, which we are now working through. And then there's also a point around, because I come from StanChart, which is a global bank with a lot of emerging market presence. In StanChart, we used to say that it's easy for NatWest and Lloyd's to decarbonize. Having moved into Lloyd's, I'd argue against it, actually, because our baseline is already so low, because we don't finance, between NatWest and Lloyd's, we don't finance that much oil and gas, relatively compared to StanChart, so, or, HSBC or the global banks, or the American banks for that matter. So for us, because the baseline is already so low, to go down 50% from there, it's a more difficult problem than it sounds. So there's a lot of these factors to be considered. So it's not just about niche, it's also Rishi's job, if I may put words into your mouth again. So Rishi's job cannot just be Rishi's job. So I think the success of his job is if all of the frontline bankers talk this language. Success of my job is if all of the credit function talk this language. It cannot just be me looking at it. It has to be the bank.
Great. No, that's really, really great. And Rishi, anything you want to add from the NatWest perspective on this integration piece?
I'd love to, and I think there's sort of two parts to me. One is the internal side, and I see Adam from our innovation team here, Tracy from our data climate team here. The key thing for me was building a carbon army across this organisation. So, before we were a small team. The Climate Centre of Excellence in NatWest is about 14 professionals now, which partly because of the strategic focus. But we were 3-4 people when we started on this journey. Now, we needed our risk folks bought in, and what we've done is sort of two main routes about this. One is training, so programs like CISL. I can't not say CISL today, but great training programs there. But also the University of Edinburgh, who we've used for 12,000 colleagues have done climate training. So we're building a massive carbon army because we need that baseline of understanding that every role, as you say, Adi, has to have a climate angle on that. Whether you're frontline, whether you're doing a middle office function, or whatever you're doing, front branch staff, every single person. So that's been one aspect. The second part is our staff network. So being Pride Month, we all know we've got a lot of affinity networks. Our Sustainable Futures network is 3,000 young, bright people who keep me on my toes. It's fantastic. They can help push us on things like just transition, on biodiversity, where the banks are slower and a bit more conservative on some of this stuff, and this is what we need. We need that heat from that passion from our colleagues. Then coming to our customers, because our customers will be part of the solutions, and ultimately, if I want to finance customers in 2030, I need them to be halving their emissions, and if they're not, I can't bank them anymore, and then I can't be a profitable bank in the future, and we can't exist. So we need our customers to be on this journey with us, whether that's retail customers decarbonising their homes, and green mortgages at the moment are the first phase of decarbonising. It's not a real. It's attracting. It's decarbonising our balance sheet. It's not really moving the homes. That's got to change. That's got to help. We've got to have solutions to help our customers, and it needs government policy as well. You can't. That's not going to happen. The last thing any of us want is 100 builders over in our homes over the weekend doing our insulation, and we need to change that and have the incentives to do that. Then SMEs, and some of you will be SMEs here today. What are those solutions for us? Are you solution providers, or how are you thinking about this, and how do we make it as easy as possible? So we're about to launch a tool, I think it's in pilot at the moment, for measuring emissions for SMEs. Mid-corporates, large corporates, there are products existing, sustainability-linked loans, and we need to do this for every customer segment, and we need to be meticulous on this because it's a whole economy transition. So I think there's both an internal side and an external side, and I think everyone here should be thinking about there's so many problems to solve, we can't do it alone.
That's great. And also it's worth signposting, isn't it, that while there's also on the green finance a lot of regulatory activity, it's hard to exaggerate just how fast the non-financial reporting is moving as well in terms of, I think, real consolidation in terms of what metrics we're using. You say it's pretty mature on carbon, but as we start to look at biodiversity, social, and so on, that's moving really fast, which again will hopefully create a level playing field. Denise, if I could turn to you, it'd be great to get your insights on the whole integration embedding question.
Yes, certainly. And I agree both with Rishi and Adi. I think, again, like thinking back what happened in 2008, it's always important to remember who the most important stakeholder of a financial institution is, and that's the customers, that's the clients. It's the mortgage borrowers, it's the small businesses, it's the people who trust the financial institutions with their savings, investments, etc. And 90% of them today, I'm making up the number as I speak, they have no idea what a good ESG practice looks like. And they need to be brought on board the same journey if the banks want to get to the net zero targets. And that's quite challenging because the data today doesn't exist on small businesses. The awareness levels are patchy. The Kpis, the borrowing requirements of small businesses are going to change because of this trend, and also it's going to, explode. So the banks, from what we see, are today trying to position their firms in a way to be able to keep up with that demand, which is quite impactful on its own right. So in the roadmap to get to net zero, the role of the banks are quite crucial. So for that, you will have to look into technology providers, how to do that most efficiently, how you engage with your customers in a way that you can help them understand transition and what it means for their businesses, etc. It also is a huge opportunity. There is a completely new economy emerging as a result of this. Fintechs being one example of that, new technology. So how do we all sort of read what's happening, what this trend bringing to us in a most efficient way so that you can create the products and the solutions to help accelerate much faster?
Great, thank you. And just a signpost, because one of the other things we found is that there's also a capacity gap. People think, how on earth do I go about decarbonising and so on? So one of the things we've done is basically provided some guidance, which is you can find on our website, but just to signpost those. So one is called Targeting Net Zero, and it's basically a guide which not just our work, but all the great stuff that's out there, what's the journey a business can go on to decarbonise. Also, through one of our platforms, we do a lot in our Centre for Sustainable Finance, working with banks, and they found there was a real gap with, if you like, relationship managers of their real economy clients. How do they help them decarbonise and finance that? So we also created a guide called Let's Discuss Climate, which is really designed for bank managers to have that conversation with their real economy clients. And in fact, Annabelle Ross, my colleague, is in the room who is involved in that, so do grab her if you want to find out more about that. We're also been involved in the first ever British standard for sustainable purpose-led business, which is getting launched next month. I was on the steering committee, so that look out for that as well. So again, just really trying to provide some common guidance. So going back to things like TCFD, a lot of it was very much saying that there's both risk and opportunity for businesses to adjust and to a sustainable low carbon economy. But often the opportunity bit gets missed out as people try to get their heads around the risk, which, let's face it, is a task enough. So I want to just move us forward to that opportunity agenda, really. So if we can maybe look at what do you see as being some of the opportunities both for financial institutions, but probably also as relevant for fintechs to really open up those. So it'd be really great to get your take on what do you see as being some of those real opportunities here in this space. Rishi,
Happy to go first, given it's in my job title. Probably useful. So, it's the key thing to keep my colleagues interested and excited on climate, because if we come from just a risk perspective, you're not going to excite the front line. You're not going to get people engaged. People want to see what are those business growth opportunities. So we've been very focused today in the industry today on financing green. So we're very good at financing renewables. It's easy to do, relatively easy to do now. I know my first wind turbines felt complicated, but it is relatively a commoditized product. And we're getting better at that with taxonomies, and we do need taxonomies to make sure there's no greenwashing. But the biggest opportunity will be financing the transition. Because actually, as Dennis said, the customers, all these customers who don't even know that they're going to be on this journey yet, are going to need that capital investment or going to need to have those products. We set before COP, we set a £100 billion climate and sustainable finance target. To try and avoid greenwashing, we've published exactly what we include in that. We review it every year, and we're waiting for the UK taxonomy to come out. But the next phase in measuring transition finance is going to be even harder, because when you're thinking about, just to bring it to a retail example, back to retail example, it's sort of easy to imagine financing an A and B rated EPC mortgage. But when you're improving a property that can only go up to D, what does that count as? And do we want to do that? We want to improve the energy efficiency of the housing stock. 80% of the UK's housing stock will still be there in 2050. It's a massive retrofit proposition, and we've got a lot of that on our balance sheet. So I keep trying to get my execs and senior people excited about this and understand that's an opportunity for you, because actually helping your customer make their home warmer and easier to keep cool as we increasingly have more variable weather. There are real opportunities to help customers in this, and I think it's both a financing opportunity, but it's a 100 billion target, which all our balance sheet by 2030 needs to be helping the tackle climate change, rather than, it's not going to be piecemeal. It shouldn't be a target. All my balance sheet needs to be aligned this way.
Brilliant, that's great.
I would just politely disagree, though. I don't think the opportunity side gets missed in a banking conversation at all. In fact, I'd say quite the opposite. It's just kind of the poor risk people kind of starting to tell the business colleagues like Rishi that, well, actually, you need to worry about the risk as well. I think, to me, but again, I would obviously say that because that's how I earn my bread. But I think the greenwashing point is really, really relevant. And to me, it's encouraging that the business people like Rishi and Denise in her old role talked about greenwashing and were really trying to do the right thing, because there's a big targets game here, right? So, for example, if NatWest says they want to do 100 billion, Lloyds that somewhere would want to say that I want to do 105 billion. And in a way, that's a good, healthy competition, because I would push NatWest to 110 as well. So it's all in the right interest and right direction. But we all know when we set big targets, we've seen instances where creates ethical issues, wrongdoings. Very recently, I went to a steakhouse. I wouldn't name the steakhouse, where I've been sort of going quite regularly, and they've now branded their steaks as sustainable steaks. You might know which one I'm talking about if you're a fan of steak. I was shocked. And if I had any sort of, it is not sustainable. Okay, there's a bit of animal welfare maybe, but steaks, it's like calling oil sustainable. It just cannot be. It's very difficult. It could be possible. But so to see claims like that, which is just riding the wave, and potentially, I'm not saying they're just riding the wave, but I still very firmly believe that steaks are not sustainable. Just riding the wave and branding something sustainable just like that without kind of suffering the consequences of it is quite risky. So if I were the owner of the business, I would be a bit scared about this, because some activist somewhere is going to pick this up and potentially go after them. And the banks have similar risks as well. So to be very, very mindful about not getting this wrong in the race for targets and numbers is very important in my mind.
And I guess that's also one of the big major roles that fintechs can play is data transparency, right? Isn't it? Because as we start to measure stuff more consistently, right across the value chain, people are really interested in this data. Both from an aggregated as well as a product level, at a fund level, at a company level, and there's increasingly less places to hide, isn't there? As we have the tools to create that transparency and make more informed decisions at every part of the system.
I completely agree, and I completely agree with everything that's said. Sustainable finance exploded in the past 3-4 years, and most of it is, I can argue, is not properly labeled. And I don't think there's any more tolerance left to greenwashing, as we've seen the headlines, shared this morning, and it's only going to get more scrutinized, which is natural. One, I think. Still untapped opportunity, which also offers quite a big sort of space for fintech providers, is what I would define as carbon markets and natural capital. Talking about risks and opportunities, 1/3 of global emissions today come from agriculture, land use, forestry practices, etc. But only 3% of what we call sustainable finance today goes to these sectors, where land use and agriculture and forestry sustainable practices can become a very meaningful solution in the fight against climate change as well. So we at Pollination think about how we sort of crack that and become an intermediary that channels more flow into nature capital. And you mentioned TNFD, which is something I wanted to reiterate. like TCFD, TNFD, which has recently been launched, is going to bring that additional understanding of, what the risks are. And when you understand what the risk is, it's a lot easier to act on it, and it also leads to opportunities. So nature is going to be the next big thing as we see the trend. Today, most of the large asset managers are trying to develop a nature-based investment strategy, and there the role of data, the role of technology, using remote or ground-based sensoring technologies, etc., is going to be quite crucial in sort of turning that into $1 trillion asset class. So I think the way that I see the whole ESG trend moving is what it was like maybe 10 years ago, simple compliance, sort of risk management policy that turned into something financial and political, and now moving into, okay, net zero is no longer enough, we need to become nature positive.
Yeah, that's great. And because the thing is, we know the big systems that we need to transform to create a sustainable future, and there's because all the sort of academics like us and NGOs all come up with the same systems, because we know it's the food system, we know it's the energy system, we know it's how we transform cities and so on. And I think the question is, how do we make that transformation? Rishi, back to your point, I think what I see so often is we can get a sense of where we need to get to, for example, zero carbon, mobility, but we don't know quite how we get from where we are to that point. And so there's a whole series of, both barriers and enablers like infrastructure, but also finance. How do we unlock the finance? Because if we get it right, that's a massive opportunity globally. Same with the food system. One thing, again, just a signpost on nature-related risks, we've also developed a guide to help businesses figure out what their nature-related risk is. Also, the guidance under TNFD is excellent, I think, and we were involved in that, but there are great guides out there. So some quick-fire questions, maybe just a yes or no. I've got a great question, which is the financial market moving too slowly? Adi?
That's a difficult one to answer in yes or no. Probably yes, honestly, but the pace is increasing, I'd say. So the momentum is there, the demand is there, the push is there, and I think we're only going to go faster. The only concern I have is the greenwashing and the swashing side of things, just to make sure that that's well controlled.
Great, thank you. Rishi?
So, I joke that Mark Carney became my pin-up boy alongside Jamie Vardy on my wall, because actually the regulators forcing us to have to do this helped me move a lot of my colleagues that maybe are moving slowly. I still think we're moving too slowly, and the pandemic obviously distracted, and all of us, I'm sure financial institutions, a lot of them did similar things like us with helping our customers, but we need to get back on this and treat it like an emergency. At the moment, it feels like we're sort of ambling towards 2030 and 2050, and that leads to failure.
Great, thank you.
For me, it's yes and no. You can always move faster, of course, but making sure it's a just transition. We need to think about, not causing harm on the other side of the spectrum. And also, it's moving, I think, fast because, all the predictions or forecasts we did on renewable technology 5 years ago proves to be completely wrong today because it's been moving too fast, right? And I also think, what's happening in Ukraine, the energy crisis, the food crisis, it's going to accelerate the whole transition. I'm a little bit optimistic on that as well.
Yeah, because I think often we have a continuity bias, don't we? We think the future is going to be much like the past, and all the trends we're seeing is it's not going to be anything like the past. So, and also that idea of tipping points and positive feedback loops, I think we're not used to thinking how fast they can kick in. So, folks, just sort of to as we come into land, I'd just be curious to know, given our audience, that we've got here, fintechs champing at the bit to enable the transition, what would be your kind of one takeaway for them that you would like to kind of show them from your vantage point? What's the sort of the key contribution they can make towards delivering a sustainable economy?
So climate VC, I think, I read something, I think it was the Bank of America report, it's a 40 billion industry, climate risk analytics today, and it's expected to be 2 trillion in the next 5 years or something. I mean, the capital, the availability of capital to support climate tech and climate risk-related fintech is growing so rapidly. So seize the opportunity because we need more solutions.
So looking across ESG, I'd say on climate, just think of it as a series of lots of different problems. It's not one thing, and we need your help. I mean, quite frankly, I'm delighted to see a room of people who seem engaged. Maybe it's the first coffee's kicked in, but we need you to be coming up with the solutions because there are so many knotty problems. This is a really difficult political, financial, economic challenge, and we need your help. And then I guess just to touch on social, because I know we've not touched much on social today. That's so immature relatively, and it's so far behind. Look out, the City of London Impact Investment Institute are doing a bit of a report coming out in July. We need more thinking on that, and some of you could help with that thinking because actually it's just being forgotten quite relatively. It's quite far behind climate.
That's a kind of keeping the different lenses in mind. So there's the business angle and the people angle. I mean, fintech people are people as well, as I can see. So you would you have the same obligations as we do as people, as employees of the financial services industries, to ask for more from your banks, from your institutions, from your asset managers, from the kind of food you eat, if you're not like me, a big steak fan. And then I think the point I made around speaking the same language is very important because the banks speak a certain language. Even if it's a bite-sized problem, we understand things in a certain way. And I think there's a two-way conversation to be had for the solutions to be effective, because it's not good enough to just say that, well, we do it this way, and you get this amazing satellite monitoring of something which doesn't mean anything to a banker. Equally, a bank should not be saying that, well, I don't care about satellite feeds. So I think there's a middle ground to be had, and that's where the success of this collaboration will lie in the future and today as well, which is let's start getting to common ground on similar languages, prioritize, again say ruthlessly prioritize the problem that we are trying to solve, be very, very clear about it, and then have a plan to solve it. And I agree with everything that's been said. I don't think banks can do this without fintechs and pretty much the entire society getting behind this.
That's great, thank you. Yeah, and I guess one final thing I would say is to align your core organizational purpose and strategy with a sustainable future, because otherwise there's a great question here, which is, does ESG sometimes conflict with corporate strategy? I think it's a false dilemma, because either you think that you can have a commercial strategy that can be resilient as it is in the face of all the trends, in which case you're deluding yourself, or you think that your ESG or sustainability strategy doesn't need to be commercial. So it's a false dilemma. And again, to signpost, there's a report we've done, which is Leading with a Sustainable Purpose, which practically breaks down how 4 leading multinationals practically did that. So Unilever, DSM, IKEA, Interface Floor. Guys, we could have talked all morning. I really enjoyed the conversation. Hopefully you folks did as well. So on that note, I'd be grateful if you could just show your appreciation for the panel. Thank you very much.
Ben, thank you for chairing what was a very insightful and actually informative discussion. It was a fantastic way to start the proceedings. We've covered basically everything there, and we'll go into those topics in more detail throughout the day. So thank you, Denise, Rishi, and Adi as well for sharing all of your insights. It's a pleasure now to introduce our first keynote speaker for our presentation. Greg Davies is Head of Behavioural Finance at Oxford Risk. He's a specialist in applied behavioural finance, decision science, and sustainable investing and financial well-being. He's got some extraordinary academic affiliations with Cambridge, Oxford, Imperial, LSE, UCL. He's the author of Behavioural Investment Management. And if you look at his biography, he's done some amazing things in music and wine as well. So delighted to be able to welcome Greg to talk about sustainable suitability. What do investors actually want? Welcome.
Thank you very much. Good morning, all. It's absolutely wonderful to be here. A bit like Rishi said there, I've been thinking about this ESG thing from an investor perspective from before it was cool. First started looking at this in 2013, 2014. From a behavioral perspective, what we're after at Oxford Risk is we're a fintech that specializes in applied behavioral finance, and we build software to help people make better financial decisions. And that word better is very, very important here, because better financial decisions for people, for real people out there, aren't just the decisions that maximize a risk-return trade-off. They are decisions that help people to best reflect their preferences in their actions, in their investing actions. And people's preferences always go much broader than a risk-return trade-off. They go into, what are my values? What am I trying to achieve from my life? So the reason I started looking at this some 7 or 8 years ago was because unless we were considering people's attitudes towards sustainability, towards how they do good with their wealth, we weren't actually considering individuals and helping them to make better decisions in the broadest possible way. Now, at Oxford Risk, we have been working on understanding these preferences for 5 years now. We've done large-scale behavioral research projects in 4 continents, 7 of them, covering almost 10,000 different individuals. And these are the data that we use to build profiling tools, to really understand what it is can we measure about people that is stable and that tells us what they actually want. And there's a bunch of things we know from this behavioral research. This is just a distillation of them. One is, this is not going to come as to a surprise to anyone in this room, but there is substantial latent demand out there. The majority of people, in fact, the overwhelming majority of people, maybe there's 20 or 30% of people who genuinely claim not to care about this, but approximately 70% of the investor population does want to do good with their wealth and wants to engage with this through their investing activities. We also know that demand here is driven largely by attitudes, not by demographics. There are a few demographic variables that are important, most notably age. And that's not because, well, what we tend to see is that younger people are more willing to engage with ESG and impact investing, etc. That's not because older people are nasty. It's largely because the novelty of the field scares them off a little bit, and they would rather do the good that they want to do through charitable donations rather than through ESG investing. A really key point here, once people do this once people engage with sustainable finance, they tend to stick with it and they tend to do more of it. So that first link is really, really important. And from our perspective, investors differ. Different investors want different things. We talk about ESG, but some people are more E people, some people are more S people, some people are more G people. If we're going to unlock this demand, we really need to personalize. And that doesn't always mean we have to treat everyone as an individual, because we also know from statistical analysis that we can group people into common sets of attitudes that at an archetype level can help us to design propositions, marketing activities, funds, etc. Let's just look a little bit of the data right at that first bit, that there is latent demand. These are data from 2020. These are actually across Europe, Middle East, and Asia. Investor population at the moment, at 2020, and I suspect it's gone up even from there now, in the general population, 69% know what a sustainable investment is. Only 36% have so far made a sustainable investment. If we focus on high net worth populations, that number goes up dramatically. So this is here and it's here to stay, particularly because once people engage with, they stick with it. But if we're going to make it work, we have to start building systematic tools that will link investors to investments. We can't just build a suite of green funds, plonk it on our product shelf, and hope that people will buy it, because there are many, many behavioral barriers to engaging people with this. Now, we've got these tools, and I'm going to show you a little bit of them in due course, but the goal here is not profiling. It's not just understanding preferences. It has to be, how do we build this and layer this on top of a suitability system? And one of the things that we think MiFID has got right is it talks about ESG suitability or ESG preferences being an overlay to traditional risk-return suitability. We have to integrate these things. We can't have a suitability system that looks at risk profiling and liquidity preferences and all that stuff over here that's completely disconnected from the system that looks at ESG preferences. So the first level here is always, have I got the right portfolio for this person, reflecting where they are in their lives, their risk preferences, all that standard suitability stuff. But after that, we go through a sequence of problems that we need to link the profile to what am I actually doing with this? What does it mean for this person's portfolio, and how can I demonstrate that to the regulators? How much ESG do they want? Some people want less, some people want more. Some people, as I've said, are perfectly happy to do all the good they want to do in their lives through their philanthropic activities, and they're happy to keep their finances just about finance. That's not the most common thing, but we have to unlock that middle ground. So how much ESG if you want, and if you wanted to put this into sort of MiFID parlance here, what is your balance of Article 8 and 9 funds versus Article 6 funds at an individual level? Secondly, once we've decided how much ESG people want, how do we start to allocate that between the options in front of this? Is this person an E person, an S person, and a G person? How do we build a portfolio that resonates with them as an individual? How much proactive, deep ESG, maybe Article 9 we can think of this roughly mapping to, versus the shallower, more exclusion Article 8 ESG does this person want? And then finally, we can get on to individual instrument selection. Does this person want to do good now, or are they happy to focus on things that are doing good 500 years in the future through climate change? Do they want to do good globally versus locally? Which of the UN SDG scales that resonates most with them? Now, we have built profiling tools that can measure preferences across all of these things and can then start to automatically spit out percentages that are recommended for people about Article 6, Article 8, Article 9, what proportion of your portfolio do you want to have in the EU taxonomy, et cetera, et cetera. The crucial thing here is that the regulators have started to mandate that wealth managers and advisors examine investor preferences, but as an industry, we are incredibly bad at doing that in a sensible way. So for example, the MiFID regulations say something along the lines of, you need to determine how much a person desires to put into funds that reflect the EU taxonomy. And the typical approach of many compliance departments is then to go, oh, great, I'll slap a question in my suitability process that goes, what percentage of your portfolio would you like to have in funds that meet the EU taxonomy? Now, it is absolutely impossible for any retail investor to have a preference for that and to answer it coherently. And yet they will give you an answer because you've asked them a question. What we've been striving to do is to ask the question, how do we build a set of profiles that measure things that are genuine, measure preferences that are stable, that are actually the preferences of these people, and then map those to the sorts of regulations that they want. Because there's a huge danger of reflecting the letter of the law in regulation, and in so doing, simultaneously completely undermine the spirit of the law. So where we start from is, what can you measure that you know is accurate, that you know is stable, and that you've built through empirically driven psychometric techniques of measurement? So the sort of questions to avoid here are anything that uses jargon, anything that asks people for percentages. These are all extremely bad practices. When we build profiling tools, we go back to, we effectively test hundreds and hundreds of questions on thousands of people. And what we're asking is very simple questions like this. Sustainable investing seems complex on a scale from strongly disagree to strongly agree. That scale in the psychological literature is called a Likert scale. It's very widely used. Its statistical properties are very well understood. And another advantage of it is these questions are incredibly fast and quick for people to respond to. So every question that you use goes through a whole battery of statistical tests that enables you to really understand that what you're asking people is reflecting genuine preferences. You can see we've got a stand out there. Please go and have a look at it. We've got a publication here of exactly how we link these preferences to MiFID requirements. There's a bunch of booklets out there. We also, one of my colleagues is going to be doing a demo at 11:30. But what I want to focus now on is, what does all this data tell us about what things we can actually measure, what preferences we can actually measure about people? So we process these thousands of responses. And what we do is we use the statistical processes to say, which questions give us the greatest bang for buck in terms of the signal they give us. So with asking the minimum number of questions about people, you can understand the maximum amount of variability between end investors. And there's 4 key scales here that we've identified. One is very simple and very high level. Impact desire. Roughly, how much does this person want their portfolio to reflect their values? Second dimension, impact trade-off. To what degree is this individual willing to see ESG impact as a genuine secondary objective alongside their financial objectives. One of the things that the asset management industry has been peddling for the last 5 years, which I think is deeply erroneous, is that we can all do as much good as we want in the world for free without any impact on returns, without taking on any more risk. Now, it is true that a certain amount of considering sustainability is just good investment practice. I want to identify the companies that are going to be more sustainable in the long run. But including things in your investment process to generate portfolios of higher risk return isn't ESG investing. That's just investing, right? If you really want to invest to match people's preferences, we need to understand that there is a trade-off between doing more good in the world and the returns I'm likely to get from this. And the important thing we know from our research is that 70% of people are willing to embrace this trade-off. And most of those are not being addressed at all by the product shelves that are available at the moment. Need for evidence, another dimension on which investors differ considerably. Some people really don't need any evidence at all. They go, just give me the stuff, I believe you. And some people really need a lot of evidence. The reason this is important is if you're going to sell products to people, ESG products, we need to be using the right narratives. We need to be talking to people in the right way. Now, the people who need a lot of evidence, this is one of the slightly depressing areas here. If you ask them what sort of evidence they want, do you want real-world case studies? Do you want quantitative evidence? They don't care. The end investor really doesn't care very much what sort of evidence you give them. All they want is someone to come along and give them a kite mark from an organization they trust. Now, this has two consequences, one positive and one negative. The positive one is we as an industry do not have to wait until the measurement problem is completely solved before we start to bring people into ESG investing. People will do it as long as they trust the organizations that are giving them the solutions. The negative side is it opens us up completely to greenwashing, because if the end investors are not going to look under the bonnet, then it becomes very easy for investment houses to sell stuff that they've just slapped hashtag ESG all over. The last dimension here is impact apprehension. And this is really important at the moment. There are lots of people out there who score high on impact desire. I want to do good with my portfolio. They score high on impact trade-off. I am willing to think about giving up some financial outcomes if I know I'm going to do social or environmental good as a result. But right now, I just find this thing too novel, too daunting, too scary. And understanding that is fundamental in being able to deliver the right narratives to people to bring them over. Now, all of these are very, very high-level preferences. If you take any individual, everyone will have their own score relative to the baseline population on these four. So there's a signature, a unique signature that helps us to very quickly determine what should their portfolio look like, how much Article 6, how much Article 8, how much Article 9. But we need to go deeper because these are very high-level things. Another aspect of our profiling tools is looking at people's actual strength of preference for E versus S versus G to start to tease this apart. And I'll show the data of the averages here. If you put people in a forced choice, you say, would you take E or would you take, what's the first one? Would you take E or would you take G? The average person says, yes, I would choose E over G. The average person chooses E over S, and the average person chooses S over G. So there's a very, very clear pattern of E, then S, then G. But we can easily identify subgroups of people for whom this is not the case. One of the most interesting findings was in the US, people who identify strongly as Republican often score very high on G and don't really care too much about the E or the S, right? If you want to sell things to people, you have to understand where their preferences are. We are now working with a couple of the big ESG data providers to map our investor ESG data to their investment ESG data in order to create personalized portfolio construction techniques, personalized benchmarks, so that at an individual level, we can say, how much does this portfolio meet your balance of preferences for E, S, and G? And ultimately, what we're after, and this is what you'll see in the tool that's demoed at 11:30 if you go there, is we have these preferences. We can measure all of these scales. We know they are robust. We know they are stable. We know that they're measuring real things. These aren't just a bunch of questions that we've slapped together. We can measure relative preferences for ESG, and importantly, we can then map those very directly to the sorts of things that are required by the regulation. We have a variation of the tool that does the MiFID stuff. We have a variation of the tool that cuts out some of the more silly bits of the MiFID regulation because they don't actually reflect preferences. But ultimately, what the wealth management industry needs and the financial advice industry needs is a tool that goes, yes, I can measure what is important to this person, and I can turn it immediately into recommendations for a portfolio. How much ESG do you want on the right? How much do you want to keep in sort of non-ESG, Article 6 stuff? Can we identify the balance between Article 9 deep ESG, Article 8 shallow ESG? And more than that, we can give people their own personalized benchmark for the weightings of ESG that are relevant for them. The last thing I want to dwell on, because we have one final layer to the tool that is, it's all modular, so most of our clients are not using this, but we can also elicit directly investor preferences across the UN Sustainable Development Goals. So not just do you prefer E to S, but which specific causes are most important to you? And this becomes very important, particularly in a wealth management context with high net worth investors, because it enables you to truly deepen the discussion if you know what matters to people. We have a few clients who only have one fund. They go, we're not separating our shelf into an ESG shelf and a non-ESG shelf. What we're doing is we're saying ESG permeates everything we do. So if you come out as a moderate risk investor, this is the fund you get, and there's lots of ESG in there. Now, that's fine. The question is, how do you make people comfortable with that? How do you give investors the emotional comfort to get into it and to stick with it? Well, the interesting thing here is those funds tend to have a little bit of everything. But you can make people comfortable with 100% of their portfolio if you tell the right stories to them about 5% of the portfolio. So if we can start identifying what matters to people, you surface those stories you bring those stories to the surface, you start to hyper-personalize your communication and your narrative. And that means you're going to be drawing more people in to the ESG proposition, and you're going to be keeping them in and making them better investors as a result. So we can measure UN SDGs, and what that starts to do is to enable us to very systematically map at scale through algorithms to various aspects of the product shelf, which products are ranked, are weighted in order to map products to people in a way that's effective. And for our view, the frontier of ESG, the next step that we're heading down, particularly with all of these greenwashing backlashes, is we're starting to see the regulators are doing dawn raids on people who are doing this superficially. We need to do it right. But more than that, if you really want to do good through your portfolio, then simply moving from one portfolio to another, divestment, is doing a limited amount of good. If you really want to do good, you want to be marshalling the preferences of your investor body into company engagement. And we're starting to talk to a few of our larger clients, not about using this for product selection or for building ESG portfolios, but to marshal preferences into shareholder engagement, into voting, into enabling people to be complicit through their pension fund investments or through their ISA or whatever, in directing their preferences towards shareholder engagement, towards putting propositions on the AGM of fossil fuel companies, etc. So rather than divest, can we keep people invested and use them to put pressure on that? And all of this ultimately comes from measuring something behaviorally about investors that we know to be important and mapping it to actions that they feel comfortable following up on. Thank you.
Greg, thank you for an excellent presentation. Clearly an amazing tool you have for profiling in order to help meet investor preferences. If you'd like to know more, I'm sure it's relevant to what a lot of you do, please do connect with Greg during the networking break, or indeed go and have a look at the demo that Oxford Risk are doing later on today. My pleasure to introduce the next presentation. on climate change and commercial lending, the risks and rewards. It's my pleasure to welcome Matt Bullivant, who is Director of ESG Strategy at Oaknorth. And as many of you know, Oaknorth is probably one of the most successful challenger banks. So you didn't start off with a horrible legacy, so you can actually tell us how to do this properly. I understand you were formerly head of sustainability at Close Brothers, also worked at Deloitte and Barclays. There's another organisation I know, they fired me 20 years ago, but we won't go on about that. But welcome, delighted to welcome you to the stage. Thank you.
So, morning everybody. Thank you very much for inviting me here today, and thank you for the intro. Yeah, I've, prior to Oaknorth, been in the financial services industry for 15 or so years. I finished up at Close Brothers Group as their head of sustainability. And I've had the privilege of being at Oaknorth for the last 6 months or so. Entirely new role for the business as Director of ESG Strategy. I'll try and be concise. I know we've only got 20 minutes. If there's time for questions, obviously happy to take them. Otherwise, please do find me afterwards. I'm always very happy to talk about this sort of stuff. For those of you who don't know Oaknorth, I'll spend a minute or two just giving a bit of background. So back in 2005, our co-founders, Rishi Khosla and Joel Perman, were looking for a working capital facility for a business they'd founded previously, Kpis Partners, which was a financial research firm. And they approached numerous high street lenders and were finding consistently that the computer said no whenever they approached them for funding. And that was despite the fact that they had a profitable business, they had strong cash flow, they had retained clients, all the sort of things that you'd be looking for. And the challenge was that it simply wasn't cost effective for those lenders to spend the time and effort doing a fundamental assessment of their business and structuring a finance solution for their needs. Now, as it transpired, one of their institutional clients was able to source them 100 times the amount of debt finance through a dividend recap. So putting debt on the balance sheet and repaying it as a dividend. So the institutional division of a bank was able to help them, but the commercial lending side of a bank was not. And that experience is one that stuck with them. So after they scaled and sold Kpis Partners to Moody's in 2014, they set about trying to find a solution to that problem of financing growth businesses that they'd experienced firsthand. And at Oaknorth, we refer to that as the missing middle. So what we do to tackle that funding challenge is we utilize our commercial lending software, the Oaknorth Credit Intelligence Suite, which we license to other banks, the likes of Fifth Third, Capital One, PNC, SMBC, and the likes of those. We also use that software in the bank in the UK, Oaknorth Bank, which got its banking license in 2015, and thus far has lent over £7.5 billion to growing businesses across the UK. We also, as a bank, have been net zero through our Scope 1 and 2 carbon emissions since 2019. And we've set ourselves a 2035 net zero target for all of our emissions. And that includes our Scope 1, our Scope 2, our Scope 3, and all of those emissions that we finance as well. On top of that, Oaknorth Bank was one of the first institutions globally to stress test its loan book for climate change and the impact of it. And you can have a look at the outcomes of that in our annual report. So this wouldn't be a climate-based presentation if I didn't start on a bit of a downer. Now, I've reflected on this slide and realised it's a decidedly British representation of the weather. And of course, climate change is a global issue. Many of these images are taken from Storm Arwen or Storm Barra, and a lot of us in the UK will remember the impacts of those very recently. But if you're in India right now, you're experiencing extreme heat waves. If you're in the US, California has seemingly endless wildfires. This is a global issue, and we're all experiencing the impact of climate change right now. And regulators the world over have begun to stress the importance and the impact that climate change is having on financial stability, and also on the creditworthiness of even the most resilient of businesses. However, where there's risk, there's also opportunity. And climate change is probably the greatest opportunity for financial services in a generation. That is a big number. That is McKinsey's estimate that it will take $9.2 trillion worth of investment every year between now and 2050 for the world to meet its climate goals. So these are truly staggering numbers involved in the opportunity that climate change presents. But if we look at a breakdown of where the major sources of emissions are across the globe, some lenders might look at that breakdown and they may look at their own lending portfolio and they might think, you know what, this doesn't overlap neatly with us. So climate change, it's just really not a thing that impacts us particularly. If we take somewhere like Oak North Bank, for example, we have never lent to the oil and gas sectors. We don't have an agriculture book of any description. So it would be very easy to think, you know what, climate change is somebody else's problem. However, we know that the physical and particularly transitional risks of climate change have a ripple effect through the supply chain, and we will absolutely be impacted by climate change on our portfolio. So I'll give you an example of that, just looking in slightly more detail at one sector. So if we take automotive, so even if you don't lend directly to an automotive manufacturer, that automotive supply chain has multiple component parts to it. That might be the parts manufacturers, the parts suppliers. It might be the dealerships selling those cars. It might be the used dealerships selling used cars. It might be the maintenance shops, the workshops, the repair centres, the servicing centres, the emissions testers, or the scrap yards. So there is a broad value chain associated with any industry. And the likelihood is that your portfolio will be connected to that in some fashion or other if you are a lender. Now, with the automotive sector, a chart like this won't surprise anybody in the room at this stage. We have all seen the explosion in demand for electric vehicles lately in the last couple of years. So since 2019, that's more than doubled. We're now, last year, approaching 9% of global new car sales being electrics. That is only going in one direction. So we need to think about what will be the impact of this change in demand, of this changing landscape for automotive, to the supply chain within that sector. You know, that is going to have wide-ranging implications, not just for car manufacturers, but the suppliers of those parts, the providers of equipment for the manufacture of cars, but also the value chain beyond it, the sellers of cars, the users of cars. So to look at that in a little bit more detail, if we take America's #1 selling car, which is the Ford F-150 pickup, so the iconic all-American vehicle. Now Ford have pledged that they will only sell electric vehicles by 2035, which is a good statement of intent in itself. And if you are invested in Ford or one of its peer manufacturers, then there's an obvious implication there and an obvious consideration. But if we think about the broader ecosystem here, in the US alone, there are 18,000 new car dealerships, and those are selling predominantly internal combustion engine vehicles. There are 140,000 used car dealerships, and those are definitely selling predominantly internal combustion engine vehicles. But there are also over 230,000 auto repair, service centres and workshops conducting equivalents of MOTs, emissions tests, repair and maintenance, all of the sort of things amongst hundreds of thousands of other businesses who are connected to this industry. So when we're talking about the impacts of climate change on autos, when we're talking about someone like Ford shifting to only manufacturing EVs, we shouldn't just be looking at Ford, we should be looking at that broader supply chain. And if you are a lender, you need to be looking at your loan book and who might be connected to that value chain. And just taking an individual data point as part of that, in an internal combustion engine, there are 2,000 moving parts. An electric powertrain has 0.01% of those. So if you are involved in the service and maintenance of automotives, that has a huge implication for you as a business, moving from internal combustion engines to electric. So that knock-on effect, if you are a lender, you need to look at the individual businesses that you're working with and think about their exposure to what's happening in the broader world, what's happening in terms of the big moves. So at Oak North, we don't have an automotive book in the traditional sense, but we certainly have borrowers who are fundamentally impacted by it. So for example, one of our borrowers is a market leader in constructing belt tension manufacture and measurement equipment and handbrake setting. We as a lender have to think about the implications for them as a business with the shift to EVs. We have to think about the implications for their creditworthiness. And it's not all about risk. So another of our borrowers is in the forecourts business. So they've borrowed from us to switch out a number of the petrol pumps on their forecourts for EV charging pods as an alternative. And that might be the case for some of our hotel customers who are needing to install EV charge points in their car parks. It might be the case for our residential property developers who are also facing the same challenges. So there's an endless list here of knock-on consequences, of knock-on implications for other businesses in the wider value chain. So if we think about how we can get to grips with a loan book and the implications of climate risk within that, this is something that at Oaknorth we've been grappling with for the last couple of years. We've been working with climate scientists, we've been working with academics, we've been working with credit technologists to think about the framework that we can put together that will help navigate this highly complicated set of scenarios. So we do pull in the sort of borrower metrics that you would expect to see. So financials, revenues, debt leverage, the sort of things that are traditional data points for a lender, for a financial services firm. But what we also do is create, and what we've created so far, is 273 different subsector level models. And we layer on top of that climate scenarios taken from the Network for Greening the Financial System, which is one of the kind of leading climate modeling bodies. And we layer that across to come up with what might be the transitional pathways for each of those businesses. How might they each, at a subsector granular level, be impacted by transitional change from climate? And you combine all of that, and it gives you a risk rating from the highest down to the lowest. But what it also presents you with is a view of where the opportunities are, a view across your portfolio of where the market leaders might be, of where those who are already leading the change might be found. So if we look underlying at the sort of scenarios that we utilize for that under NGFS, now anybody in the room who has worked on climate scenario analysis will undoubtedly be familiar with the sort of format these follow, whether that be your involvement in, say, the Bank of England exploratory scenarios, whether that be ECB climate stress tests. Generally speaking, they fall into three buckets. The first one of those being an orderly transition. And in an orderly transition, we make deep emission cuts now. We get our act together, we start making those changes that means that we meet our 2050 net zero goals. It means that we are able to meet those ambitions of keeping global temperature rises to either 1.5 or 2 degrees in these sort of scenarios, capped at those levels above pre-industrial levels. Or there's the second bucket, where that might be a disorderly transition, which means we still meet our 2050 net zero goals, but it takes us a little bit longer to get our act together. It means that those cuts come later on. It means that it has a protracted change in industry, and it's a disorderly transition. But we get there. We get to 2050 net zero, and those necessary changes are made. And the third instance here is the aptly named hothouse world scenario, where this is a position where none of us want to be. It's where we decide, you know what, this is too hard. We cannot coordinate to make this happen, and we don't make any further commitments that those already exist. Which means that we allow temperature rise unabated to 3-4 degrees above pre-industrial levels. And you don't need me to tell you the negative implications of landing in that particular scenario. Now, on top of that, we pick up PCAF methodologies for assessing carbon emissions, which is another data point that is incredibly difficult to source for small businesses and for growing businesses. But that is another data point that is very climate specific that feeds into a broader ecosystem of data points. So if we have a think and look back at, say, that example around the automotive sector, if we think about an OEM, an original equipment manufacturer, like that borrower at Oaknorth, for example, who's directly exposed to the sector, we'll be looking for a granular subsector analysis of where that business is likely to be impacted. So that granular picture means that we need to source data to understand how that supply chain might evolve. And that could be a case of looking at possible levers like changing fossil fuel prices. It might be the material costs in terms of fundamental component parts. It might be a carbon tax, things that change the supply and demand dynamic of internal combustion engines versus electric vehicles. And we pull in all of those levers around what's happening with the supply chain, what's happening with policy action. And we take that to a really low subsector level. We look at sector NACE codes, sector SIC codes of that supply chain. And we look at, actually, for suppliers of that particular manufacturer, what's happening with raw material costs. What's happening in that industry in terms of the climate expectations that are being imposed on those businesses. It's very easy to look as a financial services provider on the expectations to hit climate targets for a bank. But those borrowers also, their own sectors have their own obligations, policy change, regulation that's coming in to shift things in the right direction for climate. So how might that play out? And a prime example here, if anybody has attempted to buy a new car recently, you've probably found that you've been told that there's a year's waiting list for a new car, and that's because of a lack of microchips. That's partly a COVID thing, where chips that were produced were, during lockdowns, diverted to other uses. And I believe there was a large fire in the one factory that makes microchips for new cars in Asia. You talk about single supplier dependency, which has had a massive knock-on impact on the entire industry. Now, that is the sort of level of detail, looking at the supply chain of your borrowers, that you need to be thinking about from a climate perspective when we're doing this sort of modelling, to really get to grips with, on an individual borrower basis, the sort of implications for them. So we try and suck in as much of that data as possible, and we layer that together, and then we're able to look at a portfolio level at where our most vulnerable credits might lie. Where are our greatest degree of exposures? What sort of borrowers are going to be exposed more greatly by their own supply chain, their own kind of policy levers in the sectors they operate in, to be able to react to climate change? And that's not just a risk thing. That means that we can spot opportunities too. We can see those businesses that have already made the necessary changes, those that are actually more insulated from the shift to, in this particular example, electric vehicles. But that applies to any sector in terms of the likely events that might happen in the transition to a greener economy. And this, by the way, is not an exercise here to identify where to turn off the taps or to work out which businesses to stop lending to. You know, we are a lender to SMEs, to growth businesses. There is an S in ESG as well as an E. We need to think about that side of things. So it isn't about switching that off. What it is about is identifying those borrowers who may need assistance in the transition. Those that actually need some help in order to make changes, and what input we can have as a financial services provider to say, here is how your creditworthiness may be impacted as a borrower looking for finance based upon climate change. So, you know, I am not remotely suggesting that we have identified all of the answers here. I think if anybody tells you that they found all the answers, I would strongly recommend you checking their credentials and how they've come up with that, because, you know, this is a difficult thing to do. It's something that we are at our early stages of development. Now, we might be early on in our journey, but there's just a few things that we've encountered along the way that could be helpful for other lenders who are thinking about this journey themselves and embarking on the journey of their own. So the first of those is data. Now, it's imperative to get your data organized. We aren't talking about traditional financial data here. We are talking non-financial data. It's unusual. It's hard to come by. And getting that data organized is imperative, not just for measuring risk, but also things like integrating and setting your climate risk appetites, working out what mitigators you may need in place. So it needs to be embedded throughout your whole risk framework. Scenarios, you know, we talk about data, things like carbon emissions, a lot of that data just simply isn't available yet. It's an evolving landscape. So incomplete data, you have to be prepared to evolve your scenarios and your modeling and keep them up to date on an ongoing basis. There's limited history. And it also means that you need to consider multiple possible scenario pathways, because this could go in multiple directions. So that broad range of scenarios in terms of assessing your risk management, and also, most of us now are starting to build in climate-related targets and pathways of our own. So how does that relate to what you're seeing across your loan book, your commercial lending ecosystem? Governance-wise, it's imperative that this has the right level of oversight. Somebody at board level should have the responsibility to look after this, to drive these programs forward, and to make the right sort of decisions around setting a framework to manage climate risk. It cannot be a side-of-the-desk exercise. This has to be front and center. And fundamentally, that's true about the teams that you've got within the business. So, it's really important to coach your front line here, to understand what we're trying to achieve with climate risk, to understand the sort of questions that we need to be asking of our borrowers. And that's, the right questions for the particular sectors and subsectors that those borrowers operate in. Because if you really want to be a trusted partner to the businesses that you're financing, then you need to be able to articulate all of this, have the right conversation with those borrowers, and fundamentally, work with them to understand how this is all impacting their creditworthiness and what they can do about it. So I'll stop there. Good luck for anybody on this journey right now. It's a really exciting time to be doing all of this. And I think the key is, in reality, if we get this right, it isn't just good for climate, it's good for the bottom line as well. So as a finance provider, this is a great opportunity to marry those together. So thank you.
Welcome back, ladies and gentlemen. We're ready to start, so if you'd like to bring in your coffees, those of you that are still getting your caffeine injections. I'm delighted now to welcome the panellists for our next session. Our panel discussion will be on keeping up with the pace of regulatory change. And I'm delighted to welcome, to chair that panel, Josephine Roy. Jo is a global COO for regulations management at Citi. So we're delighted to welcome her to the stage to be chairing this panel. Prior to Citi, Jo held leadership roles at Deloitte and Goldman Sachs. She's so passionate about addressing ESG that even in her spare time, she works with social enterprises, charities, and fintechs to help further the cause of sustainability. So, Jo, I'm delighted to hand over to you if you'd like to introduce yourself and your panelists. Please take it away. Thank you.
Thank you very much. Thanks for having me. I'm delighted to be here and to share the stage with a fantastic group of panelists who, between them, represent a software company, the industry, as well as the regulator. Before I introduce our panelists, I'd like to just provide an overview on the topic that we'll be discussing today. As you would have heard from the previous sessions, over the past 5 years at least, we've had an explosion of publications, either regulatory publications or non-regulatory publications around ESG. And we expect there to continue to be a trend whereby there will be more publications being put out there on the subject as the regulators globally finalized their guidance and regulations on ESG. So it's really important that we actually cover this topic today, which is really talking about keeping up with the pace of regulatory change. And I'd like to emphasize, as whilst we talk about this, our panelists here are going to be talking about the subject based on their collective wealth of experience and not specific to any one firm. So based on this, we would like to kick off the session by the first introduction. Sean, do you want to take it away?
Thanks, Jo. Can you hear me? Can you hear me? Yes. Hi, everyone. Great to see you all, and thanks very much for the invite to be here today. So my name's Sean de Montfort. I'm a technical specialist at the FCA, where I lead our work on net zero transition plans, some work on investor stewardship, and some of our wider work on how we integrate and embed ESG across the FCA's core functions, both in terms of operations, but also our supervisory and authorizations and enforcement functions. Previously, I was a senior policy advisor to Mark Carney, leading the private finance reporting pillar under the COP26 private finance campaign.
Thank you. Kushal, do you want to?
Thanks, Jo, and once again, it's a pleasure to be here, and thanks for having me. My name is Kushal Thakur. I work at JP Morgan. I lead a team which oversees regulatory strategy and execution for the risk function. Of course, the link to this topic here today for us is that ESG and climate is a very big part of the regulatory change agenda at this point, and it is something that is affecting all the functions within banks and institutions, and the risk function is impacted quite strongly. So this is one of the streams that I have been working on. Prior to JP Morgan, I worked at Santander for a couple of years, and before that I was at the Bank of England, mainly working on capital policy. So that's it.
Thank you. And then over to you, Greg.
Hello. Yep, that works. Hi, yes, Greg Davis. I've spent, 20 years specializing in applied behavioral finance. And, I now head of behavioral finance at Oxford Risk. We build tools to help people meet the regulatory change. And for years, I've been doing this for suitability purposes. And in the last 5 years, have been moving into providing tools for ESG. And I have to say, the last 2 years has been quite a race for us to keep up with the pace of regulatory change, because we're providing these tools to our clients who need the regulatory change to be fully reflected, and it's changing very fast.
Yeah, no, that's a very good point. And that brings us to our very first question. The key question that we have is really, how can financial institutions, given what Greg has just mentioned around the pace of regulatory change, keep up with the development, and how should regulators work with the financial institutions? You're well placed to answer that, Sean.
I hope so. Thanks, Joe. So, I mean, yeah, make no mistake, ESG is high on the agenda for the FCA, for UK regulators, and for many of our international counterparts as well. You know, we recognise that the financial services sector, market participants, need high-quality information, standards, and a well-functioning wider sort of supporting ecosystem if they're going to play their role in supporting a market-led transition to a more sustainable future. We also see that consumers have increased appetite for ESG products and interest in ESG products, and see a real risk of harm, you know, around that in terms of greenwashing. So there's both a kind of, you know, opportunity and harm sort of lens to our interest here. So if I split your question in two, Joe, and start maybe with what can we as regulators do to support the market, and then come on to a few kind of higher level thoughts on what industry can do. I think there are 5 things really to cover on the first piece. So one, I think regulators should set kind of clear sort of multi-year ESG strategies. So here at the FCA, we published last November our ESG strategy at COP26 that set out a pretty comprehensive program of work with milestones, clear outcomes, and actions for the next couple of years in terms of our work program. And we then built on that earlier this year when we published our business plan, which contains some initial thoughts on metrics on how we're going to measure our progress against those priorities. And we'll also be kind of publishing a scorecard at the end of this year or the early next year, sort of looking at how we've done against that program of work. So I think it's about setting really clear expectations to the market of where we're focusing our interests and work. Secondly, I think we at the FCA are very supportive of global solutions in this space. We've led a number of international work streams through the FSB, through IOSCO, where we co-chair the work on corporate reporting and assurance under the Sustainable Finance Task Force. We're in the process of reviewing the IFRS ISSB's draft standards for potential IOSCO endorsement. The government and ourselves have already outlined our intention to ultimately adopt those standards in due course, and they'll form the backbone of the government's sustainability disclosure requirements. Also, I think, you know, this isn't just about corporate reporting on global solutions. We've got to think about kind of fund level reporting expectations. We'll be coming out with our own proposals in that space in the next month or so. Even more nascent areas like voluntary carbon markets, obviously ESG ratings. There's an interest across all of these issues for global harmonization, and we'll be very vocally making the case for that. And obviously, we hope that will, you know, reduce business burden, reduce regulatory arbitrage, and provide better quality information to users and providers of capital. I think the third point is around promoting market-led solutions. So, you know, we've seen huge ambition, proactive behavior from market participants, particularly on climate, but also across ESG more widely with the success of the TCFD. We've got the Transition Plan Task Force here in the UK, which is kind of public-private partnership. And we've got obviously a litany of voluntary initiatives out there as well. And I think we've very carefully and intentionally sought to not tweak and adapt those frameworks where we think they could be usefully integrated into our rules. So with the TCFD, you know, we essentially wholesale adopted that framework for listed companies, asset managers, and asset owners that we regulate. We also want to strike the right balance between principle and prescription and promote innovation and not inadvertently sort of hinder that. I think the fourth point I'd raise is on looking beyond rulemaking. So there can be a tendency for regulators to jump to the rule book, but thinking about how we can more creatively use our tools. So, you know, last year we sent out our AFM chair letter to fund managers, setting out some guiding principles for ESG funds. Again, we've got a range of innovation services that we've been building out in the ESG space, and thinking about how we can use our convening powers more widely to encourage kind of voluntary action and not necessarily needing to change our rules, as I say. And then I think the last point I'd make is just around kind of coordination with government, coordination internally within the FCA. I mentioned I'm leading some work on embedding ESG across the organisation so that when firms are you know, engaging with a colleague in authorizations or in supervision, they're getting a kind of, you know, single voice from the organisation as well. And then also thinking about kind of how we can work with industry through the Climate Financial Risk Forum, which we established 3 years ago, with the PRA, with the Transition Plan Task Force, where we've got a number of industry participants. So really working collaboratively and openly and transparently with industry as we kind of collectively come to the right solutions in this space.
And in terms of from a firm's perspective or the industry, so what would be your point around how they can actually incorporate and work with the regulators?
Yeah, so maybe three very quick thoughts on that. So, and none of this is rocket science, so apologies for that. So one, I think, there's obviously a litany of consultations out there, both in terms of regulatory consultations, standard setters out with consultations, but also voluntary initiatives like GFANZ will be imminently putting out a consultation on some guidance, which either through regulation or just through wider changing of the market will have a huge impact. So I think being a kind of active voice and engaging with all of those and kind of engaging with your peers on that is a really important step, because one way or another this will change how the sector looks in the years to come. Two, I think, and it's related, is sort of engaging with all of these initiatives and associated guidance in the context of the point I made around market-led solutions. I mean, at the FCA, we'd rather see the market come together to a sort of collective solution than ourselves sort of have to do that behind the scenes and inevitably not necessarily land on the right answer. And I think thirdly, just open collaboration with regulators. We're on a journey as much as industry is. We're not going to get everything right, and we'd rather hear early from industry where there are problems or challenges in relation to our emerging thinking and to have that kind of fluid and sort of transparent discussion.
Thank you. And maybe, Greg, from your perspective, having worked with so many organizations, what would you add to that?
I think the first thing to say is that if, as I suspect everyone in this room does, you genuinely care about ESG because you want it to do good in the world, then we have to welcome the regulation. We've had profiling tools for clients' ESG preferences for 5 years now, and it's safe to say that for 3 of those years, almost none of our clients who of standard suitability systems were in the slightest bit interested until SFDR started making them wake up. So I think regulation here is absolutely essential if the industry is going to move forward. The danger that comes with that is everyone starts moving forward extremely rapidly. And I completely take Sean's point about the importance of principles versus prescription. We've already had the situation that with the coming MiFID II requirements, 2nd of August, I believe, that the Dutch regulators, for example, have published their own consultation to say that they think that a lot of what MiFID II is asking of investor preferences is unintelligible, something with which we'd largely agree. If you are a firm trying to deal with this, the really important thing, I think, is to focus on the spirit of the regulation. What is this genuinely trying to do? Because if you can build a system that speaks to the spirit of the regulation rather than construct 700 boxes to tick that is just about meeting the letter of the regulation, that is going to provide you with the flexibility as the regulators continue to evolve and move and the industry keeps to evolve and move. So try not to bake into your processes something that is too granular, too detailed, and therefore becomes ossified and sclerotic and you can't move out of it later. Try and do the right thing from the outset and be flexible.
Thank you. Point very well made. I think in terms of that whole being flexible and doing the right thing, that brings us nicely to the next question around financial institutions. So to what extent can they continue to develop their strategy, given that the regulations are still being formulated, and how can they remain agile and responsive to change? So maybe, Kushal, you can start off with this question in the first instance.
Thanks, Joe. So at a very high level, I think my response would be that firms in general will be able to have robust ESG strategies and do have robust ESG strategies, which, while they remain agile and responsive to the changing environment. And I say this for 2 reasons. First thing is that a lot of the ESG strategies that is guiding firms or that is guiding the industry is based or is not something that is subject to changes or frequent change. It's because the ESG, like if you were to pick up climate or environment in particular, a lot of the strategies that firms have are based on high-level public commitments like the Paris alignment or net zero targets, etc. And those are, in essence, commitments that are not going to change regardless of what new regulation comes out, etc. So I think in terms of setting guardrails for institutions, for institutions to have fixed, robust strategies that guide their behavior and that define their ESG environment and business strategy, I think those, by definition, will not, those will be robust, are robust, and are not necessarily subject to frequent change. The second reason why I say this is that the second reason why I'm not too concerned about this is that firms and the industry in general has proved itself to be quite adept at adapting to change and responding to the changing environment. And we've seen that over the last few years, whether it is, multi-year change like adapting to Brexit, or whether it is change that has to be carried out over a short period of a few weeks or months like COVID-19, etc. So I think firms are quite adept. If there's a change in the environment from the top of the house down to the operational level, firms can adapt. So I think that on the high level question itself, I think ESG strategies, ESG direction of travel for firms, etc. I think that's I'm pretty sanguine about that. I think firms have set a path and they are going to stay the course on that. However, this whole area is not without challenge, and I think one area that I would in particular like to pull out is the development of the supporting controls environment to support some of the business activity that is happening on ESG. We've seen examples of that in the press in the last 2 weeks even. And in particular, I think what needs to happen is that we've got these high-level commitments that are made by the firm's boards and the CEOs, which are getting operationalized by the first line of defense or by the business side in terms of offering new products out to customers and adapting their sales and so on. But what is not happening at the same pace is probably the development of the controls environment to support the rollout of these new business products and so on. And I think that's where probably firms need to focus on this whole thing, in the sense that the controls environment needs to adapt and change and evolve slightly faster than it has done in the past, because the pace of change in this entire ESG space is quite rapid. This is not to say that the controls functions themselves are lacking. It's just that the pace, the historic pace at which they operate is slightly slower than what is required in this, what is required of them to respond to the ESG business needs at this point. So I'll stop there right now, Joe. And I think,
that's a very valid point. I think in terms of from a controls perspective, what additional type of controls would you expect seen in this space compared to the traditional or existing controls that are already in place for different types of regulation? Could you expand a bit more on that, and then maybe Greg, you can add.
Sure, Joe. I think my prior or ex-ante position on this would be that it's not that firms need to do a whole lot of new things. Mm-hmm. It's just that the things that they do as of now in a BAU environment and things that, the pace at which they roll out their new controls environment, etc., that needs to pick up a bit.
Okay.
So that needs to keep up with the pace at which new products or new conversations, etc., are happening with clients. So, so my emphasis would be on faster rollout, and probably that would happen with a greater and a closer integration between the lines of defense on ESG-related matters.
Thank you. Point well made. And then, Greg, do you want to add to that with regards to some of the strategy firm can start thinking about?
Yeah, I think one of the things perhaps to add is that every client that we talk to who's trying to meet the coming MiFID regulations, for example, has had a different interpretation of those regulations. And we are starting to see that, with dawn raids, that there are going to be regulatory sanctions for people tackling this superficially. There are also going to be reputational sanctions for people who tackle this too superficially. And I completely agree with you, Kushal, that the speed of how firms are responding and baking this into their systems needs to be appropriate. My worry is if everyone is interpreting it slightly differently, that's going to take quite a long time to settle.
Yeah.
Because firms are making choices of how to reflect the coming regulation. In the UK, we're all slightly waiting for Sean to see what's going to happen there. But you've got 20 firms who are doing 20 different things, and at some point that has to converge, and we don't know quite where it's going to be yet. So actually, in a way, these sort of conversations that are pan-industry, rather than embedded within the compliance department of a single organization, dotting their own I's and crossing their own T's is really important.
Sure. And I think the first panel, there was a mention around, I believe it was NatWest that talked about having their own taxonomy being created because they were waiting for regulators to come up with something, especially in the UK. I guess the point that Greg has just made around people interpreting ESG differently, how is the regulator thinking about this as they come up with their final guidance and regulation on this?
Yeah, so I guess on the green taxonomy, so that's obviously a piece of government policy rather than regulation, at least at this point. So as many of you will know, the government have established this Green Taxonomy Advisory Group who are providing advice to the government on the technical screening criteria for the various components of the taxonomy. And they're starting, as the EU did, with climate mitigation and climate adaptation, and there's still an intention to consult on those proposals this year. I don't have the latest kind of time frame on that. But for us, as the regulator, we're slightly kind of one step removed from that process, I suppose, at this stage. I guess the other point to raise is certainly on kind of ESG funds and products. We'll be, as I mentioned earlier, we'll be putting out a consultation next month with a proposed classification regime and set of labels for ESG funds. So that's certainly related, and attached to that, there will also be a suite of entity and product level proposed disclosures to bolster existing kind of TCFD rules we've already put out. So those are both designed to support consumers, but also institutional investors. So there's kind of two twin objective there.
Sure, thanks. And maybe bringing this back again to the first session that was held, the first panel session, one of the key things that was mentioned there is firms are already doing some work to try and be ahead of the game and creating their own internal frameworks or processes. And I guess with any of this is a strategic initiative as well as a regulatory imperative. So it's really thinking about internally what process you have in place, what strategy or framework you put in place, but taking Greg's point as well, not being too rigid with what you build, so that when the regulations are finalized, you can actually embed them into your existing design framework. And that brings us nicely into thinking about your processes, but then we have this a room full of fintechs. It's thinking about the technology aspect. So from a technology aspect, to what extent is technology being leveraged to help firms stay ahead of the curve? Have we seen good examples of where technology is being used or being developed? And Greg, you'd be best placed given your work in this space.
I am, although I'd caveat, our work is much more with distributors of funds, so the wealth managers, the financial advisors, the retail banks, than it is with the technology that's around making sure that the investment funds meet the taxonomy there. There, I'd say, we get to the point where technology, and of course you'd expect me to say this because I'm representing a fintech firm, but the technology is absolutely essential for many reasons, but if for none other, that it enables you to establish a solid audit trail of what you've asked of your investors and why you've given them the solutions you've given them as a result. This is just really, really difficult to do at any scale dynamically for a wealth manager who's all paper-based and, let me talk to the client and make a series of notes, etc. Using technology to say it's the responsibility of the technology to stay in touch with what the regulatory change is, so that the technology you are using, you're always comfortable, there's someone there scanning what it's happening, at the point you use it, you know it reflects whatever the current regulatory situation is, but it provides you with that essential audit trail, because that's the stuff that's going to get you off the hook if something goes wrong.
Mm-hmm. And then, Kushal, from your perspective, where have you seen technology, or how do you think technology can be leveraged in this space?
Thanks, Joe. So, like Greg, I completely agree. I think technology offers a solution to firms in this space. There's absolutely no doubt about it. However, my own experience and observation is that maybe the take-up rate so far, as Greg alluded earlier, is not as high as it could be. I think there's a couple of reasons for this. One is that when you look at ESG or climate and you think about how these are being embedded within the firm's risk or compliance organizations, I think that embedding is still happening. It's not something that is a done deal. So firms are still figuring out what the BAU environment will look like and where exactly they will need technology solutions to help them. So I think there's one is there is definitely that bit to it. I think the second aspect why some of the technology take-up so far has probably not been as high as it should be is that the solutions and the products themselves have not reached that mature stage where as a client you feel confident about deploying that in your production environment. And I think some of this is because there's a bit of a chicken and egg situation. I think a lot of firms which would use technology solutions have not come to those no regret decision points where they decide they're going to invest multi-million pound investments and implementation projects to bring on a technology solution. I don't think they've reached those points yet in some cases. And when they do, you will find that products will, products will mature, will get refined, and then I would expect the take-up rate to pick up. I think from a sell-side point of view, I think technology would be very useful in a couple of places. I think, firstly, just data availability. When I think about how, as a firm, JP Morgan or any other bank which has had to do climate risk stress testing, for example, we need lots of data to do stuff like that. The industry needs a whole lot of data, for example, borrowers' transition plans, etc. All of this data needs to be there in one place. I'm sure there are vendors here and people are aware of some pretty large firms who are working on things just like that. So I think those are the kind of solutions that will definitely be very useful for firms across the industry. And the second place where I think technology could play a role is, I think, to help out some of the smaller firms that don't necessarily have in-house capacity to build out risk models, etc., in this space. So I think technology definitely has a role to play. Take-up rate has probably been a bit low, but I would expect that to pick up in the near future.
Sure. So the latter point that you mentioned around for the smaller firms, are we thinking about or looking to perhaps seeing a kind of shared service center where data is provided for like the smaller firms to tap into? Is that something that we think might be a trend in the industry?
Definitely, Joe. I think there are a lot of vendors out there who are offering solutions of that very nature right now. So data is definitely one aspect where technology will play a big role. And I think on the second bit around modeling and, we don't know which way the regulators are going to go on, say, capital for climate or ESG in the future. But if there is a move in that direction, you will need slightly more sophisticated modeling abilities across the spectrum of firms, not just the biggest firms, but even some of the smaller ones. And in order to get there, I think there will be vendors who will probably step up to provide those solutions for the smaller firms, because it would be, I would be very surprised if they would have the in-house capacity to build out to do the technical, analytical, and the IT build out for something like that.
I can see you nodding, Greg. Do you want to add anything to that?
Yeah, I mean, the other thing I'd add is that technology also, if it's good technology, it frees up an awful lot of human time to focus on what the humans are good at. So there is also an efficiency reason for doing this. There's a personalization reason for doing this. I mean, if you can use algorithms to screen through the product shelf and find which ones are appropriate for a given client, etc., you're just freeing up an awful lot of time and mental capacity of the advisors or of the people delivering this, so that they can focus at what humans are good at, because humans are simply not good at mentally keeping track of thousands of moving parts and figuring out what works and what doesn't.
Sure.
Get the technology to do that, absolutely.
Thank you. And that brings us to our final question before we open the floor for questions. It's, I think everyone in this room, or most people, are thinking about disclosures. So the question really is really, what will be the impact of mandatory disclosure requirements? And Sean, I'm looking at you there to help address this question.
Thanks, Joe. Yeah, I mean, clearly transparency is foundational, both for us in terms of our wider regulatory activity. It really builds off having a high quality information flow across the value chain, but also obviously for financial market participants and other users to kind of apply that information to inform their decision-making, business strategy, and so on. And we've also found that actually kind of implementation of disclosure frameworks is a mechanism by which reporters kind of use that as a way to kind of think about business transformation itself, and not just the kind of disclosure aspect, but it's a bit of a prompt to do that. And I think the real value add of something like the TCFD has been that, as well as the kind of the fact that it's a disclosure framework in of itself. I mean, I think on the voluntary side, we've seen a lot of positive steps, obviously, through TCFD, but we're still not seeing the needs of investors and providers of capital being met. Regulations certainly needed, and obviously we've already taken action in that space. We've implemented, in December 2020, we put out our Comply or Explain rules for listed companies against the TCFD framework, and we kind of broadened that out last December 2021, to apply that to all listed companies, as well as FCA-regulated asset managers and asset owners on a mandatory basis. And importantly, that also referenced the kind of updated TCFD guidance, which covered issues like transition plans. So we've already got an expectation out there in that space. Obviously, better and mandatory disclosure will kind of strengthen market pricing, improve market pricing, support better business decision-making, risk and capital allocation. Let me just sort of flag a few things we're doing in this space. So I mentioned the TCFD work already. I also mentioned earlier the work through IOSCO, which, as I say, we see in the UK, the ISSB's corporate reporting standards as providing the backbone to kind of corporate reporting expectations in the sustainability space in the UK, and we've been very kind of forthright in setting out that expectation, both ourselves and in government. The third point I mentioned is around the kind of supporter, the sort of wider ecosystems, verification, assurance, service providers, ESG ratings and data. We'll be putting out a feedback statement in the next couple of weeks, outlining our view on ESG data and ratings providers in terms of kind of the role for a regulator in that space, and some initial response to the consultation we put out last year. But we think it's really critical that enabling ecosystem is in the right place. I guess the fourth point I'd mention is around our kind of work on asset manager fund level rules. I think we received 130 comment letters in response to our discussion paper we put out previously, we're now looking to strengthen the guiding principles we've already set out in that space, and through the consultation we'll be putting out in July. And then on transition planning, which is the sort of main area I work on, as I say, we've already, through the TCFD rules, set out expectations in that space, but we've already confirmed our intention to build and strengthen on those expectations through working and helping to shape the government's transition plan task force, which was established by the Chancellor and announced at COP26 last November, and is really designed to create a kind of gold standard for transition plans for the private sector, both financial firms and the real economy. So we're co-leading the work stream on user and preparer guidance around that, which will also incorporate a sort of testing, a road testing of the outputs and products there. So we'll be looking to engage the market closely on that when the draft framework is pulled together. So yeah, we'll eventually be drawing on that to strengthen our rules in due course. And the last thing I'd mention is at the FCA, we're very keen to walk the walk in this space. We're conscious we're adding a lot of expectations on firms, so we'll be putting out our own TCFD report next month, and we'll also be putting out our own transition plan next year. And it'll be apparent from that there's more work for us to do as there is for firms. So just to recognise that we're all kind of on a journey here.
Yeah, thank you. And that's a good point in terms of, I think that was raised in one of a prior session I had Sean Kushel on this last point.
Yeah, I was just going to make one point on disclosure from a behavioral angle. I absolutely agree that from the perspective of the asset managers and the institutional side of the ecosystem and the investments, that disclosures are extremely important because it helps to prevent the greenwashing that we're all scared of. Yeah. From a consumer perspective, disclosure does very little to change behavior. You know, all advisory firms have said, you know, you must disclose all of this stuff, and they all create 3 pages of footnotes at the back of the PowerPoint presentation in font size 2.5. And, you know, there is this myth that investors don't make good decisions because they don't have enough information. Providing information does very little to change actual decision-making of consumers. And that requires going well beyond disclosures into actual engaged choice and communication that is designed to actually convey the information and bring people in, rather than just make sure the information is there.
That's a very good point. And I guess going back to the point that we're discussing around information, so not only are we going to be expecting large volumes of regulations and standards out there, but also these disclosures and publications is again adding to more data out there for people to consume. So I guess your point is a really valid one in terms of how do people consume that information and make sure that they digest it to then change behaviors.
It can actually be worse, actually. There's an interesting study where they looked at the effect of disclosures on those disclosing. And advisors, once they feel I've done my duty of disclosing, therefore feel I'm now free to be as rapacious as I want thereafter. So the act of disclosure can make people feel freer to be less consumer-led in what they do that follows.
Interesting. Kushal, any final comments?
They're all very interesting thoughts. I think my view would be disclosure is an important pillar of how the industry responds to the challenge in the ESG and climate space. I would just sound a note of realism and caution here to some extent, and that would be that change and impact of disclosures is going to take time to come through. It's not going to be immediate. I think firms are going to iterate and feel their way to disclosures that feel appropriate and adequate and sufficient for themselves and their investors and the larger public and the public in general. So I think this is a process, it's not something that is going to be a silver bullet that will solve everything overnight. I think it'll take time, and there has to be patience from everybody on what the impact of disclosures will be and how their quality and information content improves over time, etc. So I would just, that would be my key point. It's just that it's going to take time, and we all need to be patient on seeing their impact.
Thank you. Well said. So we have, go on. Yeah.
Just a quick point on the, I totally agree with both of those points raised, actually. I think on the consumer labeling side or consumer disclosure side, we've deliberately delineated in the rules that we'll be putting out those disclosures designed to support institutional investors and those designed to support consumers. And indeed, we've done a lot of consumer testing around that, behavioral testing, to try and sort of refine some of our thinking there. But it's definitely, it'll be interesting to see what the reception is to that. And then, what else can I raise? Oh, on Kushal's point. Yeah, I mean, I think disclosure isn't everything, but I mean, we'll be doing a lot more work actually in the space of kind of governance and remuneration over the next sort of 12 to 18 months. But I guess we see the disclosure piece almost as the foundational to then sort of explore that more with firms. So I agree with that.
Sure, thank you. So we had some questions submitted, and maybe following on what you just mentioned, Sean, there's a question for you with regards to what the FCA is doing to make licensing easier and quicker for international fintechs and banks focusing on ESG and bringing funds for green projects wanting to enter the UK.
Yeah, that's a great question. I should say I don't kind of work day to day in that area, but we've got a number of innovation services available that I'm sure everyone here is broadly familiar with, but we also have some that are bespoke to ESG. So we had a Green FinTech Challenge that we launched relaunched back end of last year. We've also got a digital sandbox that we're running jointly with the City of London Corporation that's focused on ESG data and disclosure, and we ran a sustainability tech sprint back in last October, again focused on use of ESG data and disclosure, and particularly for us as regulators, how we can apply kind of technology in-house to more effectively use that data for our own ends. I think all I'd say is kind of engage with our innovation services on that, and if you they should be the first point of call for that. If you've got any follow-up on that, then do let me know and I can point you in that direction. But we're very keen to support fintechs, particularly in this space, and that's the messaging kind of from the top down from the organisation.
Thank you. And then maybe another question, perhaps, Kushal, you can help with this, is if there were regulation you'd like to see out there that would support implementation of ESG, what would that be?
So, this is, I should caveat any answer by saying this is my personal view. This is not JP Morgan's view. So I'm going to start with that caveat, which straight away. I think, firstly, my reaction would be that there's no shortage of ESG and climate-related regulations out there. I think I would, at this point, distinguish between what's happening in the UK and what's happening in Europe. I think it's important to do that because my personal view is that the UK is, at this point, focused more on climate, and ESG is on the horizon, whereas in Europe, it's climate and ESG both live right now. So to answer that question, what would I like to see? I think from an industry perspective, where the UK is at this point, where there's focus on climate disclosures, whether it's the BASE ones or whether the FCA policy statements that came out at the end of last year, I think the pace in the UK is somewhat more hospitable and amenable to firms in general. I think in Europe, the pace is much faster, and firms are having to run a lot harder to implement all of those things. I think, so at this point, it's very difficult for me to say if there's anything more that could be done at the European level. I think at the UK level, the focus, like I said, is right now on climate, and I think my personal views, I think the pace is fine. I think as an industry, we are all looking forward to seeing what the Bank of England has to say on the capital outcomes, on the capital impact of its stress testing, and whatever they're going to put out in Q4 in that adaptation report is something that I would personally be looking forward to seeing. So I don't want to say I'm looking for some brand new thing, but in terms of what I'm looking forward to on the horizon, it is that report from the Bank of England on how they see climate risk being embedded into the capital framework, I guess, via Pillar 2. But that's the one thing that I think will be a good marker for not just the UK, I think globally, in terms of how all of this climate ESG stuff actually hits capital, actually hits the financial side of things, because a lot of what's happening overall is more around the like risk management frameworks, compliance requirements, etc. Right? The discussion has not yet in many places moved to what happens financially with all of this. I think what the Bank of England puts out in November will be a pretty good marker for what's going to happen globally, and I'm not 100% sure whether the Basel Committee is going to come out with a view before or after that. But I think that's the one thing as an industry I would say we should look at, because the Bank of England is a thought leader in this space, and what they say and do does influence not just I would think, not just European policy making, but global policy making. So I think that would be the one thing I would be looking out for. So let's see what they have to say.
Thank you. That's a very good question, response to that. And we do have a couple more questions, but unfortunately, we've run out of time. I think we've covered quite a number of subjects here. And I'd like to thank all the panelists for an amazing contribution in this discussion, and the audience as well for all of your questions and for patiently listening to us. Thank you.
Joe, thank you for chairing that panel discussion. It was very informative. Thank you, Sean, Kushal, and Greg for stepping in last minute to join us there, for sharing your views. Yes, it could have gone on for a lot longer, but sorry, we're short of time. But hopefully people can connect with you in the networking panels to further those discussions. So thank you. We're on to the next panel. Having talked about the pace of regulatory change, we're talking about the challenge of regulatory reporting. In particular, what are the best practices whilst waiting for global standardization, an issue that I know affects an awful lot of our clients. I'm delighted to welcome to stage the chair for this panel, Dr. Sabine Dietrich. Sabine, are you in the room yet? Yes, you are. Welcome. Okay. Sabine, please do take the stage with your panelists. Many of you will know Sabine. She is a well-known expert in the regulatory industry. Sabine was, most recently, she had global responsibility for regulatory intelligence at UBS Asset Management, has over 20 years experience in regulatory affairs, and was previously with the Magic Circle firm of Freshfields. Sabine's authored numerous publications and has a PhD in international securities law and an MBA from HEC Paris. So we'd like to welcome you back, Sabine. And over to you. Thank you.
Thanks. Should never forget the microphone. Thanks very much for this kind introduction of myself. So we are here today with the panelists to talk about regulatory reporting. And I don't know how you see this, but every time I hear reporting, I think it's something really boring, it's burdensome, and it just causes trouble, basically. And in combination with regulatory, and obviously I'm quite passionate about regulation, but not everyone else is, it's probably a dreadful combination. But what we want to show to you today is how central regulatory reporting really is for the success of sustainable finance and sustainability in general, also for other industry sectors. Really like what the challenges, however, still are in practice, and how best practices have evolved to actually address those challenges. So let me introduce my panelists today. So I start with Christine Brentani. Christine just recently joined the World Federation of Exchanges. She's responsible there as Senior Manager for Regulatory Affairs, amongst others on the sustainability side. So Christine really is our regulatory expert, if you want, on this panel. Christine previously has a long-standing career, starting from being part of a regulator, but then also of big asset managers. So she will also, bring this perspective to us from a buy-side perspective in this panel. And then if I move to Adam. Adam Webb is COO of the risk management function in ICBC Standard Bank. So in his function, obviously, he covers the operational side of risk management as well as the strategic side. So he has a wealth of information, really, and experience around what it means, really, to implement approaches, regulatory reporting approaches in a bank. So he brings us the banking perspective, really. He looks back on a long-standing career as well in other banks like Standard Bank Group and Dresdner Kleinwort. And then finally, Nav Roniar. So he has two hats on here on this panel. Nav has a long-standing career as a consultant, both in-house and in the Big Four. Is now a partner since several years in Tata Consulting Services. He's responsible there and leads the business and technology delivery for his clients, and obviously is engaged with C-suite executives on many of these topics we want to discuss today. Nav also has a background as part of the UK steering committee of the International Association of Professional Risk Managers. So he really represents that entire industry, I would say, here on this panel. So straight into our panel discussion. So Christine, I think in the space of regulatory reporting, there's so many acronyms. I mean, IFRS, SASB, TCFD, TNFD, and you could continue like endlessly basically on that. And then just recently in COP26, of course, ISSB joined basically this exclusive circle basically of acronyms. Can you enlighten us a little bit more about what that means, what the standard setting bodies are, what they do, and how it sort of plays together?
Yes, thanks. Thank you, and it's very nice to be here. Thank you. So I guess in answer to that, I wanted to discuss maybe the different types of regulatory reporting frameworks that are developing and that have been developing since COP26. And I mean, there is a panoply of development around the globe in this space. But to break them down into the different types of frameworks, one, there's a framework that looks at how ESG, sustainability risks, climate risks impact the firm and the firm's financial, firm or the product's own financial position. Then there are disclosure requirements about how the company or product impacts the external environment. That's sometimes known as double materiality, you know, where there's a requirement to report on the impact of the environment on the company, and then the impact that the company has on the environment. There are also disclosure requirements about how the company or entities, what their plans are to get to a net zero carbon emission by a specific date. And there are also label types of disclosures. So where certain criteria are set around ESG, and a product, or usually a product, is then assessed against that criteria, and the disclosure is made around that. So there have been many voluntary disclosure regimes out there. I think you've mentioned some of the those acronyms. So globally, we've started with the TCFD, which, as was mentioned earlier, came into being in 2017 and was updated in 2021. And the TCFD, which is a voluntary framework, centers on 4 pillars: governance, strategy, risk management, and metrics and targets. And it's really looking at how the firm measures around risks and opportunities under these 4 pillars. And what's happening is the ISSB, which is the International Sustainability Standards Board, part of the IFRS, you know, accounting framework, is utilizing the TCFD framework to come up with their own global reporting standards. And again, not all jurisdictions subscribe to IFRS, and different regions are now coming up with their own standards. So we're seeing the trend of voluntary standards now becoming mandatory. Again, these standards, many of them are still being consulted on. In the EU, you've got EFRAG, which is consulting on their own standards. We've mentioned the ISSB standards, that's under consultation. The FCA, as they mentioned, they've already mandated TCFD disclosures, but they will be consulting on some new labeling types of rules. The SEC in the US is also consulting on a variety of new requirements, again, accounting-like disclosures based on TCFD, but each of these jurisdictions is adding a slightly new dimension. You've got Hong Kong, Singapore, China, amongst others, also coming up with their own disclosure requirements. This does present a challenge to a global firm. Maybe my colleagues will mention that, but and this is what the industry is grappling now, how to navigate amongst all these different disclosures. And last thing I'll say is some of those voluntary frameworks, such as SASB, the Sustainability Accounting Standards Board that you mentioned, the International Integrated Reporting Council, IIRC, the GRI, Global Reporting Initiative. These were all frameworks that firms were looking at, and some were using and some were not. And many of these voluntary frameworks are now being coming under actually the umbrella of the ISSB.
Thank you, Christine. So now, I mean, from your experience, the voluntary standards, of course, how have they been picked up? Is that the same in every industry, in every region? Do you have some numbers, basically? Or?
So I think that's a good question, Savina, and I think Christine sets the alphabet soup as the main challenge, right? You know, so how are we setting the standards, as you are asking, and how does it look? It's a complete mess. I hope I'm keeping everyone's attention, because I know lunch is up in about half an hour. Why do we think that greenwashing, social washing is happening? Why do we think there's confusion in the industry? When I look at it from the perspective of my day job as a partner at Tata, we have automobiles, hotels, airlines. We have a consulting firm. We're into car manufacturing, Jaguar Land Rover, Tetley Tea. Now you think about the various different legal entities that we have to deal with and the various different sectors that we need to look at as well. We also need to deal with hard to abate sectors as well. But at the end of the day, what comes first? Is it profit or is it purpose? And for the C-suite, finding that balance is the biggest challenge. But if you have an alphabet soup of voluntary standards, hopefully, which will be taken care by the ISSB, and I'm looking forward to that, and I encourage all of you to contribute to the paper that will shortly be closing. Hopefully, that will bring all these different sectors together to help three different areas: sovereigns, corporates, and financials. And why do I say those three very distinct areas? When I look at it from the Tata Group perspective, we're headquartered out in India. Our net zero target in India is 2070. 2050 years for a lot of the advanced economies. But at the end of the day, we need to balance a profit before purpose, because we need to think about economic prosperity for middle and low income countries as well. So we can all go on about ESG frameworks and climate frameworks, which is all very good. But not having disparate standards is not going to help sovereigns, financials and corporates. That's why we're seeing these issues come out. That's why we're seeing different lines of businesses and different corporates, whether it's banking, pension funds, asset managers, trying to work out how does my sustainable finance strategy work. You've got the C-suite of corporates scratching their head saying, what does this mean for me? Why do I have to disclose? Why are there so many different standards? Now think about the amount of investment that these companies all need to basically put in. So we do need to take a step back and be pragmatic. We do need to think about what does it mean for corporates, financial sovereigns. We do need to think about what does it mean emerging markets versus developed markets as well. We also need to definitely go towards the ISSB standard. That is a must. And I do hope that I see ISSB as the I don't know if you all watched Lord of the Rings, but one ring to rule them all, so one framework to rule them all, hopefully. Back to yourself.
Thanks, Nav. So, Adam, I mean, as a lender, your bank, Nav mentioned the problems, that financials have. So, can you tell us a little bit how difficult it actually is, with bank clients basically, and having the different standards, and also, having very differences across the sectors and across the regions.
Sure, thanks, Sabine. Good afternoon, everyone. It's becoming much more important for us now that the corporates we lend to are producing these disclosures. So it's a fundamental part of our onboarding and credit process that we are looking at ESG criteria, or a bit more of a lens to the climate change side of things, but certainly ESG is not something we don't include. So, we're looking to see up front if they're producing some sort of disclosures. If they're not, then why not? If they do have disclosures, are they, what's their strategy? What's their transition plans? What's their governance around ESG? What's their exposure? And it differs firm by firm, country by country. Clearly this then plays into the credit rating or the appetite that we may have for the client. We are downgrading firms internally because of what we're seeing or because of what we're not seeing. So it's definitely becoming a lot more important. And this disparity that my colleagues on the panel have spoken to makes it even harder for us to assess that. But to Nav's point, we have to be realistic. There are different pace of the journey in jurisdictions or even sectors is staggering. We have to accept that. We have to be proportionate from our own perspective as to how we apply this to our analysis. So it is a bit of a black box at times. So really we have to understand that. There are different investor-led pressures or regulatory pressures in each jurisdiction, and that doesn't make our job any easier. So it means we have to make our own assumptions about what the impact is. We can proxy that the best we can, but we know it's not right. It's without the actual hard data or the hard the unified standards. It makes things very difficult. So our firm in particular, we are quite EM or frontier market focused, and they are just not under the same pressures as perhaps the Western world or particularly UK and Europe to produce this type of information or prepare for this type of transition. So we can only do the best we can with what's available. But one thing we are starting to see, even in those clients that are in those jurisdictions, they are starting to self-report. So they're not under those pressures, but particularly those clients in extractive industries, so oil and gas, mining, that sort of thing. They are, even if they're not under pressure by law, they are starting to produce ESG disclosures because they can clearly see where the sales are heading on this. So it's difficult. There's lots of challenges for us, and we can only work with what we can at this point.
So Nav, is it maybe correct to say, that actually financial services and corporates, they need to sort of work together. They need to have a good understanding of the framework for applicable to the other one, basically, in order for corporates to get the funding, etc., access to capital markets, and for financial services, to be able to offer the services. Is that fair to say?
Very fair to say, and our members at Premier as well, the C-suite we speak to, the CROs, CSOs, CFOs, the first question they're asking is, where's the data? How do I get the data? How can I put a framework together if I don't have the data? I'm thinking about structured and unstructured data, and I think, there's been some conversation going on this morning about that as well, and I think that's why we're all here today. So you can talk all day long about frameworks, but you need to have good data. And again, it feeds back to why are we seeing valuations that don't make sense? Why are we seeing intangible valuation? Because ESG, a lot of the line items, when you look at it, it's intangible. So if you look at the constituents of the S&P, about 80% of the S&P constituents are measured on an intangible basis. Don't quote me on that. I mean, that was, I think it was 1 year or 2 years ago. It might have changed. But what goes into, what financials need to measure from corporates? Intangibility, climate, D&I, health and safety, regulatory lobbying, penalties, GDPR, cybersecurity. Now, again, I go back to my point, one ring to rule them all, one framework to rule them all. It has to be the ISSB. And once we have the ISSB, and I'm looking into my Mystic Meg, I don't know if any of you are young enough to remember Mystic Meg, into my crystal ball, but hopefully that will be the answer. And also, the FRC are doing a lot of work on basically looking at how do I look at intangible versus tangible line items as well. So once we get that framework basically sorted out, I think it will make it much easier for financial and corporates to interact together. But I must caveat that sovereigns need to get on top of this as well, right? Sovereigns have an ESG criteria as well, by the way, right? At the end of the day, those line items that will go in as part of ISSB are going to be influenced by sovereign policy. You can't punish corporates and financials for sovereign policy that is lacking. And obviously, we know how sovereigns are run. It's all politics and vote banks at the end of the day. So we need to be pragmatic.
So, Christine, now I've mentioned data. And of course, it's not only the data that comes from reporting, but the data that is the basis of the reporting as well. What's the regulatory take on that quality of data?
Yes, really important. And what we're seeing is that different data providers and the different ESG credit rating agencies might use different resources, different methodologies, and largely they haven't been regulated in the same way as, say, the financial institutions that then need to, disclose based on that data. And so where are we in terms of the regulatory intervention then in this regard, as you've asked? So legislators are in the process of assessing what the landscape is. So in November 2021, IOSCO, which is the global regulatory standard setter, set out a paper saying that they thought the ESG ratings and data providers should have greater oversight. And they produced a set of recommendations for third-party data providers. So legislators now, such as at the EU Commission, or at the EU level, the EU Commission is or has been setting out a call for evidence, is gathering data to see what intervention they need to make. ESMA, again at the EU level, has been also setting out a survey of, how are industry participants using this data. The FCA, in the panel before mentioned, they will be coming out with a paper about how they are going to look at third-party data providers. So where we are at the moment is that it's likely there'll be some more regulation or oversight, whether it's direct regulation or whether there's, say, an industry code of practice for third-party data providers. It's not clear exactly the direction just yet, but
perspective. When did it start in your bank? That the attention really was mounting up basically on these topics, and what were the challenges?
Yeah, so we started in 2020, and the reason we did it is because we were forced to. So I'm sure a lot of you are familiar with the PRA's SS3 19 regulation, so we had to start looking at really just, it was on the climate change side more than anything. So, what we did in 2020 was quite basic, and I can say that because I actually wrote it. But, we were just focusing really on the work we were doing and the work streams we were trying to build out over the next few years. Last year, we started bringing more ESG concepts. It's still, nowhere near we'd want it to be, certainly. And again, this all goes back to what framework do you follow? We're pushed as a bank to follow TCFD, but that's only a small part of the picture from an ESG perspective. So we know there's a lot of work and challenges. I mean, look, there's several, but I'll just try and pick on some of the main ones. So proportionality is probably the key one for me. In what the PRA asks, they say, please do this on a proportionate basis, depending on your size, complexity, exposure to climate risk, that sort of thing. But, that's a judgment call, and that can differ between what the regulator thinks and what we think is proportionate. So that's one of the I would say the biggest challenge for us, trying to get that balance right. You know, we can't chuck loads of resources at this, loads of money at it to get it right. So that's probably the main one. Going back to data again, you know, the availability of data and how you then model that data into relevant scenarios that that are required again is a challenge. You know, it's just where does that data come from? Can we rely on it? You know, one of the things that I noted out the CBES response that the PRA gave was that they picked up on this a lot. So, you know, third-party data, using that, scrutinising it, and modelling as well. You know, so a lot of firms have clearly outsourced that modelling to a third party, and it would appear that what the PRA is looking for is that to be more in-house. So, you know, again, that's a challenge for smaller firms. You know, so you can only do your best there. So. And that's a key part of the strategic side of things of TCFD is to run that scenario analysis and build it into your strategy, and then, you know, over different time horizons. So that's probably the second one, and probably another one that's probably a lot of UK-based subsidiaries of overseas banks can agree is that, you know, we have a parent entity based in Beijing. And they are not under the same pressures whatsoever to do this type of reporting. So they do it at head office, but it's you know, it's not following any type of framework or anything like that. So there isn't anything we could leverage there. So we're really having to do this stuff on our own back. So lots of you know, I could go on and on, but there's some of the three I could think of. And I think really from a governance perspective, the main thing is just to be clear about that and transparent. In your disclosures, and at least acknowledge that you've still got work to do, but put down a pathway to get there, because I think that's what the regulators are looking for. It's not so much just moaning and saying we can't do this. You know, everyone is on a journey here. It's all at a different pace, but you still have to try and articulate how you're going to get there, and that is a challenge in its own right as well.
And I think just to add there as well to what Adam said, I think a good example of standardization is where we're talking around the TCFD and the scenarios being aligned and using the PCAF data as well. That is an excellent example, and that is what a lot of corporates and financials that I speak to are looking for. You know, more prescriptive, not too prescriptive, but more where do I get the data from, what framework can I use, what methodology can I use? Because there's three inherent things to this, three building blocks: data, analytics, and reporting. That forms your disclosure. Back to yourself.
So actually probably analytics is something that's very challenging too, no? Because I mean, we talked about the quality of data. Obviously, that's a starting point, but then you can do, what do you do with the data? You can do whatever you want still, no?
Of course. And going back in history as someone who used to work on the trading desk, I don't know if we all remember the credit crunch. We remember all that data for asset-backed securities, mortgage-backed securities, and sort of garbage in, garbage out that was going through the products. Are we going through a similar scenario now for ESG and climate? Does the data look sane? And we all know that regulatory arbitrage is part of any industry. It's the way you police the system, right? And that's a regulator's issue, right? But we have conduct standards as well. But thinking about data, you know, it can be manipulated, and we've got far, far more to do on data and analytics.
Yeah, I will come back to that analytics side in a couple of minutes. But Christine, you have been on the buy side, so we heard about you know, Adam's experience on the banking side. I feel the buy side really was even more exposed, really, like to you know, sustainable finance pressure, I would nearly say, because of institutional clients that they have, and you know, the attention of the regulators. So, having been in an asset management firm, how did you see the challenges, really, the pressure, and including from implementing standards like SFDR, etc.?
Yes, thank you. No, you mentioned the SFDR, Sustainable Finance Disclosure Regulation, and that really brought all of this to fore, because what started out as a disclosure regulation, sort of where asset managers or all financial firms had to categorize their products either as Article 6, integrating ESG, Article 8, promoting ESG, or Article 9, having ESG as the objective, this regulation became a de facto labeling regulation, so to speak. So all of a sudden, the distributors wanted to sell only Article 8 products, and the asset managers were conscious of greenwashing, also conscious of trying to understand what the legislation was asking for, so erring on the conservative side of putting most of their products maybe in Article 6 and few in Article 8. All of a sudden, the distributors maybe didn't want to scrutinize the products, just say it's easy, it's in Article 8, that's the label, let me just ask for that. So then the asset managers, many of them ran exercises to promote their products from Article 6 to Article 8 and maybe even Article 9. So yes, they're seeing increased demand for the greener, the darker green, so to speak, products.
And was there actually, like from the beginning, like a good understanding of what the regulation really requires? Or?
I think that's been another challenge because many of the words used in the legislation were not clearly defined by the regulator, and so that left it up to firms themselves to define, well, what really is meant by a sustainable investment. What actually does an Article 8 product comprise of? What can be an Article 8? And the range was quite wide. So I think that was a challenge. The legislators issued the Level 1 legislation without then publishing the Level 2, and sort of force the industry to to implement based on just the higher level standards without the technical detail and how the calculations were done, how these products were a bit more clearly defined. So that was a challenge. I mean, things are catching up now, and I think the Level 2, it hasn't been finally published in the official legislation, but it's out there for firms to utilize.
So, I mean, often when we talk about ESG, the elephant in the room is really greenwashing, probably. So there's hardly any months, at least, when there's not a new sort of incident that's investigated or in the media. Just mentioning, even just recently, Goldman Sachs Asset Management and SEC looking into this, or DWS, etc. So let's go back to the really regulatory side of data and analytics. We saw that regulators are considering to, regulate and supervise and ensure the quality of the data that's underlying the reporting. The analytical side still, so how do you interpret it and what do you do with that data? That's still something that's, where often a lot of discretion actually is there. I think now you mention it. So, I mean, Adam, how do you see here what is your experience and the challenges really like from the banking side?
Yeah, I mean, as you'd expect, we've mentioned it a lot, it's the different pace that different regulators or jurisdictions are going at that makes this harder. So as a bank that needs to produce disclosures and outline its exposure to, for instance, climate change, we need that hard data, and we need it from the corporates we lend to, or even the sovereigns we deal with, or even the other banks we deal with. And that just isn't there at scale in the format we would need it from. Now, of course, you can go to a third-party data provider. You could proxy that data. You can outsource your modelling, but these are all black boxes, as I've mentioned before. And for instance, with climate change in particular, there isn't a whole host of historic empirical data you can rely on that will help you going forward. So, it's the old adage of past performance will not necessarily give you an indication of the future, and that really applies when it comes to climate risk. So we as a bank are so reliant on that data from who we lend to. So in an ideal world, you know, everyone would produce that data. They produce it all in the same format. We don't live in a perfect world. We all know that. But even if we did, you know, for instance, scenarios. There are a host of different scenarios out there that a firm can look at. You know, NGFS, IPCC, IEA, something idiosyncratic. You know, that could differ from firms in the same sector. So if you're looking at oil and gas firms or whatever, you know, they could have similar data sets in terms of their emissions, that sort of stuff. But when it comes to the scenarios they're producing, they could follow something completely different. So again, how do you compare each one if they're adopting different practices? So until that standardization comes, the best we can do is work with what we've got. You know, we can't really do much more than that. So, you know, until there are agreed global standards that are implemented across borders, we can only work with the best that we can, and that is not great at the moment.
Christine, anything from the buy side? I mean, maybe from my own experience, right? In many asset management firms, obviously there was ESG, sustainable investing, before the regulations kind of stepped in. So there was always a sort of systematic of how to think about what to label as, you know, sustainable, etc. But does that need convergence as well, basically? And is the regulation giving enough framework, you know, for asset managers to come to similar conclusions with the same data and not to, you know, come to different conclusions?
That's tricky to say. I think, you know, with the SFDR, firms have to disclose, you know, at an entity level, how they integrate ESG in their decision-making processes, what their policies are. But, you know, this is proprietary information that the firms have, so how much they actually disclose, you know, might vary because there's a competitive angle here. But I think from my, you know, experience and attending different trade association working groups, I think the asset managers are doing the best that they can, you know, with the way the information is there. I mean, one challenge firms had earlier this year is the regulations said firms had to disclose their taxonomy alignment, you know, in their prospectuses, but that level 2 that I mentioned that actually described how do you calculate that taxonomy alignment didn't exist. So firms do we just say, well, we don't have that information, we can't do that? Some of the legislators are saying, no, you put a 0% there. But firms knew that's not actually accurate because they knew that some of their investments were taxonomy aligned. So is it misleading by putting a 0%? You know, you'd have to caveat that with a lot of language. So tricky situations, but I think as, you know, the legislation evolves, as more detail is published on the calculations, etc., as firms get used to all of this, as do investors, then we maybe things will converge.
Let me just come in there as well. I think, you know, what's very interesting on ESG and climate, sustainability, etc., is we're seeing drip feed of regulation after regulation, right? Is that really best practice? And going back to Christine's point, we first had this alignment ratio, and that was, first we had the GAR, the green asset ratio. Now we're hearing the BTAR, you know, the banking taxonomy alignment ratio. How many more ratios are going to be published? We've got the Basel methodologies paper on climate shortly to be published as well. So it's going to be a drip feed of regulation. Is that really best practice? Maybe yes, maybe no. What is your best approach? Is it something like that we're doing here in the UK, where we're bottom up and we're saying, let's look at the data and let's experiment with the data, CBES, for example, its limited scope? Or should it be top down and prescriptive, coming from the Europeans and EBA, ECB, in terms of this is how your transition risk scenario needs to look, this is how your climate risk scenario needs to look, right? You know, and we're going to penalize you with capital. Again, what is the best practice, right? You know, if you're going to penalize firms with capital, Isn't it better to put that capital into sustainable financing instead? Now, I can't be the arbitrager of that, right, but surely Boris Johnson is probably doing that with his crazy ideas on Brexit, right,
I think that's another topic.
We had to mention Brexit, yeah. We are in London, right?
Okay, good. So I have a couple of questions from the audience. One being, what impact does ESG reporting have on the global south? So I don't know. Maybe now that's something for you again, actually.
Sorry, just repeat that again.
What impact does ESG investing have on the global south?
On the global...
South? The south?
Oh, the global south, the global south, yeah. Sorry, I was thinking sales, yeah, sorry. Global south, yeah. So, look, this is where it goes back to my point, which I raised when I first started. It's emerging markets versus developed markets. Now, developed markets can preach as much as they like to emerging markets. So, politicians can say that, okay, you have to transition, but hold on a minute, emerging markets are like, hold on. It was developed markets who basically, via the history, built up their wealth. So why are we being penalized? So I think when we look at prime ministers of the global south, and let's take India, for example, Prime Minister Modi is being very clear that developed markets should be contributing to this, right? Because economic prosperity is very important. And you can't use ESG reporting as a penalizer. Personally, if I saw ESG reporting being penalized in terms of, say, spreads on a bond or spreads on a company in an emerging markets, I would think that's highly unfair. Yes, I get it. We all have to solve the climate challenge, the ESG challenge globally, but we have to, again, be pragmatic. It's very easy for Greta to come on board and say that, okay, everyone needs to reduce their water usage or not fly. But hold on a minute, we all have friends and family all over the world. We're globally interconnected. So global south is going to become eventually global north and south, right? But penalization by ESG reporting, personal opinion, no thank you.
Next question. What do you want to say?
Yeah, just very quickly, I think a lot of jurisdictions are coming up with disclosure requirements, and because they know that, in some of the developing countries, because they know that the developed countries need that information to be able to invest, in their jurisdictions. So I think they're going along with it.
They kind of have to, no? Another question is, how can firms efficiently manage the various requirements around the world? Adam, maybe that's an operational question.
I don't think I can answer that really, but
budgeting, etc.
Yeah, I think most firms operate internationally. So really, what we've tried to do is set up a global hub here in London that is effectively scanning the horizon for these types of things that are coming out, and it's the plethora of updates is just it is staggering, and there's so many different things that are out for consultation or in draft mode, and how do you keep track of these? And I think the main thing is just to have it hub centrally. Well, it doesn't necessarily have to be in your head office. Of course, our head office is in Beijing, so we're not opting to host it there. So it's keeping it to a core group that is looking at this every day, really, because there are different things coming all the time. So, and then even when you've got all that information down, you need to disseminate that to the right people and make sure you're filtering out what isn't relevant. So it's challenging, it really is, and it is resourceful. So you do need to make sure that appropriate resources are dedicated to it, and are, like I say, doing the appropriate filtering, because not everything is necessarily going to be relevant for your business. So depending on where you are and your size, that sort of thing.
Christine, are you and your association, your federation, are you lobbying for convergence?
Yes, we definitely are, because we're a global organization representing, So yes, that is a theme of what we mention in the consultation responses that we're working on, most definitely.
I'm so happy, Christine.
What's that? Yes.
I'm so happy.
Yeah.
So happy you're doing that.
And then Finally, another question here, the likelihood, any percentage that we get to a standardization, like 10%, 90%?
Look, I think that's really going to be driven by sovereign policy. That's going to be driven by regulatory lobbying as well. Now we're going to see a lot of regulatory lobbying in the US. US is land of the lawsuit, as we all know. We know the Republican standpoint on climate and ESG as well. We have what is the right balance? Is it going to be Anglo-Saxon style model, which basically allows maybe 50% standardization? Maybe Europe goes for 80% standardization. The US goes for 30%. It's going to be very interesting to see this, and we're on a journey at the moment. But the more global standardization we can get, look, the better it is. But no standardization, it's great. That's why we're all here in this room. It creates lots of work for us.
Good. So I think these were all questions from the audience. So maybe just the last round of your last comment, wish for the future, starting with Christine.
Yes, one thing that's evident is that capacity building will need to be prioritized. So that is the education at all levels about ESG and all the rules and reporting that goes around that. And that's, at the regulatory level, at the board level of firms, at the operational level as well. And so I think this is just something to be aware of. These are technical rules. There's a lot of jargon, and it's something everyone has to start learning about, really, at all levels.
Yeah, for those, those are in banks. I would say, keep close to what's going on, scan the horizon, listen to soundings from regulators. Just as you've mastered something, be prepared to have to change it. Make sure your board's fully on board, senior management buy-in. That's another, I should have actually mentioned that as a challenge, actually. And make sure this is seen as a top-down thing, because then it's a lot easier to implement if you can demonstrate that top-down decision-making.
Last comment from myself would be, you definitely have to have a sector-by-sector approach, and then you need to look at a legal entity by legal entity. You need to then slice and dice. Then you need to put these 5 pillars on top of it, which is sustainability, ESG, climate change, sustainable finance, carbon markets, voluntary and regulated. And how do you put all of that together to think about net zero? Very important to do that sector by sector, legal entity by legal entity, and country by country.
Thank you so much to my panelists for this interesting insights, and many thanks to the audience for listening to us and your patience while the lunch is, I think, prepared. Thank you very much.
Ladies and gentlemen, welcome back. I'm delighted to see so many of you already ready and geared up for this afternoon's sessions, which will be just as exciting and thoroughly worthwhile as this morning's. And I'm delighted that we'll be starting off this afternoon with a panel discussion on the importance and elusiveness of ESG data. And so it's my pleasure to welcome, as chair of this panel, Gerrit Sinderman. I hope I pronounced that correct. Gerrit is project director of the Green Digital Finance Alliance, has a lot of relevant experience across different areas, including within Accelerator F10, where he led the FinTech projects, as an author of the Green FinTech Action Plan for the Swiss Finance Ministry, I understand, and over 10 years of experience banking with ABN AMRO. So a great all-round perspective. Gerrit, it's my pleasure to hand over to you. Thank you.
Thanks a lot, Richard, and hi everyone. I hope after lunch you still have enough energy or it's not dropping too quickly. I think today much has been said already about the different dimensions of ESG, I mean from regulatory to strategy, so I think I don't need to do much of an introduction to why our topic matters, but I think especially like when we talk about how to internalize ESG perspectives into financial services, you can't go without data, and that's what we are looking at now. So to understand a bit, the constraints, the challenges, and also how to manage the increasing universe of ESG data, of which we are probably just at the beginning. And yeah, we have some great experts here that I will let themselves introduce what they are doing. Just a quick one before we enter the discussion. Then please also feel free to post questions. I understood that I'm receiving them online, so hope they are also coming in. So, and passing it over maybe just for simplicity reasons, just to Joachim.
All right. Good afternoon, everyone. I'm Joachim Neyhem. I'm the CEO of Position Green, and we offer advisory software training and assurance on ESG. And I'll talk a little bit more about that, how that is relevant to disclosures.
Adriana Pierelli, for the purpose of this discussion today, I'm responsible for ESG at our European bank, which is a CIF in its own right. I'm also globally on the ESG Client Solutions Working Group of BNY Mellon, and I'm on the ESG Integration Steering Committee. More importantly, I think, because it has an outside-in view, I'm responsible for a number of clients globally, large financial institutions, so I have the pleasure of seeing the ESG also from their lenses into our company.
Good afternoon, everyone. My name is Nirav, and I work at M&G as the head of ESG analytics. So my work predominantly kind of revolves around the intersection of technology and sustainability and how you integrate capabilities and data in your investment process to kind of make ESG-informed decisions.
Good afternoon, everyone. So I'm Juliette Gestin-Knapp, and I run ESG integration strategy for NatWest Markets. So a lot of intersections with what the rest of the panel has already talked about.
Thanks a lot. And then let's maybe start like with the topic of how to source and manage ESG data. I mean, Joachim, you're advising hundreds of clients around the globe. I mean, what is maybe from that bird perspective, what are the typical challenges that your clients are facing?
Yeah, I think it's at two levels. One is a practical and the other is conceptual. On the conceptual side, I think a lot of companies struggle a little bit to understand why they're collecting the data. What's the purpose? Because data and reporting is not really a goal in itself, and I think easily companies commit to net zero, or they commit to a standard, and then you sort of press play on sort of, okay, we need to collect data, and you run around trying to collect data, and then some ungrateful souls are tasked with this in the organization, and it lives kind of its own life. So I think there is often a challenge in terms of getting buy-in and understanding conceptually, why are we collecting this data, and for what purpose? Is it driving our strategy? Is it driving compliance? What is it doing? What's the value of it? So I think conceptually there is sometimes a challenge of getting everyone on board, understanding it, and it's actually seeing the value of this data. Then I think at the practical level, it is also about that it is, for anybody who's been involved, for example, in GRI reporting, right? There's so many disclosures, there's so many levels, and it sort of takes on its own life, and you end up with sort of Excel sheets here and there. We work with a lot of shipping companies, and we do their climate accounting. We literally have Excel sheets from here to the moon and back on their emissions. And that's also one of the reasons why I come from consulting. We decided to merge with a platform, with a software company, so that we could find a better way of managing this data. So I think that sort of from a practical level, it's also quite chaotic. You'll, as someone noted, you'll end up often with a nice glossy sustainability report, but what it's masking is that internally it's quite messy managing and getting all this data together. So I think both conceptually and practically, there's definitely room for improvement. And I think at the end of the day, what we need to do better is explain also the value of this data. What's the purpose? How is it actually going to help your company with its business, with its strategy, and also what are the compliance requirements? And I think just one sort of piece of advice that it sounds very simple, but what we've learned time and time again, independent of industry, independent of geography, is to focus on materiality. Is this actually material to your business? And stick to what is material. You'll get all kinds of requests from other stakeholders, but if you do a stakeholder analysis and a materiality analysis, that sets you on the right track for data collection.
Thanks a lot. And I think definitely resonates very well. It's, at the same time, where it's at the moment probably also for a lot of companies a compliance topic. I mean, the human factor is definitely a big one. And so maybe Juliette, I mean, you're actually implementing since 1.5 years ESG data strategy within NatWest. So how are you experiencing it actually, and what have you on a operational level actually for challenges?
So what's quite interesting when you sit in financial institutions is the amount of counterparties and securities that you have to cover and for whom you need to be retrieving some data. And as has been highlighted a lot at the beginning of this conference already, ESG data generally suffers from lack of disclosure, lack of consistency, and lack of transparency. So what this means as a financial institution is when you look at your whole universe of counterparty exposure or securities exposure, you're going to find yourself having a patchy set of data that's only covering a subset of what it is you're trying to measure. Attached to that and linked to the fact that ESG is a multifaceted and complex area, there's the perception that this data is somewhat subjective and that being self-reported, its quality can somehow be questioned. So ultimately, once you've collected a set of data that you deem relevant for your financial institution, you end up only covering a subset of what you're interested in measuring. From then on, what you have to do is find ways to cover these data gaps. And that brings an additional set of challenges, which is how satisfying are these ways. So if you look at a lot of the statistical ways of approaching it, which I'm sure is going to be discussed later on, how do you deal with the fact that ESG data is idiosyncratic? So how accurate are these proxies? And then on top of that, there's a difficulty in appropriately assessing what it means that you don't have that data necessarily available for that counterparty. Is it a lack of commitment? Is it just because it's linked to the size of their business? And what does that mean for your proxy analysis? So when you deal with these proxies and you're trying to cover a large area of counterparties, you've got to strike that right balance between what is academically satisfying in terms of quality of data and what's practically relevant for your business so that individuals are able to base their financial decisions based on it. I guess another issue that you have on top of just this data collection, and like Joachim highlighted it as well, is the in-depth knowledge and understanding of that data, because ultimately you need to have your stakeholders knowing why it is they're using this data, how, And what you don't want is for this choice to be just always deferred to the product specialists. You want this to be relevant to the business units in question. So I guess beyond data, the next challenge is analysis. And I'm sure that's going to be discussed later on.
Yeah, oh, thanks a lot. And I think that also perfectly bridges to Ariana. So, I mean, we just heard that actually the sourcing of very maybe self-reported data puts you in a difficult situation, especially when, I mean, your bank is a bank of the banks. So, I mean, you're just passing it on in a way. So how do you actually address or manage this so that it doesn't become a problem downstream or with the client?
Yeah, that's a very interesting question, and I completely subscribe to everything that has been said right now. Not an easy objective, also considering that we're saying ESG and we're just kind of putting everything together, but there is an E where there are some more data, and S and an G where we can discuss the quality of the data that exists and the nature of the data that exists. Plus, let's also add that it's not only a point in time, but we're thinking about the transition, so how companies that you are evaluating are moving on from where they are to a better place, hopefully and potentially. So there is multiple aspects to that. We at BNY Mellon have just kind of taken a position that is, because we're a bank of banks, we're a bank of asset managers, that we're just kind of looking at multiple sources of data that are relevant to our clients, not to us, but to our clients, and we're just kind of collecting 50 different sources of data from data vendors. Clients can decide which data vendors they normally use and want to continue to use, but what a platform that we've created does is allows to take in the data at the most granular level possible, and really allows to look at the differences of the quality of the data that exists. Now, this means that you can have much better data or less comfortable data, let's put it this way, less relevant data or reliable data. And there is a crowdsourcing element that allows to actually see how other people on the platform are looking at that data and how they're evaluating that data, if they're using it or not. So you can actually see both on a qualitative and quantitative basis whether that data makes sense or not, up to the point that the client can decide to send it back to the vendor and say, hey, this data is crap. Would you mind just kind of looking at it because we don't believe this is good enough just to be utilized. So we've taken this kind of element of analysis just by providing more granular information and just kind of allowing customers to decide what is relevant to them. But it's definitely a very fascinating subject in its own right on what is required just to kind of get there.
No, I find that also quite interesting and important because sometimes the client customer perspective is quite maybe either under-leveraged or underestimated. And
the different needs, right? So why are you using it? Is it for compliance reasons? Is it for strategy? Is it because you want to have impact investing or other reasons? So that will also change the way you're using certain type of data.
Very good. And so Nirav, I mean, facing all these challenges, do you see any ways or what are you doing actually to maybe improve data quality? Is there can you prepare? Do you have to prepare the data that you're sourcing a lot or?
A lot, I'd say. And I think all three panelists touched upon several aspects of what the chaos around ESG data is. If you see within an investment management house, you're generally sourcing data from several different providers, several feeds of data. You're generating several data points internally. And you're also kind of, there's a group of analysts within the organization that are creating research as well. So how do you bring all of this together into the right set of technology and such that every time you try and orchestrate that data, it's reproducible and gives you the same outcome? You don't want to be reporting different emissions for the same issuer every time you ask your platform for emissions for that issuer. And everyone touched upon that. How do you go from that world of spreadsheets to this world where you have data quality and management? So yes, over there, I think technology can play a key role, and it's still very evolving and developing compared to what we see in rest of the industry. So at M&G, we have a very robust data platform where what we essentially do is bring all of that data into the platform and then kind of put a layer of quality management on top of it through technology as well as through our kind of data quality teams. And I think the key to that is when you're dealing with ESG data, it's really important to understand at each metric level, how is that data point arrived at? Is it derived? Is it estimated? Or has it been kind of disclosed or reported by the issuer themselves? And depending on that, your approach would be different to understanding biases, or has there been any sort of anomalies in terms of greenwashing or human error or things like that. So definitely a very good space for technology to kind of help bring some of that capability into the organization.
And so, I mean, what you also said was, like, at the moment it's probably also a phase of, like, still just better understanding the challenges and maybe avoiding some, where going forward it will be probably more of, like, yeah, either finding alternatives, fixing it yourself if possible. And what Ariana mentioned before, like involving clients, do you do anything in that direction, or?
Yes, so when you start dealing with ESG data, you see a lot of gaps, be it for a certain new metric that you are interested in, or for a specific asset class, or for a certain sector. And depending on what sector or asset class you are dealing with, active stewardship or engagement with the customers also helps, rather than you creating an AI or a machine learning algorithm to estimate it. Sometimes it's just easier to issue a questionnaire and work with your investee companies to say, why don't you help us arrive at these data points? So yes, engagement also is definitely a key element.
I just think one point here, which is important to keep in mind, is that we're almost assuming that the data is uniform, or that it can be classified in ways that lends itself to the categories that we speak under E, S, and G. The problem is that they are inherently measuring different things. And what we've done in many cases is just aggregate a lot of bananas and apples, and that doesn't change that they're bananas and apples, it just makes it a fruit salad. So the problem is, when you're looking at this at a very aggregated level, especially from the investment side, is that it's not really measuring the same thing, and it's really hard for asset managers and large institutions. I've myself consulted a lot for the Norwegian Sovereign Wealth Fund, which is invested in more than 10,000 companies. They can't possibly read all the sustainability reports and disclosures of each of those 10,000 companies. They're dependent on somebody aggregating or doing something with that data. But the problem is that that data is measuring often different things, yet it's put together saying this measures climate, this measures human rights. So I think, yes, technology, yes, aggregation, yes, we want this, but fundamentally we also have a problem about what is the data actually measuring. So we need to also go back to the granular level and agree on sort of what are we going to measure, and this is where regulation and frameworks also need a job in terms of consolidating, because there are too many frameworks, it's too confusing, and it's too all over the place.
And just to that point, we talk a lot about standardization of reporting frameworks, but there also is a need for standardizing the way providers are providing that data, because not just the aggregation. If you see the methodologies and framework that each of the provider uses is also distinctly different. So you can't overlay one provider over the other easily and say, I've boosted my coverage by using two providers. That's wrong, because when you try and delve into their methodologies, they are distinctly different.
Okay, so I mean, we've heard now a little bit about the flawed or very premature data quality, maybe. But is there also like any data that is maybe missing, Adriana? Like, I mean, you're using a lot of sources. So I mean, like, what is especially still like maybe some white spots, and how could these be filled?
Yeah, and I think there is two aspects to this, right? Is the what and the how. On the what, I mean, we're still missing from the issuer's perspective the level of information that's required. And I'm thinking even about the big names, not only the SMEs, because everyone, particularly in the banking sector, there has been a lot of discussion about it's impossible to ask SMEs to provide that level of granularity of data. It's going to be very difficult. Sure. But there was a recent study that actually looked at 107 companies in the most, let's say, polluting sectors that exist, so oil and gas, automotive, you name it, construction and others, right? And they found that 70% of the companies that were studied actually didn't have the information in the financial statements about the risks to their business. And you're talking about companies that by definition have risks in their future scenarios. So, you know, the what is important, and there is a lot of regulation that's coming in, certainly, you know, in the next 2 years to actually improve on the level of information that's going to be provided by issuers. So I think there is a way forward. This is all a journey, what we're describing, but there is definitely something there. On the how, technology certainly helps, back to what you were mentioning before, and it's really using certainly machine learning and some natural kind of learning process to at least extract information from the information that exists on methodologies. So if you know that a data point was created out of thin air, you may decide that that is not good enough to make certain decisions. If you know that that data point is actually a concrete piece of information that was provided by an issuer in one of the various documents that they produce, it may be more reliable in the scheme of things. So again, it's not perfect, but there are elements that we're certainly utilizing in order to improve on the quality of the information that's out there, or at least advise that, hey, this data point may not be as robust as you would like it to be. Maybe you want to use something else. Yeah. So again, more to come, but I think that's kind of where we're looking at this.
Yeah. And there was actually also a question from the audience about why there's such a range of quality in the ESG data. I'm not sure. Is it just that regulation hasn't clearly defined what or how data should be reported, or?
So there is not clarity of regulation on the issuer side on what information they need to produce. Now, there is actually an indication that you should produce data that are relevant on your risk element as a big issuer, so that's already there. But the reality is it hasn't been necessarily provided in a more robust manner. That's actually what the regulation is going to do. Again, for large companies. For SMEs, that's not to be expected anytime soon. It's probably going to take longer to kind of get to that level. But just also to put things in perspective, when we're looking at data on one security, we're looking at 5,000 different data points, right? And we have 3 million, of these securities on the platform. And we're talking about large companies you can possibly invest into. So that's kind of also the size of the discussion that we're having. It's pretty, wide-reaching.
Okay. And Nirav, maybe also just following up on the previous point. So about closing data gaps. How are you dealing with that? If there's any that are really painful at the moment or requested?
And with a lot of caution, I would say, and we need to exert more of that, more due diligence, I would say. So yes, being a technologist, I would always say, why don't we use AI and machine learning to read through disclosures and kind of identify intent? Is this company on the transition pathway, or what are they doing? But I think we also need to be careful about biases and kind of the inherent risk of using that approach creeps in. So yes, cautiously. And I think the other aspect that I touched on before is engaging with your investee companies and working with them to kind of disclose more actively, especially in certain asset classes where public disclosures are not available at all. So a combination of those two approaches. And also, I think this is also a space where a lot of due diligence is required, because the question, what should happen in absence of a disclosure, is yet to be kind of contemplated on and answered, as in, should a provider be kind of aggregating to the parent company, or if a parent has disclosed, is it applicable to one of the issuers in the hierarchy below? And there are still no set standards or rules that you see in the industry on things like that. And in absence of that, you could easily be misquoting. And everyone's read through the news and what's happening with Goldman Sachs and what's happening with some of the other big US companies with their ESG funds. So yes, we need to be very cautious about how we deal with those data gaps and not be very eager.
Yeah. And then on the other side, listening to Adriana mentioning 5,000 data points, it almost feels like there's not too many gaps, or at least that gaps is not the biggest problem.
It's then the quality of the data that becomes just kind of the aspect of focus, right? So you may have a data point, but if the data point is not relevant or is not material, as we were saying before, then then it becomes less of a area. It should be less of an area of focus. The risk is very often if you're taking this as a compliance and tick in the box exercise, as opposed to thinking, you know, am I looking at something that's realistic? So I agree with engagement as well and the due diligence, because those are all aspects that are going to be critical in deciding whether you are on the right path or not.
No, I think it's always advantageous when data collection is being done to essentially reach a target, or you're following some established guidelines on data collection. So for example, it was mentioned before the Science-Based Target Initiative, right? So that's about setting targets in different industries and having a robust framework that somebody verifies for you to say that you're on track and that you have a Paris-aligned strategy. Now, if you follow that, you have to produce data, and it will also tell you, depending on your industry and your emissions, whether you need to collect, for example, Scope 3 data, depending on where your emissions are they from your own operations or in the value chain. Now, if you're being driven by that type of a framework, I think it's very positive, because there it's more apples and apples, and you're using the data for a purpose. You're using the data to see if you're on track towards a target. If we're just sort of collecting data, whether it's 100 or 5,000 points, what's the purpose? So I think we need to sort of add more purpose again to the data. And I think also what's really important on the data here is, what are you doing to manage the risks associated with that data? And I think you touched on it, Nirav, in terms of stewardship and governance, because you can say if this is correct or not, but I think the idea is, are you actually managing the risks? Not are you just disclosing the data? Do you have a policy? So if human rights is a risk in your supply chain, I don't want to just have data points on it. I want to know, how are you actually managing this? How are you reducing the risk? What are you doing consciously on procurement? What are you doing on engagement with your suppliers? How are you doing independent verification of sites, et cetera? I think that's really what it's about, that the data should drive that type of purpose.
And probably also coming back to the old saying, I mean, death by data, or is more data always better? And while, if you're just over-flooded by data, it may also give you a false sense of security, where maybe some of the obvious decisions to be made don't even require too many data. But maybe therefore also the question to Juliette, with regards to how this increasing regulation has actually influenced or impacted the investment industry, and are we nowadays in a better place compared to before, where we have maybe more frameworks or standards?
So I'm French, so we're not known for our optimism. So I would say it's not necessarily better, but it's for sure different. Over the past 2 to 3 years, I would say what's really dramatically changed and evolved is that outside of the ESG-specific set of opportunities that's offered by ESG products, notably, and direct engagement, there's this consideration of ESG being essential to a financial institution's reputation and its ability to operate. So I used to be a trader, and what I would say is, as a financial investor, there's been quite a lot of misconceptions that are currently being addressed, and where the industry has evolved over the past few years. So I'll just take 4 of them, which we've kind of touched on. First one is opacity. That's death by data. The thousands of data, the hundreds of acronyms, all the frameworks that seem to change from every quarter to another. And what this creates for a lot of investment professionals is this state of confusion and this tendency to always defer to a siloed bit of the business that is the product specialists. I would argue that if you are invested in the investment community, part of the ability to digest complex information should be one of the reasons why you've joined it. So I assume once you've got the right incentives, it's not something that's very, very hard to address. Issue number 2 is very much reflecting on what Joachim was saying. It's the perceived subjectivity of ratings. So there's been quite a lot of research that's come out over the past 6 months about the difference between credit ratings that have north of 0.9 correlations, while ESG ratings, depending on the methodologies that are being used, have 0.4 to 0.7. So when you're an investment professional, you think, well, there's no way I can base my decision on that because this is just irrelevant, and depending on what methodologies I'm using, it's apple and oranges. Again, I revert to, yes, it's complex. Complex is not bad. Complex is an opportunity. And it's the industry's responsibility to spend the time and the effort and build the knowledge to put forward framework standards, but also to be deliberate about what methodology it is they're using. So back to the point, what is that data for? What is material? What is material to this company? What is material to your business unit? What is material to where you see the world going forward? That's what we're doing in risk management all the time. So very natural for the industry to evolve that way going forward. The third one, kind of linked to this word of 3 years ago, is there's a big confusion about what's ESG integration versus what's impact investing. And it's different to be formally committed to having to do right or do well and to consider ESG as an extra layer of risk management. What it is you're trying to achieve and gaining that clarity on that, that's an effort that every financial institution has to do. And certainly in regulation, one is optional and the other isn't. ESG integration and managing your risk, it's just the right thing to do. I mean, if you tell me I'm a bank and I've chosen to ignore my risk, it's a little bit of an issue. And, number 4, kind of linked to that, is what's the financial materiality of that data that you're gathering. And here again, there is some element of academic research on that, and yields link between some ESG pillars and yields and impact on the term structure for debts and all sorts of things like that. But ultimately, regulation, by integrating ESG credential and data in risk-weighted assets, in capital requirements, they are going to force the industry to move forward and progress on that issue. So I'm going to be slightly less French and say that it's actually very, very positive, this evolution, because it gets us thinking, it gets us out of this sort of intellectual laziness of, oh, it's complex, therefore I shouldn't care and I'll defer this to a silo, and it's just being integrated. And the last thing I would say is not a single investor is running their portfolios or their investment strategy the same way they were doing it 10 years ago. That's not how the industry works. So I'm extremely confident in the financial sector's ability to deal with something that's complex and multifaceted.
Yeah.
If I may, I also think that you were 3 and 4, right? So I think the aspects related to risk specifically are global in nature.
Yeah.
So while in other sectors there may be a different perspective, let's put it this way, if you are in different parts of the world, in terms of how relevant ESG is from a particularly climate, environmental sustainability of the ESG, in the evaluation of risk and the necessity to potentially put some capital at it, that's global. So we're seeing this in Brazil, we're seeing this in Singapore, we're seeing this in the US, we're seeing this clearly in Europe. So I think that's great because one of the issues was comparability. This is actually probably just making everything more comparable.
No, and yet also like in this phase where we have a lot of confusion and opacity, I mean, we're also having players that either consciously or unconsciously or accidentally maybe explain a bit wrong what they are taking for measures in terms of ESG. So I mean, greenwashing, no panel on ESG without greenwashing to be covered. Maybe Joachim, is there meanwhile any good approaches how for the banks or for the investors actually to properly detect greenwashing or?
Yeah, and I think there's a certain buzz around greenwashing now, but I think maybe we're using it a little bit too indiscriminately as a term in terms of what is actually greenwashing. So the controversies that have been referred most to are the ones where regulators come in and are basically investigating someone for packaging something as green when it's not green, or that they've basically said it is something it's not, right? So that's obviously a potentially greenwashing and very important to clamp down on it. But then there's also greenwashing in terms of what is sort of perception from consumers or other businesses that certain businesses get labeled as green, and they think that's wrong, for example, right? So they feel that that's greenwashing without it necessarily being a violation of any kind of regulatory requirement. So I think we need to sort of unpack a little bit on this greenwashing, but our experience, the best thing you can do to avoid accusations of greenwashing, whether they're coming from regulatory authorities or consumers or other businesses, is to be transparent. It's basically saying, you know, this is how we measure something, or this is how we package something, and preferably link it to some established standard, even if it's a voluntary standard, and saying, you know, we're following a voluntary standard for our sector. Where I become skeptical is, you know, when they package and saying we have a proprietary method, and it's fantastic, it has some AI mixed into it, and it's great, you know, but we can't disclose how we measure it, etc. So, you know, the more you do to base it on standards, the more transparent you are, the less chances of greenwashing. And just to give a concrete example, we do second-party, our assurance team does second-party opinions on sustainability-linked bonds, on green bonds, and I think having some type of assurance along with what you're offering is key here, because you're allowing somebody else to come in and do an independent review of it and saying, does this live up to what the market, whether it's established or not, because then when it comes to sustainability-linked bonds, it's not regulated yet. It's supposed to be regulated, at least in the European market in the near future, but you can at least have some independent actor come in and say, when we do it, we look at, is it material? What you're saying that you're doing, is it actually material to your business? Is it ambitious? Because one thing is to sort of have the disclosures, but are your targets actually ambitious? And can you show us that compared to peers that it is ambitious? When you have that type of verification or that type of opinion on something, it becomes a lot more solid, and it's a lot harder of accusing it of greenwashing. And from a pure sort of compliance perspective, you can always point to somebody else and say, but listen, these guys assured it, so it must be fine. But I think that's really key here, to sort of be more transparent and more robust on it. And just very shortly on this, you know, there's been, ESG is meant to measure controversy, but sometimes ESG measures become the controversy, and that's what we see now with the S&P and Tesla case. And I think, again, it comes back to this confusion between ESG that Juliette was speaking about, ESG integration, and what's sustainability. And from that, there are a lot of thoughts about, you know, greenwashing and how can Exxon be on this list and not Tesla. And I think they're actually both right. And time permitting, I can say why, but let's maybe take some questions.
Okay. Yeah. No, actually, we're almost close to the end of the panel. So maybe 15 to 20 seconds for everyone, like to make a guess. Five years forwards, coming from an age of imperfection, what will have significantly improved on ESG data?
Well, I'm hoping it's going to be the transparency and audit trail via, you know, using technology and using blockchain. The more transparency, the better it is for investors and you know, to actually evaluate the impact of your strategies.
Thank you.
I think for me, ESG is not going away. It's not just a trend. So maturity in terms of disclosures and organizations setting more targets and kind of actively disclosing them. And then also from a technology perspective, a lot of the standardization of how this data is consumed and stored and used within organization, that will also further mature.
Definitely a journey. I agree that we need more transparency, and we're going to have, through technology and distributed ledger, definitely is going to be used in this regard, just more certainty about where the money goes and how it goes. We need more investments in new technologies, really, not from the fintech perspective, from the climate perspective. So the only way to do it is just to reduce the concern about greenwashing and get people comfortable that if they're investing in something, it is, you know, going in the direction that they really care about. So I think that's critical.
And my short take is why Elon Musk is right and why he's wrong. Why he's right is that we as an ESG community, we haven't explained well enough what these measurements are about. What are we actually measuring? Is it integration or is it impact? So we need to do a better job. He's wrong in that sustainable companies, or those who have a business model that is sustainable, they also need to care about ESG. So you may be good on one side on emissions, but if you're not looking at human rights or at governance, product safety, you're not an ESG company.
Thanks a lot. I think that's a very powerful final statement, and I hope everyone got some new food for thought on how to think about ESG data. Thank you.
Garrett, thank you and all the panelists for a very emphatic discussion there, which helps us take the debate on further. Thank you. We've got some more high-powered panelists to follow on. Carrying on with the concept of ESG, we're now talking about ESG assessment and improvement and asking which technologies are the most impactful. It's my pleasure to introduce Kalyani Inampudi, I hope I pronounced that correctly, as our chair for the next panel. Welcome. So Kalyani is an ESG consultant at Renwity, where she's currently working on the development of net zero strategies with asset owners. She's also previously spent over 10 years working in the finance sector in various data analytics and ESG and sustainability roles. So another perfect person to take us through this topic. Thank you.
So good afternoon, everyone. Hope you all can hear me. So welcome to my next panel, ESG Assessment and Improvement. Which technologies are the most impactful? So we have the lovely panelists here. Do you want to introduce yourself? Yeah.
Thank you. My name is Ivomila. I'm the CEO and co-founder of a company called Plan A. What we do is we do complex data processing for ESG assessment and improvement. So we work with a lot of corporates, financial institutions, and their whole portfolios to allow a really deep understanding of the performance, and then we automatically prescribe a recipe for success. How do you achieve your net zero, and also how do you improve the ESG performance of your portfolio?
James.
Good afternoon. My name is James Green. I work for Société Générale, representing myself today. 20 plus years in the financial services sector. Recently playing data geek around all things ESG and data to have the intelligent conversation with the board and senior managers to make a decision around how are we being sustainable and how are we being able to drive that from the desk team level up to, you know, outside facing with sustainable finance and those bits. Thank you.
Johnny.
Hi, I'm Johnny Matamore, and I'm head of risk and sustainable finance at First Derivative, which is a technology firm for substantially integrating and providing data systems for financial services firms. My background's 30 years in mostly pricing securities in trading, in banking, and then in hedge funds. And the vast majority of my work at the moment around sustainable finance is how to systematically take the data problems we've all been talking about and turn it into a framework where we can actually value assets properly, upwards or downwards. And I've coined the term the big green short to reflect all the hell we've been through before in 2008 and beyond.
That was great. Thank you so much. So to start off with, the first question could be, how can financial institutions identify which technologies are best suited for their strategy? James, what is your take on that?
I think for financial institutions to make this work, right, for me, it's really two parts. It's really understanding the problem and what are we trying to solve, what are we looking at, so we can measure it. Because if we don't know what we're trying to measure, throwing up KPIs doesn't really do anything. The other side for the technology firms, and if we partner or when we partner with fintechs and smaller firms, is does it solve our use case? Because if it doesn't fit the current problem to solve my pain, it could be the greatest tool in the world, but I have no reason for it. But the other side of it is, especially in light of today with a lot of cost changes, it's can that same solution be utilized across multiple use cases within the organization? So I'm not just stuck with just, I've got this tool for this problem and this tool for this problem, but I've got this tool that can solve, say, 5 or 6 problems.
So how do you identify which are the most useful or maybe not so useful technologies and limitations when you implement these technologies? And then also, Johnny, how do you actually look into this aspect as well when you're serving your clients or financial institutions?
For me, the starting point here is a proper definition of what the data object is. We've all talked about the data problem, but if you don't define what the data object is you're looking for, the taxonomy, then you're wasting your time going looking for data. And I'm a mathematician and markets economist by background, and I was always taught make a definition, and then you might have a theorem which people find useful in life. And whilst it's mathematics, it's why bridges don't fall down. You know, it's because they define things, the thickness of a girder that you need, and then the stress and all of those things in engineering. And we're exactly the same in financial services. You know, we're an engineering type mindset for making sure the edifice of the adequate capital of a bank doesn't collapse. The adequate returns on a fund don't collapse. The underwriting by an insurer covers the losses. Those things are actually price-based, and we can talk as much as we like about doing good, but if the fintech isn't contributing to what is essentially the preservation of the quality of the asset and the enhancement of that asset, be it green or otherwise, then we're not even at the right starting point. So when we talk about doing good, we should never lose sight of it. You don't do good by destroying value. You only do good by creating value. And if we want to create value by turning everything more green, we still have to abide by the same principles of getting the pricing right. And you know, this concept of the big green short is a real risk. If you've got a bunch of mortgages in your book and you think they're safe, and then suddenly there's a big jump in price and they collapse, then the asset backs that the asset managers bought and the borrowing rates on all the funds will all go to hell. So, you know, fintechs for me, the real value is if they start with proper definitions of what the data object is.
So, Lubomila, how about
Maybe
yours?
I can just add some controversy
Yeah.
to shake it up a little bit. So I think we have to twist the model a little bit upside down, because at the moment, the way we define growth and the whole economics is kind of flawed, because we've been missing a layer of the assessment that would allow us to understand the true cost behind the decisions that we make. So if you look at all these financial vehicles, or look at all the ways in which we've been introducing money into certain setups, we actually have never understood the actual value that is sitting behind all of those, because we have been looking at growth margins as the KPIs that define our reality. For anyone here that is managing a lot of money, probably the concern at the moment is like, how do you assess your financial risk? That is the climate risk that is associated to this missing layer of your analysis. And for those that have not understood that, if you're not prepared to kind of go deep into the data, and with the right data, I'm fully aligned on that, you're probably going to be losing a lot of money down the line. So I would say kind of from the perspective of where we need to start with assessments and improvements, first we need to kind of understand that there is a fundamental need to rethink the model, and then for whatever data is available now, kind of start working on the improvement immediately in order to be able to actually go beyond simple analysis.
Definitely. So we also have, like, financial institutions implementing machine learning algorithms. There's a cloud migration, blockchain, which is being trialed for a variety of ESG applications and IoT. Where do you see that, the innovation is coming up, and obviously not every of this is implemented, right? I mean, you're going to choose which of them are the most, every
You do,
day. Yeah,
but
yeah.
I think, to a certain extent, and I'll throw hopefully a little more controversy into the mix. I do agree, Johnny, with you where we do need the right data, but I still argue the point of, if you don't know what you're trying to solve and then what you're going to measure, how can you find the right data? So, but at the same time, there's so much data, sometimes we get paralyzed with the analysis that we don't even move, we just go, and but that's what happens. Or what I've seen too many times is we'll partner with, and I've worked at several different organizations in the financial services sector, where we will partner with a company to go, this tool is really great, this is cool, let's use it. And then on the flip side, turn around and spend 3 times as much money with that firm to completely rebuild their software package to put the square peg in the round hole. And to me, now instead of spending €500,000 to buy this really great tool, and then as an organization, let's change how we operate and still get to the same endpoint destination, but now it's more efficient. We can't do that. We need to work the same way with a new tool because it's shining. Come on.
How do you look into these new craze technologies like NLP? Everyone's after NLP, right? Everyone's parsing the data by using AI, to so much of innovation happening. Yeah, you want to take that, Johnny? Especially. Yeah.
The banding around of these terms is almost useless because, again, if you don't solve
blockchain and solar panels,
if you don't solve the business problem, so the business problem we focused on here is you do good by not destroying value. So if you can value things properly, so back to I'm talking about separating taxonomy to data. Everyone talks about finding the right data. Don't even look for the data if you haven't got the taxonomy, the definition. So if I'm going to revalue a bond, I'm going to use the same discounting using basis points. Okay? And that's never going to change in the history of our life. ESG is not going to change that. But what's going to change is what metrics go into what the basis point spread should be over Govy to discount that cash flow to give me the bond. Now, today, the statistically most relevant input into repricing a bond is carbon emissions, because we have nothing else. So that's what's going to dominate in the first repricing of the global bond market, in my view. And if you look at valuation of any security, from a bond, you can get the residual and revalue equity. So if you're going to do something, you start to look at how do these business problems get solved. They get solved incrementally by discovering which bits of data we can now build into proven pricing models. We're not going to change value at risk. We're going to change what goes into it. We're not going to change the pricing of a bond. We're going to change what goes into it. So it's a data problem again, but that only works if you can get the definition of the object you're trying to put in. And there'll be a point shortly where we will be able to take a suite of bonds and we'll be reverse engineer from the market. These prices have changed, and we can infer with the relationship on the disclosure of carbon emissions for companies. And we could then hypothesize that the number of basis points on this bond, the attribution is here's the Govy spread and here's the carbon emission spread. Now, whether or not it will be reliable is neither here nor there. It will be the only tool we have for the initial repricing of bonds. And it's that type of thing, I think, which James is alluding to. If you're trying to solve a problem, don't boil the ocean with every bit of data and every bit of fintech. Go for the boundary conditions you think you can incrementally solve things. And that's what I like about the fintech market. They generally are backed by venture capitalists and personal money. So they have to find a solution that's immediately relevant. And if it's immediately relevant, they'll sell their product. So it's a good focus for helping us, because if they've got immediate solutions for the incremental advance of ESG, of what is fundamentally repricing every asset on the face of the planet, then that's really valuable to us.
So Lubomila, as a startup, fintech startup, how do you look into this AI and ML, NLP? I mean, constantly evolving technologies. How do you actually cope up with this?
So the Planet technology is based off of two sides. One is science. We have a quarter of our team, which are climate data scientists. And part of that, the team also includes people that come from policy, that have worked in European Commission, the UK government, also in some of the certification bodies. And a final bit of this team is also decarbonization and ESG improvement experts. What this gives us is a really strong fundament that allows us to have a technology that is not solely focused on the reporting and the analysis bit, but really pushing companies and their portfolios, if it's financial institutions, to move forward beyond that. And the second bit of our technology is AI. We use AI for the decarbonization and ESG planning. What this means is that in order to continuously be able to serve the same type of industry with more success, from the thousands of suggestions that we give that are very practical, that go as a counter action to all the data points that we've gathered, we essentially have been building our AI algorithm that essentially gives us an opportunity to understand what are the biggest levers for businesses to improve, for their portfolio to improve, and then how everyone can align around the same goal. Because if we go to the comment about data, one of the challenges that we have at the moment is that when we speak about ESG, probably if we have to do like a little survey here, I'm sure that we're all going to give a different answer, because there's different legislations, there's different frameworks. We have clients from private equity that have surveys for their portfolios with 300 questions. We have VCs that have 20 questions. So you can understand the layers and the depth of analysis quite different.
And for this disclosures are a very big part as well. Like,
yeah, but the disclosures are also with different definitions of quite often even the same KPIs. So ultimately kind of aligning of the language and then aligning everyone to go towards the same goal is the fundamental outcome of the use of our software.
So the next topic would be how was actually, you're coping up with the data methodology, technology, especially the constant evolution of data standards and regulations. How do you cope up with this everyday changing scenario, especially like from my survey, it shows that, most of the data providers are sticking to SASB at the moment because they're going to come up with, it's going to emerge as a global standard set of metrics for sustainability disclosure coming up in 2023 for the IFRS. So some of them are sticking to just different AI models. So how do you cope up with these challenges, especially, James, when you actually source the fintechs? What aspects are you looking into them, the changing landscape?
Is none a good answer? No, I mean, all jokes aside, it changes, but, depending on the size of the organization, your ability to pivot and be agile, and I apologize to everybody in the room for dropping a buzzword.
I would like to know what the limitations and challenges you have, because there are going to be challenges every day. But
the limitations are within the organization itself. It's how quickly can an organization pivot. If you have a company the size of Plan A, we can fairly move at the drop of a hat. When you look at an organization, whether it's HSBC or RBS or some of the bigger brick and mortar organizations, you can't just turn that ship on a dime. As much as we would love to say we can, you can't. So a lot of it's planning around, okay, what can we do, how can we do it, and it's putting it into run mode or put a project around whatnot to find the data, or even internally, we may already have the data, but then it goes back to, did we define the right question?
And contracts.
Right.
So you can't rip up contracts that have been in place for decades.
No, I mean, there's a legal aspect, there's the compliance aspect, it's
regulatory aspect.
But it all calls back to the regulator, because the regulator and the policymakers are going to say X. They're not going to tell you how to get to Y. They're just going to expect you to get to Y.
I'm not sure if everyone followed here what happened. I think it's 40 minutes ago or 1 hour ago, but the MEPs in the European Parliament blocked gas and nuclear to be called any more green investment.
Yeah.
Why I'm saying this is because I fully align with you that the regulators at the end of the day have been pushing this ESG revolution or whatever you would call it. And what we see a lot in our cohort of now more than 1,000 companies that we work with, of the likes of BMW, including Societe Generale, is that when the regulator calls, as much as you think the ship is not going to move quite fast, all of a sudden the priorities are totally different. When the EU taxonomy was first announced, and then when TCFD was announced, the amount of panic calls that we got within 1 day, we had 400 requests for our software, and that was within the span of the 3 hours that were after the announcement. So I would have to argue that contracts might be there. There might be quite a lot of, obviously, concern on how do we turn around our company and fundamentally the hypothesis on which we've been building wealth. But with the severity that governments kind of have introduced with regards to all the legislation, I think there's no doubt in anyone's mind that this needs to be priority number one.
Especially SFDR, everyone's still struggling on the disclosures,
and it's all disjoint. You've got companies having to disclose after fund managers. Fund managers have to disclose before companies actually are publishing their data. It's completely upside down.
Yeah, the regulators. So finally, I would like to know what would be your take on how to create a collaborative environment between ESG, fintech companies, regulators, and financial institutions. What do you think the main key points should be implemented here from each of your perspective?
So when we were before coming to stage, we were chatting with you that we should speak about how difficult it is for corporates to work with startups. Just to spice it up a little bit, I would say that who here knows the concept of the GHG protocol? Just by a raise of hands. So just a quick explanation, I think it's quite useful. So for the EBIT that we look into from the ESG story, we have emissions, of course, and how you calculate emissions is based off of a protocol that is internationally accepted called the GHG protocol. It's divided in 3 layers. Scope 1, facilities and vehicles. Scope 2 is your purchase services like heating, cooling, electricity. And then Scope 3 is your suppliers. It's your investments, also use of products if you're producing something physical, employee data, and so on. And essentially what this is to demonstrate is only on the EBIT you can understand that the only way for someone to really start looking at ESG improvement, you are nowhere close to hitting any targets if you don't involve your third parties. This could be your investments from a portfolio perspective. This could be your suppliers. This is even the people that have brought this bottle of water here for this event. If you look at the wider perspective, and I'll give an example from one of our clients. So we work with also fashion companies, and for them, obviously, the supply chain is quite of a big challenge. And the S-bit, so like social, anything related to like how workers are being treated, is quite of a big challenge. I'm sure many of you have heard about all the controversies around fashion companies that have been essentially put into a greenwashing list because they didn't check on their suppliers. So bottom line of these 2 examples is that you have a lot of interdependencies that require all of us here, regardless of the type of industries in which we operate or the type of companies we invest in, to really look into these peripheral players and stakeholders in order to really be clean and kind of not accused of any greenwashing. Now there's like pinkwashing and all sorts of colors, so yeah.
Johnny, what do you want to?
No, continue with the controversy? Sure.
I mean, I think, mostly how do you think the collaboration can help to boost the innovation, overall innovation? Because from my survey, 300 plus fintech providers, they all say there is an issue either from the institutional investors or even the financial institutions, there is...
I mean, the biggest problem around collaboration is fintechs thinking they can sell one cog in the solution wheel. All the work I do, I have to work with fintechs closely and figure out which maybe 3 partners will solve the problem. Otherwise, nobody's going to talk to me, no one's going to engage me. And I think that willingness to actually collaborate is no longer just desirable, it's essential, because take something as simple as EBA carbon emissions, mandatory for a large number of the banks. From January this year it was announced. There's like 10 templates they're phasing in over several years. There is nobody on the face of the planet who can do that, and I can assure you there's lots of people telling you that there are turnkey solutions. Big consultancies can do this because they have something on the wall, and behind they have 10,000 graduates at keyboards. So nobody can do it. Okay. So what we have the EBA Pillar 3 ESG disclosure. Okay. Then we're going to go to Pillar 2. And then more risk disclosures. And then we're going to go to Pillar 1, and we're going to address capital. And we're doing it in that order because non-financial disclosures gives you some type of stake in the ground to say, okay, what's the most statistically relevant thing? Emissions. So there are some fantastic fintech solutions in there looking at this first stage of what are we trying to capture that's statistically relevant to the whole environmental change and the improvement of temperature conditions. Those things really matter as a first across ESG, because if you start on something like that, the momentum for everything else, which is less tangible and less well defined today, will start to become defined. Eventually, we'll have a social taxonomy that could be as robust as a risk taxonomy for trading bonds. Now, that's the ambition that we should be aiming for. You're not going to get that without collaboration. And I would say the most important thing, if you want to be successful now, is to start doing your own due diligence and quality assurance on both fintechs and partners of fintechs, because you're not going to engage one party. And when one party delivers a solution, they'll always blame the other party that they're not engaged with for the solution failing. These solutions will systematically fail, and they will incrementally improve. So you've got to start engaging people as a group and make sure they work together, because the last thing you want is one fintech saying, well, ours works, theirs doesn't work in your solution, and we didn't engage with them. And that kind of passing the buck. You are not going to solve a problem without a team.
So, Johnny, what do you think of taking the frequent feedback from the fintech data providers? Because from the recent SFDR, when I was working on SFDR consulting project last year, even now, most of the financial institutions, they say that, they need to disclose this. We need to have a granular level data, and it's very tough. They don't disclose. Now, the point is, most of the small fintech companies do struggle, the startups do struggle. Don't you think like a regulatory bodies like even SFDR, even ESMA in Europe, they should be looking into these fintechs to take some initial feedback, the struggles they have to get this data out? Because everyone wants to get there, right? I mean, especially the innovative fintech startups, hundreds of them. So,
but the data we're talking about comes from the originating companies.
Yeah.
The fintechs can only fill two voids. They can either be a mechanism for transporting that data, or they can be a mechanism for mathematical proxies of the data. They can't do anything else. And that's what climate risk modeling is all about. That's why it's so expensive and why there are so many people struggling for it. I'd say one thing about this collaboration. Everybody has seen data from Sustainalytics, MSCI, etc. They publish a lot. There's a lot of transparency on some of their ESG vendor data. But there's still no clarity on what the taxonomies are and what the methodology is. Some publish them. There's a very good one by Refinitiv. I'll only call out good names. I won't criticize anybody. But the litigation, my friend. But the key thing here is whether or not you can get that taxonomy to test the data they're providing to you. Everybody forgets it comes back to the definition. And if you want to do good, you must define what good means. And again, you go back to a definition. I don't think there's any other way without getting full disclosures on taxonomies and being able to map taxonomies between different systems.
Lubomila from Planet, sorry.
I'm sorry, but even with, we've talked between fintechs and financial services and bantered back and forth a bit, but the regulator still has to come up and be part of that definition, right? We have to collaborate. It's got to be across the board. Even if we look at SFDR and other disclosures and reportings on ESG for corporate, who defines the materiality? Who defines that data set? Is it the business? Is it the marketplace? Is it the regulator?
And this is why we're stressing, the collaboration between regulators and fintechs.
I mean, there is this thing that people forget. We are responsible for our own businesses. Whilst we might comply with regulations, the first thing we have to get right is the running of our own business. If there were no regulation today, we should still be running our business properly. So it's actually, the onus is on us as firms to have internal methods which may lean on third-party fintechs, etc. But we own the responsibility. So, for example, if we have credit ratings today inside a firm, if we want to define the next generation of counterparty risk, maybe we use green ratings and combine the two to give the new counterparty risk. But internal green ratings are the responsibility of a bank. And we can lean on the regulator, and that might be a subset of what we report, but the bar needs to be raised by the organizations themselves. We must be higher than the regulation, otherwise it's worthless. BCBS 239 in Basel III proved that. There's only 30 banks in the world have to adhere to that standard. It's become the gold standard for every financial institution that wants to be taken seriously, even unregulated financial institutions.
Plan A, what do you think of
maybe just to kind of add a different perspective on this, I do see your point of companies raising the bar and having ambitious goals on the ESG topic, but at the moment we're speaking thousands of different languages when we talk about this topic, and by allowing for all companies to define their own agenda on ESG, first of all, it creates a lot of frustration for the companies themselves because all of a sudden they need to become climate data scientists and ESG experts and policy experts. The beauty of having an aligned vision of where we're headed on the ESG topic and having a set of standards about what does it mean to have good S and G performance, what does it mean to have an aligned net zero agenda to the one of the government is that we actually can save on resources that are dedicated to defining these agendas. So I think, and that's something that I'm hearing a lot from our clients, there is a lot of wish for more kind of alignment because there's all these thousands of standards, different reporting frameworks, and that creates a lot of confusion and a lot of time spent on just preparing these reports, and people cannot actually focus on the improvements.
That's wasted capital. That sucks out capital.
James, how do you look into from your perspective, because you actually source these startups, right? And don't you think it's a bottleneck when they're not prepared enough, not proactive enough to scale up to the regulatory level requirements?
I don't think the bottleneck's with the fintechs on the scale-up side of it. I think the fintechs, because they're small and they're agile and they're nimble, they're coming to the table fairly prepared. I think the challenges the fintechs have coming into financial services as an entry to barrier is just the size and the internal politics, the internal compliance, all the negotiations, and all of a sudden what should be relatively simple turns into a 5-year sales cycle that you end up beating your head against the wall. And I feel for the fintechs. It is argumentatively a huge frustration for them, especially when they're coming up against a mentality in financial services. As you alluded to, as we're all a bunch of engineers, so it gets into the problem of who are you as an organization, and answer that question, and then go, do we build it or do we buy it? And half the time I've seen, we'll buy it first and then get frustrated because it's not working the way we wanted it to. So then we're going to throw it in the bin and then we'll build it ourselves anyways. And so now you've wasted, I don't know, 1.5 million or 2 million in 2 years of project work and relationship building with great companies like Plan A to go, never mind, we're going to throw it in the water with the baby and everybody out and then do it ourselves and then spend 3 times as much and take twice as long. And so I think financial services has an onus on this from a third-party risk operation perspective, but we have to take the responsibility to say, we will own the fact that somebody else is going to do the work, but we understand and we know what's under the bonnet, what they're doing for us, and then let the fintechs get on and do what they do best, which is actually deliver really great solutions and really great products, and we need to step out of their way.
I think that the great hope for fintechs, the very positive thing is financial institutions have finally woken up to kind of running their model like their financial products business, like manufacturing, like you'll make an automobile or something. And they're very happy to outsource as services in technology, microservices. We're getting to the point where they're very happy now to outsource operational microservices. And I see the fintechs as key cogs in that whole operational microservices environment that's evolving. And in a few years from now, I think it would be quite normal to see big financial institutions that have traditionally been very conservative about outsourcing elements of their operating model, having as many as 100 third parties feeding in. But that can only work if that operational model is robust. That's been the bugbear for fintechs getting into financial services firms. They are inherently conservative about their operational risk. You try moving something or decommissioning an application in a bank. Good luck.
And I think forum-led regulators such as ESMA in Europe and FCA in UK, do you think they should continue to share their thoughts on the new data requirements, have an open discussions?
Can I just add a comment to what he was saying, because I think it's quite important also, maybe shed light on the fintech perspective. One of the biggest frustrations that we have when we collaborate with corporates, and that makes up a quarter of our clients, so quite a lot of kind of processes have been already done in the past, is that innovation teams don't have a lot of credibility internally. Like, they're put there to find connections to startups, but often they don't have budgets, and often they don't have actually the decision-making power to turn this into something that is scalable. So maybe this sounds controversial because in your organization things are functioning in a different manner, but we've seen many times, again and again, the case where innovation teams are isolated, similar to how in some cases you can see sustainability and ESG teams isolated because this is a new patched up department that just has been added. The second problem that we have seen in the collaboration with large-scale companies is often kind of no reduced procurement process. When you're talking about like a 20K or a 50K deal, it should not take 3 years to get this through. And maybe it seems kind of impossible to think of such reality, but I can promise you and give multiple examples where this has been the case. There was one, I'm just thinking of one particular deal that we just closed, and it took 1.5 years for a deal that is like 60K, and that's something that, it should be kind of more, especially with the importance of ESG, clear of a priority with a shorter process, understanding that the stakeholder on the other side is done. And then the final bit, which is kind of related to data, what we've been talking extensively about is, of course, many financial institutions need to be compliant with a lot of laws related to client protection and so on. There's quite often no know-how internally on how to anonymize data or like go through the process of making the experiment possible without going through the data protection burden fast.
So I think it's nearly a question time now from audience. I've got 3 questions here. How can we distinguish between fleeting trends, buzzwords, and the trends and technologies that are actually here to stay? So what are some examples of these? James, maybe you want to take that.
I'm sorry, can you...
Blockchain.
And some DLT while we're at it?
Yeah, Web 3.0.
Nice. Can you repeat the question? I'm sorry.
Sure. How can we distinguish between the fleeting trends, buzzwords, and the trends and technologies that are actually here to stay? And what are some examples for these? I think it's looking into the ML and blockchain type of technologies.
Speaking of dropping buzzwords, I think part of it is, it goes back to what we talked about earlier with Johnny, is what does good look like? And being honest about knowing what you know and knowing what you don't know. Because, you know, we've all built teams in the fintechs in the room and whatnot, have built some great teams and amazing teams, and they don't build them by putting people around them that think the way they think. They build it by finding those people that they can work with, but that fill in their weaknesses and their shortcomings. And I think we need to do that and be honest, and don't use the buzzwords, but go back to just how do we talk and communicate and have those open dialogues and actually just deliver. Whether you're in a big corporate, whether you're with a fintech, you're collaborating between a fintech and the regulator and other companies. I think there's a use, even within the brick and mortar sector of financial services, that we could collaborate on a lot of stuff to get the best in breed without worrying about our competition, because we're all ending up fighting for the same 5 pence anyways. So collaborate and share, but that could be a pipe dream on my part. So
the next question is actually, what would you like to see more or less in the industry in the terms of ESG assessment? Because I think personally I see this as, I mean, I do sustainability consulting with corporates. They always ask me the question, what is more and what is less? And if you look into something like SFDR, which I'm working with a fund manager, it's always like, you know, how do you balance? How do you fine tune it? So from fintech's perspective, Plan A, how do you answer this question? Yeah.
I think we should stop thinking that technology is going to fix it all, and I'm saying this from the perspective of building a tech company. Quite often what we see is a lot of hope that any kind of ESG challenge is going to be fixed by the fact that we're going to have a fancy buzzword system. The truth is that we need to focus a lot more on the action bit that comes after whatever analysis has been done. It's totally okay to not have all the data. There's a lot of data gaps out there. This is what also the previous panel mentioned. There's a lot of challenges related to the educational bit. So I'm assuming that many of your stakeholders would not be informed of many of the topics that have been covered in this conference because they just have not been dealing with this as suppliers, as investees, and so on. So understanding that we're kind of, building a plane while already being in the air is something that fundamentally can allow us to start actually implementing actions that really matter to our planet, to our society. We're here to talk about improvement, so obviously that's for me what matters the most. I think we need to understand that there's a lot of technologies out there. They can be implemented at scale. They can do a lot of work. But until financial institutions don't start working with those at scale, we don't need any more fancy innovation.
So I think another point to add is from SASB standards perspective, you need to identify the most material points and then the less material points. Probably that will help the corporations to, disclose, You cannot disclose everything, it's hard. But, the most pressing points at least, and, probably you can just prioritize like that. What do you think, James?
Well, I agree with the colleagues in the previous panel when they started talking about the materiality. It really is going to boil down to what are you as an organization doing?
Yeah, exactly.
And what material within ES or G fits who you are, what you're trying to accomplish, where you're going. So you've got the right definition, and then do I or do I not have the right data for that definition?
Especially for the ESG assessment, it's an ongoing challenge. What is more, what is less, and people are looking at a different variety of frameworks, right? I mean, we have most of them are looking into SASB, and SFDR is coming to the picture now, and you're looking at a GHG. So how do you fine-tune the balance, from within the frameworks? And maybe Johnny, do you want to take up that?
Yeah, I mean, this whole accounting thing is nothing new. If anybody knows about derivatives that used to be off balance sheet and then they came back on balance sheet, what we're talking about here is trying to measure financial metrics which are not in financial metric terms today. So actually, we're translating, I'll use the simple example, carbon emissions into a potential adjustment to an asset or a liability on a balance sheet. Hedging on balance sheets has gone through this, fair value versus average life. All the CDOs that were off balance sheet, they came back on. Massive amounts of debt came back on balance sheets. So what we're talking about is nothing new. It's a question of how do we augment the current regime by extending the type of data that we're going to include. And that's not new. ISSB, SASB, and all of these are following existing proven principles. I'll use one simple final example, intangible assets. If you're an advertising group like WPP 20 years ago, the greatest boondog was be able to put $1 billion on your balance sheet of thin air. So it's not new, and that's what you really should take away about ESG, in my view. There's nothing new here apart from taking new data and trying to augment existing systems. We're not going to change the risk models in banks because that's the basis of their license. We're just going to augment them.
There's the last question. We only have 2 minutes to go. Is there any high priority within the financial institutions to implement technology for ESG, or is it still low on the list compared to other areas of the business? Do you want to take that, Danny? Yeah.
Absolutely, yeah. There's a lot of focus on the topic of ESG, but I would be lying if I say that this is the only priority. The truth is that there's a lot of decoupled discussion about the energy crisis and ESG and post-pandemic instability. All of these things are interlinked, but at the moment they are considered as different priorities. Where we see a lot of excitement is in the the rise of the Chief Sustainability Officer and the Chief Impact Officer and heads of ESG. This is a new generation of professionals that is at high demand, and there's no single company that wants to be a leader on the market in the coming years and in the future that does not have this position. As much as maybe it's not on top of the agenda, I can promise you that the amount of demand that we see is just the beginning of a massive wave. So it's really exciting to be kind of building in this space and in this timing.
Any questions from the audience? Anything?
Can I add one thing to that?
Sure.
I think there's a useful separation between which areas of the organisation it's important to now and next year. This year, I think it's all been about enterprise disclosure. Next year, it'll be all about embedding it in the lines of business. And the reason for that is the enterprise disclosure is like the stake in the ground. This is our first best cut. Next year, it's going to be, we've set a commitment to a carbon reduction target or a transition objective. Therefore, we've now got to start impacting that and affecting it at the point of inception of risk. That's pre-trade, on the trading desk, on the loan origination, corporate books. Exactly the same for asset managers and insurance underwriters. So this year, all about enterprise disclosure. Next year and the years after, I think it's all going to be about business embedding.
So thanks, everyone. I mean, I think my final key takeaway would be, in my opinion, the regulators such as ESMA in Europe and FCA in UK should continue to have open discussions with the fintech providers to get early feedback, when they actually implement any of these regulatory rules and regulations. And then also, I think the most collaboration should be coming in from investment managers, actually, who wants the fintechs to scale up, bring in more innovative solutions, because most of them, they struggle for funding. Most of the fintech startups, they're struggling at the moment, at least in the UK, I've seen so many hundreds of startups, they have innovative ideas, but nobody's keen to partner with them. So I think the collaboration could also come in the form of a partnership, or it could be some sort of sponsorship, or it could be some sort of building a technology together. Could be another way to collaborate and then keep this going. So thanks a lot, everyone, and to my distinguished panel as well. If any questions or anything, just I think we can just meet up in the networking event in the next 5 minutes, I think. Yeah. Thank you.
My pleasure now to introduce Dr. Ray Nolte from Centigo, who will be giving us a presentation on financial services and regulator leaders' perspectives on ESG, and I think will share with us a 2022 global research report. I'm delighted to say that Ray's got an awful lot of experience, 30 years as an international business advisor, half of that in the financial services industry, so knows what he's talking about. So Ray, welcome.
So good afternoon, and what I'm going to do is I'm going to talk briefly about a report that we've just finished, which had to be updated based on the issues which challenge the world at the moment, which have pretty significant regulatory and ESG implications. And what we did on this report was we were retained by a government agency called Enterprise Ireland, which are the largest by deal VC company in the world. And what they were conscious of, that there was a lot of investment going on in RegTech, and particularly ESG and FinTech, and they wanted to get a better handle of the market. And they have a portfolio of around about 30 or 40 firms who are actually looking at this. And they wanted to essentially look at the US, UK and Canadian markets, and then laterally the Asian markets, to see what the opportunity was. And this report was a result of this. But I think my overriding observation on this area is that selling or indeed buying ESG FinTech is a major challenge for financial services organizations and FinTechs. And this came out with the last panel discussion. And really, as you're aware, and it's been mentioned today, is there's a lot of ambiguity about ESG, and indeed there's a lot of issues around commitment to ESG, and some of the work that we do, particularly with the boards and C-suites of large financial services organizations, is trying to build that commitment and trying to build it into the purpose and strategy of those organizations. And indeed, when you look at the kind of the key protagonists in here, it's not just the regulators, it's not just the FinTech organizations, the financial services organizations, it's the wider ecosystem. But even when you take the three major financial services components of it, there's just a huge amount of disconnect between all parties. And I think probably the organizations that are the most guilty of this are financial services organizations. And this report was really the perspective of what's regulators and very senior regulators in these jurisdictions contributed to it. We were blessed in the fact that we got access to the board chairs, CEOs of these organizations. They were quite frank about this, and certainly they were raising key issues around not many of the issues that we were talking about today, about skills, competencies, capabilities, and the business and operating model challenges. But they were also raising issues around, is the ESG going to be watered down? Is there a commitment to ESG from policymakers? And lately what we are seeing is a very worrying trend, particularly in the US, and probably definitely been pushed by the Republican Party, where there's been pressure put on organizations to water down their ESG commitment. And we talk about greenwashing, and we talk about what happened in Germany recently, but there is greenwashing at public policy level as well, and there's a lack of substance, if you like, sometimes, not only at the regulators and lack of coordination definition, but it goes all the way through the ecosystem. And to solve this problem, it's an ecosystem problem. It's not something that financial services organizations on their own can actually address. So, Centigo, just a brief introduction to us. We're a Nordics consulting firm, and we've been working for over 20 years on ESG for large Swedish firms. And last year, outside of the Nordics, which I'm responsible for, we helped about 200 firms to address their ESG strategy, of which there was a number of major banks in there where we've helped them set up their centers of excellence and their training. And the reason I mention this is not because we did it, but because for us there has been a lack of engagement with the FinTech ESG industry because of its immaturity, in some case lack of trust, and a focus on training and developing and mentoring members of the ecosystem, including their clients, on what ESG outcomes need to be and the impacts. So they're saying, well, obviously, they obviously recognize technology is an important part of this, but they're actually saying action with our clients is very important. And in light of the difficulties we're having with data, etc., we do need to be moving something forward. And certainly, the PRA and other regulators around Europe have been very specific on the fact that you really do need to impact the outcomes at a client level. And so I think that's kind of a very important development within the market. Now, within this report, and when this report is available, and it'll be available obviously free to everybody, I think it's useful because it takes into account the perspectives of fintechs, banks, regulators, venture capitalists, and others. And I think using those perspectives as a checklist in terms of either establishing your fintech ESG strategy or indeed your ESG strategy is incredibly useful. And the report runs to about 200 pages, and what I've included in here is some of the quotes that we received from, as I said, very senior executives within the industry. So climate emergency and sustainability are, arguably the top priority for global standard setters and national regulators, and we've all seen that. But what we're not really seeing is organisations taking this as an existential threat to society. And whilst there is a lot of work been going on, and we've been involved in, for a number of our clients, the risk committees on ESG. I'd say one of our Nordic clients, I'd say the ratio of ESG-orientated risk committees to overall risk committee meetings is probably around about 9 of the 52 or so risk committee meetings. So that's an interesting benchmark in your own organisation. Are you actually meeting that type of metric? But it's interesting that the DEFCON 3, DEFCON 4 type scenarios that we've been running actually paint a very negative prognosis on ESG and time running out. And a lot of financial services organizations or fintechs don't employ climate scientists. And when you actually look at the science doesn't lie, I hope. And certainly it's really important to be able to build that and collect that and understand the implications of that within the businesses that you're looking at. I think the other thing that came out of this for us is that you need, as a financial services organization, or you need as a fintech provider, to understand that we now need to move to this sort of dynamic capability environment, and that financial services organization need to have this ongoing sensing of what's going on, and they need to be reacting to that and dynamically planning and dynamically implementing it. And the analogy I would put is, if you can imagine as your financial services organization that you are in fact a fighter pilot and that you're flying around this world today over Ukraine or somewhere, what are you doing? You're actually looking at your instruments. So what's going on internally? You're looking at the weather. What's going on externally? You're looking at somebody firing, potentially, anti-aircraft missiles at you or whatever. And you need to be doing this all the time in terms of ESG, because the environment is changing. And are we actually picking up that type of data? Can we process that quickly? And then, when this rocket's coming at you, you don't have time to react. You need, in some cases, nanosecond reactions. And we do really need some very quick reactions in terms of ESG. So how can we dynamically replan and understand what the implications are across our business model and operating model for our products and our customers, and actually put that in place? Now, typically financial services organizations, they're very slow to react. And how can we respond to the changing requirements, the changing regulations, the emergency that's there in order to be able to have impact and effect on what's going on? And that's going to be one of the challenges. And so how does the technology actually help us with that? So what we have here is a number of barriers to the development or implementation of RegTech ESG. And one of those is obviously uncertainty. And I think many of the speakers have talked about the uncertainty around S and the uncertainty around G. and certainly the carbon is a very important measure and what we can do that. But as you can see here, or maybe you can't see, here's some of the quotes from some of the regulators around this. And they're actually quite candid in terms of them basically catching up to policymakers on this, and they're struggling to do it. They're struggling with, and they're only at a very early stage in terms of how can we ask questions in terms of climate measurement and accessing the importance of it. So it's a really big issue, and the financial services regulators can't take full responsibility on their own for regulating climate. There's likely to be other regulators who are better suited to it, and the way we had, should regulators actually are they suited to regulate on cyber issues? The same thing comes into question around ESG issues and what are the roles of which regulators are going to be involved in this. And then there's obviously a huge data issue, and there's challenges of inconsistency across regulators, obviously, for organizations which work across different environments. I think the other thing is that ESG has a fundamental impact, should have a fundamental impact on your vision and your purpose and your strategy as a financial services organization. And what we are seeing is that organizations are grappling with this. And some of the largest ones in the world, their issue is, how do I get through this thermofrost, this organization thermofrost of people not really buying into it or understanding it, or their performance measures or short-term goals being a conflict with what's going on with an ESG, from an ESG point of view. And I guess this is normal for any organization, but it's certainly seen by leaders as a major issue for them in moving this particular issue forward. I think one of the things that we're finding is that ESG is likely to have a major cost for organizations, and you're all aware that the cost of compliance, and almost unanimously those people that we spoke to have indicated that they would expect another 50% added to your compliance costs to actually meet the evolving and developing ESG requirements. That on its own is going to cause a major issue, and that on its own is going to be a major driver of operational and business change for an organization. I think in terms of trying to buy fintech ESG from organizations, and these are the sort of points that banks have made, that their own internal ESG awareness and who is responsible for ESG is a major issue. Who's responsible for ESG, and the fact that does it really belong with compliance, or should it be at risk, or is it something that goes organizational wide? And that's an issue which I guess applies to compliance as well as ESG as well. But certainly we're finding that many organizations that we're working at are beginning to look at neurotechnology to really understand some of the human bias in decisions and some of the errors that are being made around some of these decisions. And we actually applied neurotech assessment to the fintech ESG organizations that we looked at, and that threw up a lot of issues. So typically when we interview somebody, they'll tell us something, and that could be something from the truth to a damn lie or somewhere in between. And certainly the report just threw up a whole load of issues in terms of the capabilities within some of the fintech organizations. I guess also your decision that you're going to make around how you're going to approach ESG, and particularly on the regulatory side, is kind of could be a career limiting move for somebody, and and replacing, I think as Johnny mentioned earlier, a legacy technology is kind of a big decision, and may not be one which you can safely make in your organization. So there are a whole load of drags, if you like, which make it very difficult for organizations to sell it. And I think what we're really finding is that there's a lot of tire kicking on ESG technologies, and so therefore, because the purchase time and purchasing cycle can be so long, many fintech firms have actually reported that it could sink us, and actually qualifying an opportunity up front and agreeing with the financial services organization what we're trying to achieve is really quite important for their own success. I guess the next area that we're looking at is kind of the business and operating model side. And fundamentally what we're hearing is that ESG results in a whole load of competencies, a whole load of skills, new processes, new technologies, which an organization has never dealt with before. And financial services organizations, indeed many organizations, aren't particularly good at operating across an ecosystem or understanding the implications. And whilst, financial services firms have been better at looking at the implications across their immediate supply chain, if you like, understanding what the implications for clients is actually quite difficult, end customers. And that's going to, I think with ESG, we really have to look at, what is the impact or the outcome we're trying to achieve, and work back through clients and see how we're actually going to move forward. And if we look, as I mentioned, sort of the early recommendations of the likes of the PRA to focus on client outcomes, that is going to provide a huge challenge. I guess the other thing is that understanding the ESG exposure, particularly counterparty risk, and the deep knowledge of the ecosystem which goes with that is actually going to be a big challenge. So I think the reskilling within financial services is going to be really quite important. And I guess the going concern status of certain financial services organizations, if this continues the way it's continuing, really comes into question. I think finally I would say innovating business model in particular, and possibly operating model, is really quite important. And I think what we found, particularly outside the financial services sector, innovation and successful ESG strategy go hand in hand. And if you don't have a culture of innovation, you don't have a culture of implementing that and failing fast and whatever else, like many fintech organizations do, you may not be that successful on it. I think, and this is my final slide, that if you are a tech vendor, many financial services organizations find it very difficult to prove the credibility of the value proposition. I think part of the problem, it was alluded to earlier, is that we have a lot of point solutions and how those point solutions integrate with other solutions. We don't have very big solutions at the moment in this ESG area, and trying to coordinate and trying to collaborate, which is difficult for many organizations to do, is actually quite fundamental for this to work. And there is, particularly from the smaller startup organizations, there's a general distrust of innovation and new software by these organizations. I think the other thing is, what we're finding is that with some of these firms, there really isn't a very strong understanding of either the regulatory aspects of financial services, which are obviously evolving and aren't coordinated, but also with the business model of these organizations, which is actually causing problems. And there's a lack of buyer appetite to engage with these smaller organizations or fintech because of the perceived risk. And finally, understanding of ESG regulations. Now, when the report is issued, I really would recommend that you read through it and read through even the quotes that are there. I mean, this is just, there's probably about 200 pages in quotes alone that we thought were actually worth putting into this report. But, fundamentally, as I said, unless we actually solve this disconnect and begin to address some of the more strategic issues and collaborate on this, it's going to be a difficult problem to solve. Thank you.
Right, thank you for sharing that with us. It was packed with quite a lot of very interesting data. Hopefully, there'll be more. It'll be extended and more detail in the report, which we look forward to seeing. So hopefully, we can send the link round to people who are interested in getting that. We're now on to final panel of the day. Last but not least, we have another fantastic panel. I think we've been very lucky all day with all the senior level people we've had sharing their insights, and that continues now as we talk about how to efficiently manage ESG risk. It's my pleasure to welcome as chair Chris McHugh. Chris is a Principal Enterprise Fellow at the University of Southampton and a Senior Advisor at the International Association of Credit Portfolio Managers. His research on the private sector operation of development banks and the interface between sustainability and financial markets. So a perfect person, I think, to chair the last panel. Thank you. Over to you.
Great, thank you very much. So yeah, best till last, always. So hopefully this is going to make this a very exciting session. We realize it's quite risky to be between you and the cocktails afterwards, but we're going to do a very good job. I just, full disclosure, I spent 20-something years as a derivatives trader, so I get quite excited about risk mandates and frameworks, and so I'm looking forward to hearing what the panel has to say. Before we get into questions, I will just ask each of the panel in turn just to introduce themselves and explain how they relate to this particular topic. Keith, could I start with you, please?
Does that work? Yeah. Okay, so it's Keith Davis. I'm currently the Chief Risk and Compliance Officer at Federated Hermes, who I think are the UK's oldest specialist ESG investment management company. And there, and also at M&G, with the help of Michelle down the line, I introduced, I think, the first sustainability and reputational risk frameworks in the insurance sector for sure. So heavily involved in this area.
Well, I'm Chandni. I'm the founder of Oak1. We are an ESG research provider, and we help our clients get an accurate and transparent view of the sustainability of a company's operations, be it internal, so their own operations, or external, their portfolio or their balance sheet.
Hi, I'm Victoria Collins. So I'm currently Global Head of Climate Risk and ESG at Nomura. So I'm responsible for implementing a framework for managing climate and ESG-related risks within the firm, meeting all the regulations in the various jurisdictions in which we operate, and also aligning to the firm's strategy relating to sustainability.
Afternoon all. Last but by no means least, Michelle Leavesley. I'm Director of Organisational Risk and Resilience at M&G PLC for 3.5 years. I am currently on a sports sabbatical, so excuse the cap on the profile picture from LinkedIn, but I'm also associated with cricket and the Commonwealth Games, so I'm having a little bit of time out at the moment. But my role was to support CRO office and CEO in setting up the first approach to managing ESG risks. So really looking forward to the debate this afternoon and hopefully lots of interaction from the floor.
Great, thank you. Just a reminder, you can submit questions through Slido and they'll appear magically in front of me for me to ask as we go along. I think if we do a good job, we'll be able to tease out some real-world problems that I think will be of interest to you, the audience. I think what I'd like to do is sort of start with, actually, Victoria, with you, just to ask the question of how do you even start as a financial market participant to put ESG into a risk framework?
Yeah, okay. So I'll respond from the financial risk perspective. So, I mean, there's a number of key ways we need to think about ESG risk. First of all, they're not new risks at all. So, you know, to quite an extent, they're already embedded within our frameworks, but they just historically haven't been embedded to the degree that they need to be. So, primarily, you know, we incorporate them within the existing risk classification. So from the credit perspective, you know, one of the key elements that we need to think about is how the ESG risks impact creditworthiness. So an approach that can be taken is that you can break down your ESG into a number of, you know, risk drivers relating to each of those three factors, and then do an assessment of that, and then ensure that in your credit rating processes that those are adequately accounted for. And chances are, to quite a significant degree, they are already incorporated. But then, you know, clearly with, you know, the environmental ones, such as climate risk, those risks are escalating, so that you might need to adapt your process to kind of better incorporate them. Then, like within your kind of due diligence processes for new transactions, you know, I know a number of firms have now got an explicit ESG assessment as part of those processes to make sure that those are, you know, properly thought through and considered. And then, you know, from the climate perspective, there's a huge range of tools that have been developed. So one of the key ways of assessing climate risk is to build out some scenarios. So, so you do the scenario analysis, looking at kind of much longer time frames that typically you'd assess your risks within, and then use the results of those to assess whether your strategy is appropriate, and also, to use them to see whether you need to put aside financial resources, etc. So those are kind of some of the key methods that we've adopted, expanded to approach the ESG risks.
So, Keith, how does that compare with your experiences?
All right, very, very similar actually. I think it's very fair to say, I totally agree with Victoria, these are not necessarily new risks, these are ones that we haven't thought about before. And if you take it back to first foundations, the definition of risk management, if you go to ISO or something like that, will say the protection and creation of value. So therefore, the risk team should look at everything that drives a firm's long-term value, however you categorise that, whether that be the traditional financial ones or the non-financial ones, as we're now seeing, i.e. the ESG ones. And I think the ESG ones certainly fall into that. If you look at what's happened to, say, Yorkshire Cricket Club last year or P&O Ferries, they would not be traditional financial drivers that have had a massive long-term impact on the company's brand and value. So I think it's fair to say that they definitely need to be integrated holistically, credit and other ways. And in fact, I'd actually call them not non-financial, I'd call them intangibles or indirectly financial or something, because they have a financial impact. That's the whole point of this position. So the question is, they need to be assessed. How do you do it? And there's two schools of thought at the moment, and this is in the intellectual battleground, which none of us are particularly interested in, but it's ultimately, do we look at ESG risk as a separate standalone risk? Or do we, like Victoria's highlighted in credit, do we drill down to the different areas and try and work out the impacts they have on those specific risk types? Now, at one level, and I'm a pragmatist, I actually don't care, because the reality is these are very big risks that aren't currently being properly managed across firms. At the moment, I personally believe you need it as a specialist team where there isn't the skills, because there's a lot of areas which won't have the specialist skills as Victoria would have in Nomura. There's a lot of risks that actually don't actually fall naturally into existing risk types. You take the social risk stuff, the human rights, the sort of the culture, the conduct pieces, they don't naturally fit into a framework. So maybe you start, wherever you end up, maybe you just start now with a centralised team of specialists. I also think that that's important, and there's a couple of other reasons why I think that model works, because the mindset of that function has to be a bit different to traditional risk functions. If you think about the traditional, let's take operational risk. You have a risk, you control it. You put preventative controls in, detective, corrective controls. You can control it. It's within your gift. If you get it wrong, you get it wrong, but typically you can control it. The thing with ESG is a lot of it is external. A lot of it is not in your gift. A lot of it is what stakeholders perceive things to be, or values or behaviours that you can't directly control. So this risk team looking at the ESG needs to look at those things, and we can't control them, so it's more about how do we minimise them and how do we react to them. So that's one difference why I think a specialist team. The second one is I do think you need to think a little bit outside the box, because it's some of the ESG risk is inside out, i.e. what you do as a company and how that affects your firm's value. So what is your D&I stance? What is your carbon footprint? And clearly the risk team needs to look at that. But the other one is, what is the outside-in thing? So to Victoria, how does climate impact our value? How does climate impact our operational pieces? How do we look at firms, other firms in our investment books? There's an inside-out and an outside-in, which is a bit different to other risk types, and again is a different mindset. And the third one, which is there to some extent, but I think becomes bigger, is the whole supply chain matters to a firm in this space. If you look at some of the fashion scandals and the sweatshops, it doesn't matter whether the people making the garments are outsourced or part of use. It's Nike that gets altered. So you need to have this more holistic end-to-end view than you perhaps have in traditional risk management functions. So I probably haven't answered how you do it. There's lots of individual techniques, and they're not new. They're just applying a lot of similar techniques in a number of areas, as Victoria indicated, adapting. But it's actually more about the mindset and the approach of a risk team that needs to be different to ESG.
Thank you. Well, fortunately, I think Chandini's going to explain exactly how we're going to do it. And I'd be really interested to see if you could talk about it from your perspective in the data frame. You know, what has changed, or why is it different at all? Is this same old data used differently, or is there something fundamentally different for you?
No, I mean, I think it's definitely different from the sense anything could be ESG data at this point. To Keith's point, operational risk, you can control it. You also know where to source that data from. But it could be something written somewhere in, I don't know, Brazil that eventually ends up becoming an ESG risk. And that becomes challenging for our clients when we work with them. Just the scale of data gathering to even get an accurate view of that risk is huge. And then Keith said the entire supply chain is important, and we've seen so many examples in the last year where companies, their second-degree removed supplier was doing something, and then that spills down to their supplier, and then eventually it spills down to the company. And then for our clients, it's about how do we think about these risks proactively and forward-looking? Can we get ahead of them? Can we gather this data? Can we make sense of this data? And that brings to the question of how. I guess the main question is, how do you define ESG risk? What is for your firm ESG risk? Is it, and then when you segment it down by climate, what sort of granularity are you looking for on climate data? Victoria and I were talking about this earlier. If you can look at the operations of a company, but then that company could have international operations. Where it has international operations, what kind of operations does it have? What are actually the physical risks that company is exposed to? If you're thinking about social, what kinds of social risks do you want to then gather data on, and how do you choose to analyze it? Is it about internal, to Keith's point, the well-being of its workforce? Is it external, the impact that those companies are creating? And then, yeah, I mean, the same goes for governance. But to your original question, it is quite different in how you gather data for ESG. And I think the starting point is for the firm to have a framework in place on what they classify as ESG risk, and then to start putting protocols in place to start bringing that data in and analyzing it.
Great, thank you. I mean, one thing, arguably, the speed at which this has come around is a lot quicker than other types of market adjustment. So, Michelle, if I could come to you, when you sort of reflect on what's missing, in particular with reflect to sort of skills that may exist or not within organizations, what are your feelings on that?
Sure. No mistake in my job title. So Director of Organisational Risk, not Operational Risk. And as Keith mentioned, that was very much on the basis of focusing on the mindset and the culture of the business. So I think we've spoken about the sort of third leg. You know, you've got the financial risk. You very much operational risk. Probably 10 years ago, people probably thought operational risk was the new kid on the block. Whereas my role has been very much to focus on the collective accountability and responsibility across all lines of defence. So number one task as Director of Organisational Risk is to support the CRO and the CEO, who uniquely owns my control policies for ESG and for reputational risk, to bring people with us on the journey so that the process, as Victoria said, doesn't change. We have to identify, anticipate, mitigate the risks that we face, but actually that's everybody's responsibility. It's not uniquely the risk team, and the default setting is to them. So in terms of skills, I very much came from a non-traditional risk management background. So in terms of my recruitment, I'm amongst friends here today because I had a foot in technology, software platform used in financial services as a risk management aggregator tool. The CRO had tried an operational risk type approach, and I was asked to come in having tried that, and it didn't work. It didn't bring people with them on the journey. So I have that unique understanding around technology, tools. I think I had to spend a lot of time housekeeping when I first landed because we had so many tools in the ship that actually there was a lot of duplication. There were different legal entities using different tools, coming up with different results. So there's been a lot of foundation of housekeeping. So understanding technology, Chris, communication, culture, people. Ultimately, we spent the day talking about data, and it's been hugely interesting talking about technology and data, but how we interpret that data and the people part of the equation is super important. So I'm looking for people who work in FinTech to move into risk, communications professionals to move into risk, and that's really after 3.5 years at M&G, we've very much transformed the risk team to have a much broader skill set.
I'm actually going to stay with you with a quick follow-up. So one of the things in something like operational risk, you might have a framework that, depending on the severity of loss, you escalate it in different ways, or you have some reporting mechanism. Yeah. When you talk about culture risk or organizational risk for ESG, and in fact, anyone can chip in on this, I mean, what does that look like?
So we very much use the existing risk management framework. So I think when, and a number of us in the room belong to the Sustainability Forums for CRO, and we've shared best practice and shared thinking on this. And there were two schools, you know, completely separate approach versus adapting our existing risk management framework. So we use our existing risk management framework, but the difference in terms of the escalation, I won't mention the tool, but you know, most of us have a risk management tool that we use. The challenge I've had from a sustainability perspective and from a reputation perspective is the incubation, the fact that something can arise that's an issue, and our traditional risk management tools want us to close issues, wants us to act and then forget about it. And you know, we're measured at risk committee on how many closures we've had. That doesn't work for us in our environment. So what we've done is we've taken risk management framework, adapted the tools where we can to make it work. But there's still a long way to go, Chris. And in terms of some of the software tools that we use, we need them to move with the times because some of them aren't moving that quickly.
It'd be quite bold to say you've closed the climate risk at this stage, right? So,
yeah, but I think it is actually worth adding. I mean, that's a really important point because if you think about these, if you turn ESG upside down, it becomes reputational to some extent. And the issue with reputation is it could be a bad news day or a big news day, or it could be accumulation of lots of small things, or it could be the flavour of the month. You happen to be the third company that's done X. So there's no quantitative threshold at this stage that allows you to say it's this important, it's that important. So, but you still should use the same frameworks, but perhaps with a lot more subjective opinion. I mean, candidly, when something happens and it's front page of the newspapers, that goes to board level. If it's something someone's spilt a drink on the carpet or whatever, so it's a lot more subjective. But I think it comes, and that's precisely why I think you need experts or specialists in this area, because it's not a case of pressing the button and saying the probability times the loss is this, which you can do in some of the risk areas. It's actually, do we really think this can have a material impact? And that is a lot more subjective.
So what I'd like to, just to follow through, I'd like to get Victoria's views on the what she feels she might be missing in terms of informational systems, and then I'll come to Chandine and talk again about what you think, whether we almost have too much data or whether you think there's things that are missing. But Victoria first.
Yeah, so I think it just really depends. So there's many different approaches that can be taken with respect to how you go about identifying and managing ESG-related risks. And it really depends a lot on the actual business strategy and the business model of the firm as to what's appropriate. So it's so not a one-size-fits-all at all. So, for example, if you've got kind of relatively low, let me take climate risk as an example. So if you've got kind of relatively kind of low exposures to it, you don't need all the bells and whistles. So that means that you can just do a very kind of high level approach, use your heat maps to kind of determine whether you've got any concentration risks, etc. And you don't need to go into the kind of really granular level of assessing every single exposure that you got and all its asset locations and the precise impact of what the physical or transition risk might be. However, probably what is a good approach to take is to, once you've identified where you might have some concentrations, then do kind of much more detailed drill down into, some of your kind of core risk areas. So really a bit of a blended kind of, a top-down and bottom-up approach. And for that, you might need to go into kind of much more detail around, with your data requirements to get, the precise data and potential impacts of, whatever the climate-related risks, for instance. So you know, it very much depends, you know, on your overall business mix as to what approach is appropriate for you. And that's in line with what we've heard, you know, in a number of the regulatory discussions today, in that it's very much the principle of proportionality that we need to apply for this stuff.
Chandina?
Yeah, no, I was just, and Victoria and I already had this chat earlier in the speaker's room, but this is actually what we're seeing across clients to define your priority areas. So Victoria, you said, for example, that you don't need the exact granular detail on everything when you start out, but first mapping out where exactly your exposures lie, and then wherever you have the high risk exposures, drilling down on data into that. And we get a range of requests from different clients. For climate risk, for example, for someone who has really high exposure to intensive assets, then the challenge becomes every company actually reports differently. Someone will say scope 1 plus scope 2, scope 1 plus scope 2 minus these factories. How do you start to bring standardization around that? If you want to do scenario planning and you want to see, are you even in agreement with the Paris Agreement, for example, you first need to standardize that data. But you only need to do it if you actually have that significant risk on your portfolio. Your risk might actually be the social risk. You might have exposure to companies that have extensive international manufacturing, and then your significant risk becomes, do they have any sort of labor abuse in their supply chains? And then you need to start collecting data on those kinds of risks. So I think what Victoria is saying, that blended approach, top down, first having a view of where those risks are, and then drilling down on each one of those. I think we've seen that approach works best with our clients, really.
Can I stay with you? Actually, I've got a question from the audience. As the effects of climate change continue to change themselves, how does it affect ESG risk? And I'm interested because when you think about climate risk, the data we have doesn't include the future. So how do you address that from a data perspective?
No, you're right, it doesn't. And that becomes a huge challenge because the best that we can do today is look at the direction of travel, really, and see at least are we going in the right direction. For financial institutions specifically, the companies that you hold in your portfolio or a balance sheet on an aggregate portfolio level view, have they set the right targets? Have they set the right goals? And then are they moving towards those targets, or first, are they even disclosing against those targets, and then are they moving in line to at least achieve those targets? That's the best that we can do at this point, really.
Yeah, I guess the same question to Keith and then Victoria, the same about adjusting frameworks.
Yeah, well, I think that's very true. I mean, but I think let's be clear that that's true of a lot of other risks. We only have historic data by definition. Some patterns are more predictable and more understood than climate. So I think you always need to project into the future. I think the issue with climate is actually it's going to be non-linear. It's going to be a tipping point, a Minsky moment, whatever you call it. And how do you work out what that is? Plus, of course, biodiversity is the next one. How do you work out where the points come where there's a point of no return and therefore it becomes a different structural model? I do think one of the points on this is that you end up being very careful with the data you use, but making more about the assumptions you base it on, because that's all these are. These are forward-looking projections at the moment, and it's critical that you don't place too much weight on the outcome of any model at the moment, or any model ever, because it's actually ultimately only as good as its starting point, but also the assumptions and the modelling techniques to get to the future. And I think this is particularly true at the start of a journey and when there's a non-linear piece. So I think, and as things change, of course, you have to change approach. Science-based targets are absolutely the way forward to monitor an individual company, but actually it doesn't matter if you've got all the 10 best companies in the world if the world collapses around you. So you ultimately actually have to adjust, as you would do with any market. In the financial market, you can look at certain parameters, but all of a sudden liquidity becomes king. That doesn't mean the old models are invalid. They're just not right at the moment.
Yeah, I think one of the important points as well is that you shouldn't be kind of too excited about the precise, numbers that you get out of, say, a scenario analysis. But you're just really looking for an order of magnitude to see which parts of your business model, do have a significant exposure. The fact that it comes out with kind of a 3 million loss versus a 500 million loss. You know, it's the order of magnitude, not the precise number. So, you know, then, I mean, certainly over, you know, we've made so many developments over this last couple of years in developing our models, but we're so at the start of the journey that we can expect everything to evolve so much. You know, we're just learning from each other, from, you know, various kind of peer group sessions, and learning from organisations like GARP about, you know, what each other's doing to kind of enhance their models. So, you know, we're all on this kind of journey, and it's going to carry on improving. So I don't think we need to be too married to, you know, a precise methodology.
Great. Actually, Michelle, can I come to you? To another question from the audience. We talk about roadblocks or things that make it hard to implement ESG risk management frameworks. What would your take on that be?
So, in my experience, sticking to strategy and holding our nerve. There are so many different elements of ESG, and our stakeholders are also key influencers. We live in a global and digital platform where, you know, one individual can hold a business to account. So I think that, you know, everything, all of the discussions today have got to link back to the key strategy, and that's going to be very different for each of us in the room, depending on our business. I think the other part, Chris, is the scope of where we look for ESG risks, because we tend to drill down very quickly into products, services, deals, investments. But actually, where I sit from a reputational perspective, talking to fantastic conversations with James earlier today around reputation, that actually being authentic and having sustainability at the heart of our business, going back to some real basics around brand, purpose, vision, is absolutely critical. And it was great to hear people talking about greenwashing earlier today, that it's not just about regulation, but actually living our truth and being really authentic in how we manage. So ultimately, if you get that bit right, managing ESG risk becomes a lot easier, because, you know, if you cut yourself in half, you're living and breathing this stuff. And I see too many people's websites or businesses' websites that say sustainability is at the heart of everything that we do. And I think, really? Okay, well, I've just read about, you know, how you've treated your employees, or I've just read on Glassdoor your employees' perspective of how the business is operating. So, yeah, I am a helicopter view person. That's why I'm organisational. You know, what is our strategy? What are we trying to achieve? You know, are we living it?
And Chandini, from your perspective, when you're engaging with your clients, what kind of roadblocks do you see? Obviously, you'd like them just to sort of sign up for all your services, but when you do speak to them, and what are some of the difficulties they encounter?
Yeah. So actually, to one of the points that Victoria said earlier, it's not one size fits all. And actually, when we speak to clients, and that's where we come in, is that challenge of it's not one size fits all. So if you sign up with a ratings provider, then the data comes packaged in a certain format, and you sort of have to just make it work for how you think about ESG. The other challenge that they have is with the transparency and the coverage. So you're trying to cover a certain aspect, a certain sector, let's say, or a certain geography, and you realize that you only have data on the operations of your only 50% of the operations of your portfolio in that region, and then mapping out the rest of it. So the biggest roadblocks that we see with them is, okay, I've got a high level score, or I understand my portfolio is facing these risks, but I really can't drill down and actually understand what is the root cause of this risk. Why is my portfolio, why does my portfolio have climate risk? What exactly is it about this business or these sets of businesses that exposes it to climate risk, or that exposes it to a social risk? And the other challenge that we see, to Keith's point, you said something about if something is on the front page of the newspaper, then it goes to the board. But if, you know, it's someone spilled something on the carpet, it's not something that you look at. But when does it become something that you need to look at? Because we've seen examples of companies where there's, you know, small indications here and there of some issues, and nobody's really talking about it. And suddenly some NGO picks it up, it becomes massive, then it becomes front page news. Can you get ahead of it and start managing it, start driving conversations at the board of that company before it even becomes a concern to be talked about?
Yeah.
Chris, can I just add a couple more? Because I think so. I think one is, and it links into everything. There's so many, you actually have to pick what is aligned with your values. You've got to be authentic. You can follow every trend and every front page of the newspaper and be all things to all people, but you can't deliver it, and ultimately that will come back and hit you through greenwashing, etc. Secondly, though, I think that this is a really key point, is that you have to do it holistically, because there's trade-offs. If you take something, the obvious one everyone talks about is the just transition, whereas if you reduce carbon too much, it results in poverty in those countries that produce it, and you have social problems. You cannot do this one by one. There needs to be a proper ESG strategy, and again aligns into your values. The third one, and I'm going to be honest, is the naysayers and the education. If you think back, sit around a board table 5 years ago, people were still climate deniers. You sit there now, the knowledge of people, and this is not an ageist comment, but typically the people that are around board tables making strategic decisions have not been involved in this world. It's new, it's fast, it's different. Do they really understand the implications of this? Do they really connect with what the stakeholders want? That is another big problem for companies. The people making decisions may be out of touch with what their stakeholders want, and that's what ESG largely is about.
So I want to pick up on that slightly, Victor. I'm going to plant a question on you that we haven't prepared. So here we go. So thinking about it from a bank perspective, a traditional risk limit, you might say, right, when we hit a limit, you can order a trading desk or a loan book to reduce and cut and rebalance. With an ESG risk, is it different? Can you mandate a business to change, or is it more an act of persuasion at this stage?
Yeah, I think that's a very good question. So I think with respect to ESG, there can be some things that you can mandate. For example, new transaction, you can have a screening process that mandates that you don't sell, you don't finance munitions of some description, cluster bombs, for example. So the screening process might have some very clear and obvious exclusions. However, there's a lot of grey areas, and quite often when you're you're assessing whether you should do a certain type of business, you're weighing up if you're doing your ESG assessment, there'll be some factors that actually are really positive, and then some kind of really negative, and so it then becomes really a strategy decision as to whether they're comfortable in participating in such a transaction. And for example, we fairly recently put in our ESG assessment process, and so we have an escalation process whereby if there are contentious ESG-related issues, that it goes up to Reputational Risk Committee for discussion and agreement whether to proceed or not. And so it's almost a bit like, case history, in that the decisions made within those reputational risk committees will then inform what kind of business that we do going forward. So it's not like you're mandating explicit kind of exclusions on like every single component of and every possible kind of risk driver, because that's just impossible. It's much more nuanced than that, but you can just learn by the decisions that are made in the past.
That's interesting. I was hearing someone talk the question of how far down the supply chain you actually look. How many degrees you go down, and that's a sort of, I suppose, would you see that as a reputational risk acceptance when you think about those?
Absolutely, and it's that's why you need the right level of people in the organisation to discuss and actually decide whether they risk accept it or not.
Thank you. We've been asked for a clarification from the audience, because I think we've said a couple of things that are potentially contradictory. So I'll throw this wide open. One is that ESG risks are not different and that they fit into existing frameworks, but at the same time we need specialist teams to look at them. So this is an unrehearsed question. Who would like to take that one? Keith, you're looking very keen.
I can give my go at it. I mean, at one level, they clearly are different because they're being thought about in a new way. People have not thought about them before in the same way that we're thinking about them now. So they are different. They, as I say, they have a number of reasons why I've said they're different. They're outside in. They're more reactive. They depend on stakeholders' reactions rather than internal controls. We've just discussed you can't probably control them in the same way as you could traditional financial risks.
So they are different, and for those reasons, I think you need a different mindset. However, I think what we're saying is that they can be fit, as all new risks have done in the past, operational, cyber, etc. They, over time, people work out how they fit into existing frameworks and adapt modern frameworks to do them. It's not as if we've had a risk universe for 50 years that everyone's agreed, and then there's this great new load coming along. It's part of that evolution. So I think there are fundamentally differences. That's why they're a different risk, in the same way that cyber is different to operational, to people, to credit. They're all different in some way, but the tools that we, the basic, I think Michelle said it, candidly, it's identified, try and control, react if it doesn't work, respond, or whatever the framework you hit. That is no different. It's just different weights and different ways of doing it.
Do you see parallels in things you've done in the past?
Well, yeah, I suppose the maturity piece is the biggest difference, isn't it? I mean, we're just not as experienced as businesses in looking for ESG risk, so we have blind spots, and I think that's the big concern. And I know over lunch people were talking about the E versus the S versus the G, and some were talking about G squared, the geopolitical dimension. And it just seems that there's something new. The pandemic landed. It's quite a challenge in terms of identifying where those blind spots are sitting within some of the really large businesses that we operate in. So I think maturity approach, as I said, stakeholder influence, I think is quite challenging in respect of this specific area of risk. And that can come from employees, and too often we overlook our employees. So there are definitely meaningful differences, but I still think risk management should always be looking to innovate. So complacency is not a good place to be. So we're always looking to evolve the model.
Can I slightly counter Keith's view? I don't think they're new risks at all. I just think they have historically been very poorly identified, and there's been less focus on them historically. Whereas actually, they've always been around. I mean, some of them are escalating. For example, climate risk. Obviously, the impacts are escalating with respect to that. But I think it's more about the lack of identification and the lack of focus on trying to identify them. And that's where the big changes happened.
Good correction. Newly in focus.
So we're just coming into the last short amount of time. I think I'd be very interested, it's an obvious question to ask people operating the risk space, is, what's the top 2 or 3 things on your list for the next, year or so, things you think, the burning issues. So maybe we'll just go down the line. I don't know if you want time to think about it. Keith, you want to go first?
I'll be boring. It's regulation. It's how there's so many different regulations. There's so many different measures of ESG, climate, labels, ratings. How do you make them all work and still run a business?
Excellent. Chandini, what about from your perspective?
I have a really simple answer. Whatever answer they give, those are my priorities to make sure I make them happen.
Okay, fair enough. They're all right, yes.
So I think designing a risk management framework that supports the business strategy, for example, a lot of firms are signing up to net zero. So how do we go about supporting that? So that's going to be key.
Collaboration. I think, we can't do this alone. And academic institutions, we're talking about innovation, FinTech. We need to be smarter, more resourceful, and work together.
Great. Actually, we've got time to squeeze one last late entry from the audience, which is about, greenwashing, colour washing, whatever you want. I think we've touched about it, but just to address that one directly, how do you see that fitting into the sort of the overall risk framework? Is it a reputational problem, or what do you think, Victoria?
I think we're just going to have to be whiter than white. For example, if we come out with a firm strategy saying that we're signing up to net zero, then our business model is going to have to demonstrate support of that throughout the organisation. So I think that's certainly one of the key things.
For me, it's going back to that authentic, delivering what we promise and understanding how we're going to deliver our promises. So someone mentioned earlier today, it's not just about regulation. We've got to be authentic.
2 levels. I'm going to sum the 2 up. One is internal. If you don't walk the walk, you're going to be called out, and that's a reputational risk largely. If you sell products that mislabel, that is mis-selling. It's regulatory. It's going to be reputation as well, but that is outright illegal or regulatory issues.
Chandini, your closing thoughts. What do you think?
I mean, no, we actually, this is a burning question that we try and answer for a lot of our clients is when companies disclose or they set targets, are they actually, do those targets translate into action on the ground? And can you get independent verification or third-party verification of, if a company says we're trying to eliminate deforestation from our supply chain, have they actually done that? Or they're saying we're going to be 99% forced labor free, then what is the actual reality on the ground? And just marrying those two, self-disclosures versus third-party verification, I think is really important to avoid greenwashing.
Thank you. Well, I think it's good to end on a question, because it means there can be a sequel, I guess, at some point in the future. It just remains for me to thank you to everyone on the panel. Thank you very much for your contributions, and thank you for your questions.
Thank you, panelists, for a brilliant way of ending the day. It's been an intense day, but we sorted out ESG. Maybe not, but we did have some fantastic presentations and discussions, and we addressed a lot of the critical issues that are happening at a very critical time. But it's great to see so many people are deeply engaged, way beyond what I think we'd expected. People have gone beyond talking, and there's a lot of action happening, and it's clear that people are quite early on in that journey. So clearly, we must have a sequel. We'd like your feedback on how we do that. We could easily multiply the size of this event, but we tend to keep our events below demand in order to keep up the quality of the discussions and the caliber of the participants. So please do give us any feedback you'd like to about how we take this forward. Finally, I'd just like to thank everybody, all of you delegates, all of our speakers, our presenters, our sponsors, the FinTech Global team, particularly Audrey, for all the hard work they put into making this happen. And please do now join us for a drink to another chance to network. If you haven't been around all of the sponsor stands, please do. You'll probably get another surprise, and it'll be well worth your while. But thank you for participating today. It's been a pleasure to be here with all of you, and I look forward to having a drink with you now and seeing you again very soon. Thank you.